the the core value that you're going to learn here is redefining what you think trading is. All right. So I put this little thing together here. So you guys are here because up until this point, you've been trading in the dark. All right. And by now, you've pretty much gone down every single rabbit hole in search for what you have been led to believe is the Holy Grail, right? We think there's some form of perfection or there's some point in time that we arrive, right? And in trading, there is no arrival, okay? And so you've dabbled with concept after concept, system after system, yet still the pieces have not led to profitability. All right. So what you do is you go back, you retweak the system, you add more filters, you learn about another concept, and then later on you find out once again, right, you're right at a dead end. So in going through that, like, what is the issue? All right. So the issue is that you don't quite understand what trading truly is at its core. You believe that the way to profit is to win. All right. This is how the human mind is created, right? We don't like uncertainty. We want to win. All right. You spent all of your journey focusing on finding a way to win. However, right, you have not focused on how to make money in trading. I want you guys to understand there is a complete difference in the two. And sad enough, the internet, right, has fooled really all of us. Right? 99% of us begin this journey, and we have this certain belief about how to succeed in this space. However, that belief is very, very far from the truth. All right. And so what is my purpose in me telling you this? All right. So my purpose is that from today on, we will redefine what you think trading is. All right. You will no longer trade for money. You will learn how to trade for expectancy. All right. You will no longer focus on how much you will make. Instead, we have to learn to focus on how well we can become at losing or how good we can become at losing. All right. As contradictory as that may sound. But don't get me wrong, as mentioned, right? We're going to gain some of the most profound understandings from this day forward, right? You will also truly leverage the proper application of those understandings. All right. You'll develop a rule-based trading system, and that system will be built on mere objectivity. All right. But in doing so, the most valuable thing that you will gain here is the enlightenment needed for longevity and sustainability in this industry, and all of which have little to do with technicals. And no, it's not psychology. All right. But it's necessary that all pieces are put into place first so that by the end of boot camp, right, you guys are prepared to receive the true holy grail of trading. All right. There is a holy grail, right? But it has nothing to do with technicals and it's not psychology. All right. But we've been led to believe that, which is why we're aiming for a certain target, right? And honestly, that target is not there, which is why it's hard. It seems hard to hit that target. All right. So much of a holy grail that you could merely trade any strategy or system for profitability. All right. So yes, we're ICT traders, but obviously you guys have learned that just listening to, smart money or ICT is not going to make you profit. All right. And there has to be something else that we've been missing this whole time. All right. And we're going to basically bring you guys to that form of enlightenment. All right. So our job is to help you see the promise. Your job is to pay the price, right? We're going to go from trading in the dark to trading in enlightenment. All right. So today's lecture, right, is building the framework. Let me just ensure that we're recording. I like to just double check. So today's lecture is building the mental frameworks, right? This is the paradigm shift into logic and delivery. Okay, so consider that over the next few months, we will be building a bank, right? Which in turn is you guys becoming profitable traders. All right. However, in order to build that bank, right, or in order to optimize our work, we must first bring the necessary tools to the building site, right? Which is what we're going to do today. So learning objectives for today, right? Base principles, we'll just talk about liquidity. That obviously that is something that is already coming in this space, right? But we want to make sure that we cover all angles. We'll go into market efficiency paradigm. Just speak briefly about PDRA matrix, then we'll go into dealing ranges, and we'll have tons of examples. And it won't just be terminology and visuals. It'll be you guys actually understanding what creates the delivery and what creates the significance behind the delivery. All right. So getting right into it. Base principles. All right, just starting off the PD array matrix. All right, so when I'm looking at the PD array matrix, so I'm thinking about the PD array matrix, right? Without overcomplicating this, initially what I perceive or what we perceive is the high, the low, right? The OB and the fair value gap. Now there are multiple arrays. However, you will soon find that the fair value gap, I promise you, is the single most important array in price. Almost every other array heightens in probability when accompanied by an imbalance, right? You think about order blocks, right? Order blocks that are accompanied with imbalances. Those tend to be highly probable OBs. Breakers where an imbalance is on the opposite side of price, right? Those tend to be highly probable areas for price to turn around from. And then also mitigation blocks. All right, and then just one little keynote. If a breaker, if you have a range, sort of like what we have here, right? And that breaker, there's a breaker fair value gap combination, right? Most of the times when we're thinking about PD array matrix, right? You're trying to frame, we have that dealing range or that range, and we're trying to frame which PD array price is going to run to, right? If you have that breaker fair value gap combination, most times we won't necessarily make it to the extreme of that particular dealing range. All right. Now, of course, as time progresses, right, we have to go into speaking about rejection blocks and things of that sort and really gaining an understanding behind them. But for starters, this is what we want to proceed. All right. Now, up until now, right, you guys have been taking the PD array or PD arrays for face value, all right, and just trading the PD array, okay? And we have to shift that understanding into understanding that the PD array alone only provides potential, okay? There's no promise that the fair value gap, the order block, or the rejection block, there's no promise that those things will hold up, okay? And so we trade the response, right, high probability pricing sequence at the array, not the array itself, okay? So just a very quick example. We're coming back up here, right? Price is trading back up into this breaker fair value gap combination, all right? We're not just gonna go in and execute a limit order entry just because the fair value gap is there. All right, we have to understand that what will show up on a fractal basis is that high probability pricing sequence. That shows up every single time, right? It's going to be here, here, right? Even here, right? And then also here. Okay, and so we're at this point, once we're at that array, we're locked in, we're zoomed in, and there's a certain response, all right, that we're looking for. It's very objective. Once we get to Model X, you guys will see what that response is, all right? So moving down into liquidity signatures, all right? Obviously, pretty simple. We all understand that above every high, we have buy side liquidity. Okay, below every low, sell side liquidity. Pretty simple. All right, moving along from that, we have our high resistant and our low resistant signatures, right? A high resistance signature, obviously above this high, there's buy stops, okay? So a high resistance signature is simply just price actually running out the buy stop liquidity pool, right? And then reversing, trading back through the range to opposing liquidity. All right. The idea or theory or concept is that price will be more protective, right, of the stops above this most recent high. Right. On the opposite side of that, there's another high where we have buy stops. Price rallies here. Okay, we fail to run back above that high. This becomes a low resistance signature. All right, meaning that price will have a less tougher time, right? At any point when the look back function kicks in, it's going to be more prone to running out those particular highs. All right, and have a much easier time. So high resistant, low resistance signature, low resistant, we tend to term that as layered liquidity, right? That stops above that high and that high. Okay. Internal versus external range liquidity. Pretty simple. All right. External would be considered anything outside of the box, right? Outside of the range. Okay, so if we're, if we have this type of price action here, external liquidity would be anything outside of that range, right? And then obviously internal is everything inside of the range, right? Now, high and low resistant liquidity runs. All right, high and low resistant liquidity runs. All right, so in high and low resistant liquidity runs are first framed from the premise of the current state of institutional order flow. Basically, what that means is, am I on the buy side or sell side of the curve? And obviously, that idea, right, is fractal. I'll show you how. Okay, it is best to trade in low resistant liquidity run conditions. All right. Subsequently, we can just say trading with the trend, pretty much. All right, as fancy as it sounds. And then trading against the trend, a high resistant liquidity run is lower in probability. Okay. So if you guys look at this image here, all right, what we're seeing is these down close candles. All right, this is a weekly chart. These guys are supporting the direction of price. All right, and as we're supporting the direction of price, right, obviously from a higher time frame perspective, we understand that the buy stops, right? This is technically where the low resistant liquidity run is. All right, but on a fractal scale, once price reaches this point, right, we need to trade back down into a discount PD array, right? Rather, it stops at the fair value gap or it actually pushes to the actual OB. Okay, so when we scale down to our 4-hour chart, what we would understand is that the move back lower, all right, for a certain time period on this scale, right, these lows, right, taking out these lows, trading here would be the low resistant liquidity run, right, up until a certain extent, right? And that extent is to the point where we reach, you can see here, this is that higher time frame weekly OB. All right, so then once we get closer inside or to that weekly OB, we understand that this is where probabilities are decreased in terms of us, taking shorts. Up here, we're good as we're, on an intraday basis, we're taking shorts. We're understanding that all of these lows should be attacked, right? The highs are protected at this point. This is nothing but a hedge program or a sell program, a buy program going on, right? Where, institutions are attacking on those buy positions here. All right. And as we make it down to that weekly OB, right, we understand that the closer we get, now it becomes more of a high resistant condition. Okay. So just giving you guys an example here. Imagine that these are our up close candles. All right. And every single low at this particular point is that low resistant liquidity run. All right. Now, low resistant liquidity run to what extent? All right, take this. One second, guys. All right, perfect. All right. So if we're to take that, all right, and All right. So if we were to take that and we were inside of price, okay, what we see is maybe we're shorting on an intraday basis. All right, but at some point you got to understand where you are in terms of the higher time frame institutional order flow. Am I on the buy side of the curve? Am I on the sell side of the curve? All right. And at this particular point, as we're trading down into that higher time frame OB, or that higher time frame point of institutional order flow, we understand that we should be preparing ourselves to frame out a potential smart money reversal. All right, and we'll talk about market maker models and things of that sort. All right, so what we're seeing here is that short-term low is being created. Right, and honestly, what's truly going on is, as mentioned earlier, this is just a hedge. Right, these guys are tacking on those buy positions. As we get down to that weekly OB, right, we begin to look for a shift in institutional order flow. All right, understanding that from a higher time frame perspective, this, right, is our low resistant, is the true low resistant liquidity run. We were just making it down to a measurement, if you will, of institutional order flow. All right, so now what is institutional order flow? We'll discuss more in depth in lecture 2 and 3. But institutional order flow is the measurement of buy side accumulation or sell side distribution. All right, it identifies which party is in control and where significant participants will continue to drive price. All right, so without needing to look at a footprint chart or a ticker chart, we're able to identify which side of the curve we are on. All right, and this is fractal, right? And by saying it's fractal is what I'm showing you here. Obviously, we were on the sell side of a curve from that intraday perspective, right? This doesn't, there's no time frame attached to this. This could be a 15-minute chart and a 1-minute chart. This could be a daily chart and a 1-hour chart. All right. But if we were looking here, we would say we're on the sell side of a curve, right? For this particular time frame or this perspective, right? But we have to understand the higher time frame, right? Framework. Because from the higher time frame, we're on the buy side of the curve. So that brings me to a point. When you're thinking about institutional order flow, you have to understand that on the buy side of the curve, right, down closed candles will support price. Okay, on the sell side of a curve, up closed candles will support price. Very, very important. Okay, if you look at any market at any time, if you look at any peak and reversal and you study both halves of that peak and reversal, you'll see that there is a consistency in down close supporting price on the buy side and a consistency of up close supporting price on the sell side. This is a fractal idea. All right, think about when price is trading up to that fair value gap, the movement up here, right, means that on a lower time frame, you're going to see those down close candles supporting price. If order flow changes, right, if we want to go short, we only want to go short when institutional order flow is in fact bearish, which means we should be seeing at some degree up close candle supporting price. Does not matter the time frame, right? But we'll go way more in depth in that. This is just me laying the foundation here. Okay. All right, now the market efficiency paradigm, right? This is basically the mental framework of how we understand price being delivered or administered to the market. All right. So you're to say, hey, Chris, how is price delivered, right? What is the language of price? I tell you that price trades buy stops to sell stops, right? It creates imbalance and then it rebalances. All right. Buy stops to sell stops. It creates imbalances and then it also rebalances. Okay. Now we can also translate that, or the way ICT translates it is with the price delivery cycle. All right. But we're going to kind of take it a step further and have a much better understanding of this. But the price delivery cycle is important because we need to understand these market phases. All right, so there's consolidation, expansion, retracement, and then also reversal. All right, key points that we need to understand that consolidations, this is important, consolidations are paired with fair market value and equilibrium. All right, expansions are paired with order blocks. Retracements are paired with inefficiency. Okay, and then reversals are paired with opposing liquidity. Okay, just remember that. Okay, we'll come back to it. Now, in a trending market, what we'll see is that price will trade stops to inefficiency, stops to inefficiency, stops to inefficiency, stops to inefficiency, right? At least until it makes it to some higher time frame array, right? Similar to up here, where we're seeing stops to imbalance, up until the point that we make it to a higher time frame array. Now, why is this important? Okay, it's because, as mentioned, the fair value gap, right, is literally the single most important thing in price. All right, it's literally almost always the very first thing that gives if we're getting ready to see a true change in state of delivery or a true change in institutional order flow. All right, so along the way, as we're trading down right here, right, we're seeing that price is trading back up to inefficiency, and it's honoring those inefficiencies, or we can say it's honoring premium arrays. All right. However, once we make it to a larger, much more significant, higher time frame discount array, all right, this is where that discount array has potential. All right, now, what does it look like in terms of that potential actually showing up to the market? Well, the very first thing is what we'll see is, since we've had this training market, we have that inefficiency here, right? Prices got just above that higher time frame array. We create that short-term low. Okay, there's our short-term low. And if this market wants to continue lower, right, we should see it go back into inefficiency, and from inefficiency back to stops. All right. So the very first sign that this higher time frame array is truly going to become the catalyst to price, very first sign is the way in which price treats that inefficiency. All right, and we're going to bring this more to life as we progress. All right, so once we see that imbalance, that guy is closed, and where that imbalance is created is significant, which we're going to get to. But once we see price trade and close above that inefficiency, all right, that point, this is where, we're engaged. Okay, once we learn Model X, we're going to learn you don't need the market structural shift. But as of right now, this is at this point, this is where we're engaged, and we're seeing some type of change in prices behavior. All right, those sell side imbalances that were superior early on, those guys aren't really holding up anymore. All right. So then what we'll see is eventually we'll see price trade through that particular area. Notice we talked about institutional order flow earlier, right? These up close candles these guys that are over here. Obviously, this would be an up close candle. That up close candle was taken out. It's not just about the structural shift, right? We're looking at order flow. That up close candle was taken out, and what we should see is that down close candles at some point start supporting price. All right, notice that looks just like a market maker buy program. All right, and as you guys just saw, in reversing markets, what we'll see is price will go stops to stops. So going back down here, if we're saying that, hey, a trending market is gonna trade stops to imbalance, well, the very moment that we clear out that imbalance, as we do right here, the very moment we clear out that imbalance, the only thing that's left on the table at that point are stops, right? Pointing to a potential opposing liquidity run. When I say opposing liquidity run, what I'm talking about is if price has been going this way and then we trade back through and we close at an efficiency, that will be the opposing liquidity run, right? Now, another part in terms of market efficiency paradigm, which I'm sure you guys have heard by now. If you're here, you're familiar with this. All right. We understand that high probability pricing sequence all right, this is always going to occur. Right? There's never not a time where this does not occur. Right? We're always at some phase of this within the market. Does not matter the time frame. All right. Now, what price will do is we'll engineer we'll neutralize, we'll distribute. Once we distribute, we'll rebalance, right? And after we rebalance, right, direction is honest, we'll see that we redistribute. All right? This is fractal. Whenever we're looking at a market, you're literally always at some phase of this. But if you when you begin to truly understand this cyclic nature of price, right, you're able to frame out ideas, frame decisions, and kind of build those anticipatory skills to say, hey, right, we've traded through that balanced price range. We should come back to fair market value. We should rebalance here. That particular area should hold. Once we get there, I'm looking for a change in state of delivery. All right, does not matter the time frame. Okay, so markets will trade fair value to discount, discount to premium, premium to fair value, right? The order of this is it doesn't have to go by this order. But I'm giving you guys a framework, right? Fair value to discount, discount to premium, premium to fair value. All right, what is important about this is this part in the middle. Okay? Because if we're going from fair value to discount, well, what occurs here is important, which is change in state of delivery. Okay? Change in state. Now going back to our image here, this is us seeing this market trade discount we're trading discount, right, to fair value, or actually we're trading premium to discount, discount to fair value, right? Once everything is fair, change in state, all right, back down to discount. All right, remember that change in state is the order block itself. All right, you guys will get an upload within the channel that spends a lot more time on the change in state. All right, I feel like we've spoken about it so much. I don't want to spend too much time on it here, but you guys will get an upload in the channel. All right. But anyways, the change in state is simply say price runs out a higher low. All right. Once we close through that particular candle, right, that is our change in state of delivery. It's very important that you allow price to actually close. If there's a wick, we won't consider that a true change in state of delivery. All right. But the main key point is that there has to be stops that are run. Stops resting in this particular scenario to the left of price, right? Once those stops are run, and we want to see if order flow is changing or if there's going to be a change in state, right? The moment price trades and closes back below that particular candle, right, that becomes our change in the state of delivery. Okay. What's also important about that when you're looking at that CSD is, let's imagine we have a candle here. And a candle here. And also a candle here. All right. The candle with the most significance, okay, is the candle that actually trades and closes with volume below the liquidity pool. And you're going to see why in a second. Okay, it's that candle that has the significance. All right, so we're looking for price to close through the low of that particular candle. Even though we say, hey, the OB is the last up close candle before the down move. All right, this is kind of taking it a step further. All right, now let's get into balanced price ranges. Okay, this is where it kind of begins to all come together. All right, so a balanced price range is a range in price where buy side and sell side delivery has been evenly distributed. All right, these areas will hold as strong areas of support or resistance and can also be used to frame future ideas about price. All right, so now what is significant? All right, so outside of these areas, holding as strong support or resistance, when price exits these areas, it means that there's no reason for price to seek liquidity on the opposing end of the range. All right, and we'll come back to that. So when we're speaking about balanced price range, all right, just remember, it's where, once again, buy side and sell side delivery is evenly distributed. Okay, so if you look at this image, obviously we know there's this scenario here where there's a fair value gap on this side of price and a fair value gap on this side of price, right? That's one form of a balanced price range, all right? But the more significant balanced price range is this scenario here, all right? Where we're looking at the delivery of price in this box, and basically consider it like this, right? For every buyer, there's a seller here. All right, for every up close candle, there's a down close candle. All right, there's no point in price in this particular box where there's only up close and there's no down close that is evenly distributed. All right, in that case, we reference this as a balanced price range. I'll just write PR. All right, so balanced or efficiently traded price range. All right. So if we're looking at this, I want you guys to place in the chat, are we balanced here? Right, excuse the grammar. But are we balanced in this particular case? Right, we have a fair value gap right here. But is this range of price balanced? Can we consider this delivery as balanced? I'll check the chat to see if you guys are actually answering this. Perfect. 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 You guys are great. I like it. Absolutely. Right. So even though we have this fair value gap, all right, this range is considered balanced, right? There's really no need to trade back down into that inefficiency, okay? Because everything, as we're speaking, everything is pretty much paired up here. All right, so we'd have our down close candles here, right? You can see that there's an even distribution of down close candles and up close candles. Okay, so a lot of times we ask, hey, how do I know it's not going to trade to that fair value gap? You never really know. There's no certainty within this market. There's only probability. right? So once we get this type of scenario, right, it is a high probability that price doesn't really need to trade back down to that particular inefficiency. All right, and then we begin to frame ideas at this point of fair value. All right, so that is our balanced price range. Now let's speak about fair market value. All right, so when the market builds equilibrium, right, or it's ranging, right, we're seeing like a consolidated market. All right, that market is creating equilibrium. All right, the midway point is what we regard as fair market value. All right, which is neither premium or discount. All right, so if I'm looking at this, the midway point of this particular range, all right, that is considered fair market value, right? It is not discount, it is not premium. Okay, what's important about that equilibrium portion of a balanced price range is that when order blocks are created at fair value or fair market value, I'm sorry, those order blocks tend to hold. All right, and if they're traded through, they tend to also hold as even stronger breakers. Okay, and we're going to look at a few examples or kind of make that come to life. All right, so just remember, we have balanced price ranges. Once you have a balanced price range, right, we've created that equilibrium. That point of fair market value is that midway point of that particular balanced price range. All right, and we're going to see why that's significant. We'll come back to that. Let's speak about fair value at this point. Okay, so now fair value, right? I know the two terms they can be used interchangeably. All right, but when we're speaking about fair value, right? Fair value is the term that we use when price trades with speed through an old high or low, leaving behind imbalances or liquidity voids. All right, in theory, price has not spent enough time at these areas to allow certain market participants to do business there for price. So therefore, price will seek to offer fair value back to these areas. Once offered, price moves back into its intended direction. All right. So just to give an example, we have that low, that high. All right. Price trades with speed through that particular low. All right. So we're seeing fair value gaps. We're seeing liquidity voids, whichever one. But the biggest point is that at this particular point in price, you can just see this as an up close candle. And we see this as a down close candle. Right? Right here, we're pretty much balanced. It's at this point, right, where we need to offer fair value back to the marketplace. Okay? So price will work its way back to that point. Right? And a lot of times we'll actually see precision where bodies of candles are literally aligned right at that point of fair value. We'll see price trade to that point. Let me slide this over a little bit. We'll come to that point. Once this market is fair, all right, remember, we're trading discount, fair value, right? Or premium to discount, fair value back to discount. You can also combine this with the understanding of stops back up to inefficiency, all right? And then from inefficiency back to stops. However, once we are fair, this is where we should see that change in the state of delivery, all right? So remember this. The idea or the concept is that order blocks form in areas of fair value. Why does that happen? Because if this market is only concerned with running out stops and then making sure that certain areas or that price is offered efficient, right? Once we're efficient, right, and we're balanced here, okay, now we need to trade to new areas of fair value or new areas of discount or liquidity, right? Which means in order to do that, there has to be a change in state of delivery, which in turn is the order block. Okay, then we're going to learn about the delivery that actually creates the order block. All right, just to give you guys a few examples of fair value. So we can see there's a high, there's a low, and we're trading with speed through that particular area. All right, key point. Most of the times, when we have that point of fair value, or we have speed trading through that high or low, if you can find the exact candle that actually trades and closes through the high or the low, that candle will host the most significance. All right, you'll find that even if you have a range where there's multiple fair value gaps, price is going to want to seek the actual candle that's responsible for the displacement and fair value gap above that higher low, right? As you see in this particular image here. All right, here's another example right here. Okay, and let me explain this. So if you guys at this point you're seeing this down close candle, right? But what we have to understand is that the delivery, right? What creates a wick is the fact that we've had upside delivery here and then an even downside delivery here. All right. So once we go with speed through that point, this is where we have, you can see this as one whole down close candle, one whole up close candle. Up until that point, we're efficient, we're balanced. But the moment price goes through here, right, now we need to offer fair value back to the marketplace. All right, which is why we come right down to this point. If this is a 60-minute chart, I think this is a 1 hour chart. So that means that if you were to scale down to maybe a 15, 5, or 30-minute chart, there may actually be a few different candles in here. This may look like a liquidity void. All right, but at this point, you guys should understand, just based on what we've spoken about, all this stuff is balanced, right? Everything is evenly distributed. Okay, but there may be one candle that rests right here that actually trades and closes above that high. Okay, looking at another example. Okay, and then also notice, right, the order block forms because once we're considered fair, right, we can then go back to stops. So this is nothing but price trading from stops to inefficiency, or change in state of delivery here, inefficiency back to buy side liquidity pool. All right, another example. Speed through that particular low. This is the candle that trades and closes below that low. All right, and you can see we had downside delivery here, upside delivery starting at that particular point. Right, everything is balanced. Right, that is all balanced. Once we trade through, there's a little bit of imbalance here. We trade up, we offer fair value back to the marketplace, which is why you see this particular area holds twice, right? It turns out to be a very strong area of resistance for price, right? And to make this scenario a lot better, right, when we're talking about confluences, right, with our style of trading, we even have balanced price range in terms of seeing that double fair value gap scenario. All right, moving to the next example. Okay, this is what I mean when I say a lot of times you'll see mere precision. All right, what time frame is this? Okay, this is a 5-minute time frame. Okay, I'm very sure that even on a 1-minute chart, there may be one candle that rests here that actually trades and closes below that low, and it has a fair value gap. All right, but you can literally see the precision with the bodies as we're coming back to fair value, right? Once we come back to fair value, order block forms, right? This is our change in state. We're offering buy side to the market here. We offer sell side to the market here. All right, on a fractal scale, this is a dealing range. We're going to see why this is a dealing range. All right. Right. This is that same example we saw earlier when we were speaking about high and low resistant liquidity runs. All right. So now understanding why price was wanting to trade back to this point. So if you were looking at that image and you saw that there was a huge fair value gap, right, on that higher time frame, and you're wondering, well, shit, why didn't price just stop at the fair value gap? All right. It's because now that we understand fair value, right, we understand what a balanced price range looks like, we can give ourselves a much better understanding of why price would want to trade back down to these areas. All right, and this is not hindsight stuff. These areas are called, right, as we're looking at price and we're saying, hey, this is a highly probable point for price to run to. Okay, but you can see as of this point, right, we need to offer fair value back to the marketplace. We come down here, you can literally see the bodies of these candles only want to get to that point. Short-term low forms, right? And then we're off the opposite way. Okay, by now you guys get the point, right? Same idea, fair value, so on and so forth. We're going to come back to this image because there's something really good with that particular image. Same idea here. All right, this is a trade from, I want to say 2 weeks ago. We took shorts from this particular area, all right? And it's framed out, understanding the New York session. This is just OTE, but what made this even better was the fact that we traded with speed through that low. You can see that fair value gap as we come down to the 15-minute chart, right? And look exactly where price runs to, okay? So we come here, we run into the fair value gap, right? Early part of New York session, we get that New York Judah swing, all right? And that Judah swing for New York session is only concerned with trading to fair value, right? Once we trade to fair value, you can look inside of here, and what you'll see is a fractal dealing range, right? So look at that first candle, right? If you don't understand what that means, that 1, 2, 3, 4 means, we're getting ready to get to it. All right, but just understand, as mentioned earlier, the array, that fair value gap is only potential. All right, once it gets to that fair value gap, we then want to look at the response in price, right? That response is most times that high probability pricing sequence, which is exactly what we see here. All right. What I like even better about this is when you think about when we're saying, hey, engineer, neutralize, distribute, right? And this is that rebalancing phase. All right. When I say, hey, you can look, if you understand the high probability pricing sequence, when you understand that what phase of that cycle you're in the market, doesn't matter the time frame. When you understand that, you can frame trading ideas a whole lot better, right? With a lot more proficiency. So in this case, I understand, hey, we're getting ready to rebalance. We engineered those short-term highs. We ran those guys out. We traded with speed through that range. We're going to come back and speak about that range. But we traded with speed through that range. We have fair value, right? I'm in the New York session. All right, I want to take an OTE type of trade. All right, we come back up here to rebalance, and now I'm expecting that next phase of redistribution. But just because I understand the high probability pricing sequence, it doesn't guarantee that I'm going to get the redistribution. What I have to do is go down to my lower time frame, and I have to understand that institutional order flow, right? I can see it here without even, without going to a lower time frame. I can see that these down close candles these wicks are just down closed candles. These guys are supporting price right now. Right? Up until the point that we make it to fair value. Once we make it to fair value, guess what forms at areas of fair value? Order blocks. All right? Let's go to the next image. Okay, same idea here. I want to say this is the same. No, this is January 2nd. No, this is actually February 1st. All right, cool. Doesn't matter. Either way, same idea, right? Here's a low. There's a low. We trade with speed through that low, right? Hey, why does the price come to that fair value gap? Well, honestly, if I look here, right, everything here is balanced. We don't need to come to that fair value gap. So what about this fair value gap? That's the one that we'll see that price runs to. Look at the bodies of candles right here. All right, the wicks are subjective, right? Because wicks they can deviate depending on what feed price is coming from. These bodies are true price, right? Look at the precision, bodies here, bodies here. All right, so now we understand fair value, right? Cool, but now how do we frame the opposite side of that coin? Okay, so typically you'll notice that even if there are multiple fair value gaps, guys, please excuse my typing errors. I was pumped for this session. But even if there are multiple fair value gaps, prices look back function will seek out the fair value gap that traded through the actual higher low. All right, order pairing will take place here. Okay, however, if we see that particular candle does not hold up and we close through the fair value gap, there's a high probability that price will seek opposing stops. Okay, so the imbalance on the left side of price is where the magic is. All right, most times we focus on the imbalance on the right side of price, right? We're trying to take that limit order entry. But if you start focusing a little more on what's happening on the left side of price, right, that is where the magic is. I promise you. Okay, so just to show a few examples, this is that same example of Euro USD. All right, where we saw price run back here to that point of fair value. You can also see this is pretty much the same thing, right? This is fair value. Oh, this is a little more to scale. All right, so same thing, right? We push up right to that point of fair value. You can see that price, there's a little static around that area. But remembering that the candle, right, that order pairing candle, or the candle that actually trades and closes below that particular low and leaves behind an imbalance, that candle is important. All right. Most times, not all the time, remember, there is no certainty. I'm not here to teach you certainty. I'm here to teach you probability. Okay. Most times, if that candle's fair value gap is not respected, all right, this is where we start to frame a potential opposing liquidity run. All right, so we close through that particular candle. All right, notice also, if I take that candle when I scan across price, once we close through that fair value gap, look at where the sensitivity comes in terms of price trading back down and basically using that candle as support. All right, I promise you that those are not random occurrences in price. Okay. You can also see it on a fractal scale here, but I'm not going to go into it. Okay, another example right here. So when I'm saying, hey, in trending markets, price is trading stops to inefficiency. In reversing markets, we're going to go stops to stops. Well, you might say, well, what if there's multiple fair value gaps, right? What if there is, right, we go stops and efficiency, and then we go stops, right? Well, there could be a fair value gap here, fair value gap here, fair value gap here, fair value gap here, right? So, well, hey, Chris, you're saying that if we close through that, let's imagine there's one more fair value gap. So, Chris, you're saying that closing through this fair value gap makes it high probability that we're probably going to go to stops. Well, what about the rest of the fair value gaps? Well, let's take it a step further at what we're doing now by saying, hey, this fair value gap where that point of fair value needs to be offered to the marketplace. If we trade and close above that fair value gap, that is where we start to see, all right, cool. shit, we're probably going to run to the opposite side of this range. Okay. So taking this candle, scanning across price. All right. We trade, we close above that candle's fair value gap. Okay. And we see that price is going stops to stops. All right. Inefficiency has came off the table. Price is showing us that this imbalance is we're not concerned with that. We took out sell side liquidity. Right. There may be a higher time frame array resting right here. And we're seeing that swing low fractal form. All right. Where we're seeing stops and balance, stops, right, and balance, so on and so forth. Okay. All right, here's another example. There's a high. We trade with speed through that particular high. That candle leaves behind a fair value gap. We go above price. Once we trade and we close here, probability for an opposing liquidity run, right, is increased. Okay, and then obviously you guys can see, right, that there's an opposing liquidity run. All right, right in here, this is pretty much a balanced price range, that little point in price. We'll come back to that later on as well. Literally the same image. Okay, cool. You guys get the point there. So now let's go back to balanced price ranges. Okay. So what's significant about this whole balanced price range thing is the way in which price actually leaves the range. Okay. So we can either leave with speed, right, creating fair value, as you guys saw, right? We have fair value, creating the imbalances, inefficiencies, or indecision. Okay, and we have to be keen to recognizing, hey, yes, we exited that range, but there were rejection blocks. I'm not so interested, and I'm not interested in whatever predisposed idea that I had. Right? Hey, we exited with speed. All right, well, shit, we might continue higher, but let me watch price and see. Okay, so when price exits an efficiently traded or balanced price range with speed, we assume that it's chosen its fate. In other words, the direction is set, and at most, we only expect it to retrace back to fair market value, right? Remember, where is fair market value? Fair market value is right around here somewhere, all right? So this market is efficient. If we leave this range, there's no reason to trade back to stops at the opposite side of this range, all right? When I say there's no reason, there's no reason for the regard of going back higher. All right. This is efficient. Okay. Just hold that idea in mind. Okay. When price exits the range, we begin to look at the order pairing candle, as we saw a second ago, which is the candle that creates imbalance at the exiting of the range. And we also want to watch equilibrium. That's that fair market value. If price negates fair market value in the order pairing candle, the odds increase for an opposing stop run. All right. When we trade with speed through the opposite end of the range, probs increase even more, that the balanced price range will hold. So when you think about engineering, which is technically what we're doing here, all right, neutralizing, rebalance, redeliver. All right. So watch this. Here's the balanced price range. And let's say that price even exits this range with speed. When I say speed, what I mean is we're exiting with volume. All right. So at this point, as the trader, what we're saying is, oh shit, we left that range with speed. All right, that range is balanced. There's no reason for price to come back below fair market value. Right. Most times we'll see we don't want to see price closing below fair market value. If so, that's an indication that we might just be getting an opposing stop run, right? That first up move might have just been some type of manipulation. Okay, so we lead with speed. Now we're saying, all right, market has chosen its fate. That range is balanced. What we expect is that at most, if price is still bullish, or it's truly bullish, we only want to see rejection blocks. If we do trade this deep, we only want to see rejection blocks back within this particular area, right? And if we start seeing rejection blocks, then we're like, okay, cool. We may actually be truly trading higher. All right. But where this gets really good and this understanding gets really good, all right, if you guys start thinking about the original consolidation, right? Or why we say, hey, I want to see that last phase of reaccumulation taken out. That's what's going to let me know that we're on the sell side of the curve, that this market maker model has transitioned over. All right. It's taking this understanding, this logic of a balanced price range. So once we trade back through here at this point, we close through fair market value. All right, that's our first sign. And then we trade and we close with speed back through the opposite end of this range. All right. At this particular point, we should understand as a trader, well, if all of this is efficient, if we left the top side of that range and then we trade back through that range with speed, the probability of all of this holding as resistance at this point, that probability is very high at this particular point. All right. And then at this point, we're framing out trade ideas. All right. So when I'm over here and I'm saying engineer, neutralize. Okay. So we've engineered, we neutralized, we left the top end of the range. All right. Obviously we distribute. Okay. And then now we're going to rebalance, right? Rebalance in the range. But at this point, we understand that we should only come at most to fair market value. This is where that fair market value portion will really hold, right? Remember, I told you guys that order blocks created at equilibrium or a fair market value of a consolidated range, those guys tend to hold. Well, if that area is traded through, it'll hold even stronger as a breaker. All right. Hence why we say the high probability pricing sequence is very high in probability, right? It's not due to the pattern, it's due to the logic. We're efficient, we leave an efficient range, and then we trade back through the efficient range. Well, shit, chances of us continuing that way are very high, right? Everything here is balanced from here to the top side down to the bottom side. We're anticipating that rebalancing phase. All right, we look for lower time frame fractals, and then here. All right, so when you're thinking about market structure, that's your short-term high, intermediate term high. You're looking at the market, you're framing this idea. Does not matter what time frame this is. This could be a weekly time frame, guys. This could be a weekly time frame, but by you understanding that, hey, we were balanced here for a few weeks, we left that range, traded higher, and then traded with speed through that range. I'm going to frame all types of intraday opportunities up here. As we also saw on the euro, right? This could be a 15-minute chart where you're framing, lower time frame opportunities on a 1-minute chart. All right. But it pays to understand this stuff and know where we are within a particular cycle within the market. All right. So just to show examples of this. Right. So right here, we're seeing buy side and sell side delivery, right? Pretty much evenly distributed. We leave the range this way, right? At most, we'd expect, either fair value or fair market value, right? We'd expect that this OB that's created at the equilibrium portion, that guy should hold, right? The moment we trade through that area, right, we start closing, right, volume, right? As you can see right here, we trade back to fair market value and we exit that range, right? We even come back at a later point in time, right? We engineer, we neutralize, we distribute. From a fractal standpoint, we're rebalancing, and then price is getting away. Right? I would understand if I were looking at this as a trader, I'd say engineer, neutralize, distribute. Now we're rebalancing, but I'm also combining my understanding. I'm combining my understanding of the fact that this range was balanced. We traded through that range both times. there's a very high chance that we hold to send price that way. All right, we're going to basically redistribute. Okay. I'm also understanding a second ago we looked at, we were talking about institutional order flow, right? Look at these down close candles that are created at that point. So now you're all these concepts, you're blending all this stuff together to have a much more efficient understanding or efficient way of engaging with price. Okay. Let's go here. This is this was posted on Instagram a day or two ago. One of our guys took this particular trade. This was well mapped out. So what happened is we traded through. We took out this previous day's low. Right. Obviously, it's been a shit market with Euro USD, Pound USD. But he's seeing that price is taking out that previous day's low. Right here, we begin to engineer. Right, we're engineering, crouching above a discount array, balanced price range. We leave that range with speed. All right. Well, shit, if we're still bearish, we should go stops and balance, stops and balance, stops. Okay. Let's frame out the candle that trades through the low and creates the imbalance. That guy's right here. Where does news bring price? Boom. This fucking candle. Right? That candle has significance. Okay. So he's seeing engineer, neutralize, we distribute, right? But he's not seeing a pattern. What he's seeing in this case is he's seeing the logic behind the fact that this range is efficient. Once we trade back through that range with speed, there's a very high likelihood that at most, we only trade back to fair market value, right? And we don't want to see body closures. Okay. Remember also what I said about order blocks formed at equilibrium, right? Those guys should hold. You can kind of see here, right? That area, same area holds, but obviously we had I think this is ISM manufacturing or high impact news release. So then we get a little more, broker manipulation here. Okay. Engineer, neutralize, distribute, rebalance, redistribute. Okay. Now, if I'm a trader and I'm looking at this and I'm understanding that this is where we are rebalancing and then we should redistribute, I can also frame out another trade idea if I'm looking at this particular portion in price, right? So we're basically efficient here. All right, we trade through, we close on a fractal scale. This is the same thing. Engineer, right? You see the short-term low. Neutralize, we distribute, all right? We're rebalancing right here, and then we're off to the races. Okay, you could also see it like this as well. Like everything right here is balanced. We leave this way. How do we leave this little balance range? Rejection block, indecision. How do we leave the range on this side? Volume, body closures. Well, shit. This is just price rebalancing from that side, and we're going the opposite way. Another example. We're looking at price. So we're looking at price. Everything is efficient, right? We may even say, oh man, it needs to run out the equal highs. Not really. All right, we're efficient. We trade this way. Well, if we're bullish, we should come to fair market value and continue to trade that way. Well, what happens is we get body closures through that point. All right, we get body closures through that point. And then, speed back through here. At a later point in time, we come right back to fair market value. And look at what happens at that fair market value. Engineer, neutralize, distribute, and rebalance, and then redistribute. High probability pricing sequence. Right? Here's an example of a balanced price range, right? Where we're not really manipulating the opposite side. we're just trading with speed above that level. And this is where, that OB that's traded at equilibrium, that guy actually holds. All right. What I really wanted to show you guys here is just in noticing the rejection block created at fair market value. All right, this stuff is very, very consistent. Same idea here. This is a different image. Fair market value. We leave the range. Notice the rejection blocks that are created. I can also see a fractal dealing range, right? Engineering, we're neutralizing here, we distribute, we come back, we rebalance at this point, and then price gets away. What's created at fair market value? Order block. Right? Another example here. We leave top side. We come here. You can see order flow is built, right? And then bodies of candles right at fair market value. And if you guys are wondering where I'm shading that box, I'm just looking at where price struggled to leave from the more consistent. Right? We got up here, spent some time here, we spent some time here, we spent some time here. So that's where I'm framing it out at. Right? Same idea. And looking at this one, I could have just, I could have chose that. Right? And if I did choose it, then you see, right at fair market value. Right? We're leaving that range here. And then we leave here, the speed. We come back. That same thing, engineer, neutralize, distribute, rebalance, redistribute. Right? You saw that example. This is a higher time frame example here, just to show you guys how how logical this is. This was actually a week of this was FOMC. All right, this move here is occurring at 2 p.m. I forget exactly what day this was, but we were looking at this. We were seeing it, earlier in the week. Price is here, and we start trading higher. But we're looking at this range of price, and you don't know exactly what it's going to do, but you're prepared to frame ideas off of this particular point, right? If we trade through here with speed, then guess what? We're just going to use it as now we're going to be buying from that way, all right? But we trade up here, we take out that previous day's high, bodies of candles right at fair market value, right? There's a lower time frame delivery here. Obviously, news is going to send price away much faster, but there's a fair value gap created. We're not trading that late in the day, but just giving you guys ideas of what occurred here and why it occurred. Even in a situation where we have a high impact news release. All right, so bringing all of this together, all right? So here's where we bring all pieces together and understand why a dealing range's delivery, right, a high probability pricing sequence is so significant. Okay, it is a combination of blending institutional order flow, balanced price range theory, fair market value, and fair value. Okay, now what is an interbank dealing range? The dealing range is not just a pattern. It should be understood first as a high probability pricing sequence, right? It's to be understood as delivery. Okay, by understanding where price is in a particular market cycle, any time frame, the trader is able to frame out future direction and trade ideas with more objectivity. The beauty is that there will be smaller dealing ranges at each end of larger dealing ranges, as this delivery creates your order block or change in state of delivery. All right. So we have a type 1 dealing range. And type 1 just means that all pieces played out, right? We engineered, we neutralized, we distributed, we rebalanced, right? And then we ran the bottom of the range. Okay, so you guys, when we're first learning this, you'll always see us say 1, 2, 3. One key rule is that 4 should always take out 2. Okay? Just looking at it from a fractal sense, thing about just candles, the reason I say that high probability pricing sequence creates an order block. You were looking at a chart, you frame that out as an order block. It's the same delivery, right? Type 2 dealing range here. Same idea, same concept, same idea, same logic. Okay. This is just where phase 1 plays out, phase 2 plays out, phase 3 plays out. However, 4 never takes out 2, and the draw becomes 1. Okay, but what's even more significant about this is, right, everything's balanced. We leave bottom side rejection block, the top side volume and speed, right? Fair market value should hold up. All right, the blending of concepts. So let's look inside at an example. Okay. So imagine we're looking at the market and we saw that price from the top side up here. On the top side, we engineered, we neutralized, we distributed, right? Everything here is balanced. We trade through that area with speed. This becomes that point of fair value. All right, so we may have, draw here. We may have candle here, candle here, candle here. All right. At this point, you guys understand like which candle has the most significance. Right? It's that guy that traded and closed through that low with speed. So as players in the market, engineer, neutralize, distribute, we're looking at price and we're saying, all right, I got fair value. I had this balanced price range above. Everything there is efficient, right? Price ran above it, we ran back below. There's a very high chance that if prices traded back up to that area, there's a very high chance that we see a reversal from this particular area. Okay, I'm also understanding with engineering neutralize. Now it's time for price to rebalance. Okay, so once we see price trade up to this area of fair value, all right, and let me go back and explain one thing. Okay, so when it comes to a dealing range, this is the technicality of a dealing range. All right, or the objective part. For simplicity, the dealing range is simply a sweep of both buy side and sell side liquidity. All right, don't make it more complicated than that. If I have a range, right, and let me also mention this: it's not subject to just a consolidated range. Right? So what I mean by this is it doesn't always have to be this tight range where we run out the buy stops and sell stops. There could be a scenario where you might have something like this. And then price runs here and then runs here. Did we run buy stops and sell stops? Yes. Is that a dealing range? Yes. We keep it that simple. All right. So dealing range is sweep of both buy side liquidity and sell side liquidity. Let me move this out of the way. All right. All right. So we trade back higher, right? We understand as traders, this is the part where market's going to trade up here. We're looking for it to rebalance, and then we want to capitalize on that phase of redistribution. All right, and that's from a higher time frame standpoint. All right, market turns around, it trades here, gives us a little bit of noise around that fair market value. All right, and boom, we've traded through the opposite end of that range. Okay, at this moment, this is a dealing range. All right. Yes, up here we also had a dealing range, right? You'll see dealing ranges inside of dealing ranges. All right, we're going to frame this out as the dealing range that we're focusing on right now. Okay, so what you see is 1, right? And then obviously this move here becomes 2. All right. So earlier we talked about the fact that this market trades buy side liquidity, the sell side liquidity. It creates imbalance, and it seeks to rebalance that imbalance. All right, so we traded buy stops down to sell stops. Obviously, we create some form of imbalance right here. And now the market is going to want to seek to rebalance that inefficiency. All right, so that's 1. This is our 2. All right, engineer, neutralize, distribute. We're framing out that this market is getting ready to rebalance this range. This is 3. Right? Once we rebalance, all right, we come back up, we've traded to fair market value, right? And we don't always know, there is no way to know exactly where price is going to go to. All right, we have to get that out of our mind. We have to understand that this market, all right, there's what's called random distribution, meaning that outcomes are randomly distributed. You never know for certain where price is going to go to. All you can do is take what you understand and use the logic, right, to build the necessary anticipatory skills around that logic to engage with price. So we get to that point, we rebalance that range, all right? Just to also go back to earlier, we go external range liquidity, external range liquidity. Now we're trading internal. Okay, and that when we're saying external, it's all external, internal is all relative. We move from here. This is where 4 should always take out 2. Boom. All right. So we went stops and balance, stops and balance. Okay. What happens is we trade back up. Right. And at this point, guys, what do we now have? Right, because obviously if you're looking at price, you should see that these would obviously be buy stops here, right? And then these are also sell stops. So just in the chat, like, what do we now have? You guys have been active. Perfect. Perfect. Right? We now have a new dealing range. Gotcha. Right? So at this point, we now have a new dealing range. And this is where this old 3 becomes a new 1. This old 4, remember we say that 4 should always take out 2, right? This is type 1 dealing range. That old 4 becomes a new 2, all right? So we're looking for price to trade back inside of the range, maybe to some type of inefficiency, maybe to fair value. We never know. Right, this is an imbalance. We trade back up inside of the range. This becomes 3. Right? And if If we're still bearish, all right, we traded to that inefficiency. If we're still bearish, we should see 4 take out 2. We're coming here. All right, and then boom, something happens. This is a sell side liquidity pool. That's the sell side liquidity pool. We see price trade higher, and it takes out 3. All right, let me just give a little more to this. All right, you guys might see where I'm going with this. All right, so now at this point, we're seeing what we frame as a type 2 dealing range, technically a failure swing. So we've taken this short, all right? But I'm going to argue that that short at this particular point, right, is low in probability. Why is that? Because we needed to zoom out and understand that this is a higher time frame PD array, right? So now zoom out. If you guys remember the image from earlier when we were speaking about the high and low resistance signatures and understanding to what extent I can continue to short, right? It's to that extent of that measurement of institutional order flow and understanding where I am, you know, in the market, and especially from a higher time frame perspective. So if we look here, all right, this delivery has gone up, it's going down, and then it's going to speed through that level. Boom. All right. So price was only trading back down to that higher time frame point of fair value. What forms in areas of fair value? Order blocks, right? Or changes in the state of delivery. So here's the key rule when it comes to dealing ranges, all right? If 4 fails to take out 2, as we do here, and instead runs and it takes out 3, then the draw equals 1. All right. Why is that the case beyond me just saying, hey, the draw is 1, right? The reason that we say that is because at this point, what I'm framing right here, at this point, what I'm framing right here is there's going to be some degree, or there should be some degree most of the times, of this being an efficiently traded price range. All right. So if we take out 3, and obviously we want to see it do so with, with some type of speed. All right. If that occurs, right, then there's a very high chance that this little range of price here is balanced, and we should draw on 1. All right. But if you look here as well, we took out sell stops. Then we also just took out buy stops. So I know you guys know it, so I'm not going to ask in the chat, right? But at this point, we now have a bullish dealing range, right? And we have a bullish dealing range as a response to a higher time frame PD array in alignment with higher time frame institutional order flow. All right. So this becomes 1, 2. This range is efficient. All right. We left that range. We're going to see that as potential 3. Right. And then we're drawing on 1. Boom. Okay. Now at this point, at this particular point, we're sort of seeing that concept of balanced price range come a lot more alive. Okay, and we're understanding, all right, down here we had a failure swing, right? Swing low fractal, short term, intermediate, short term. You can even see it here, short term, because this becomes fractal. This would be short term, intermediate, short term. We'll speak about when you start to frame it as long term and intermediate and long and short term. But for now, I'm just going to say short term and intermediate. All right. But we trade through one. At this point, guys, what we also have is another dealing range from a higher time frame perspective, or a more zoomed out approach, rather. All right. So we can see here, we've taken out sell stops, we've taken out buy stops. If I were looking at this price action right here, I would say that, I'd say that this is, let's say that this is pretty much balanced. All right. So we run through that area, understanding that we've responded to the higher time frame array, right? At this particular point in time, I'm looking at this. We should be looking at this and we should be seeing that, all right, this delivery right here, down close candle, down close candle, down close candle, right? Down close candles are support and price, which is also in alignment, once again, with our higher time frame. All right. This is a market maker sell buy program. Right. So we just basically saw how all this stuff develops. Okay. And now we're going to see that this little area, remember this balanced price range here, later from earlier, right? What we'll see is that when we talk about reclaimed order blocks, right? Or I like to say reclaimed interest, right? Because there was buying interest from this area. Remember, when the market makers are framing out a hedge program, all right, all of the buying doesn't happen at the most discounted point in price. They're hedging into this market. All right. So once enough business is done, these guys are now transitioning to the buy side of the curve, right? Those areas where there was once buying interest or they created equilibrium at that area, all right? Those areas become reclaimed, but now we're understanding the logic behind that. All right, so right in here, this is also a dealing. Don't forget that this is a dealing range. Right in here, we'll see, potentially that reclaim, and then we'll see that price may actually trade higher. Okay, so what I like to do with this image is let's erase this part. Yeah, actually, let's not erase it. Let's just move it out of the way. We'll see that over there. All right, so just look at the delivery right here. Okay, and just so that I can just ensure that you guys are understanding the delivery, let's look at this very first part. We're going to frame that up as a candle, right? So just imagine that delivery, if we were to go to a higher time frame, would be literally one candle that looks just like this. Right? This next part where we're taking out the high of that little range, right? We're taking out those short-term highs. That would look like this. Okay. Now the next part of this is literally a down close candle, right? That runs through that particular low. We run through that low. Right. And then this next part can also be a down close candle. Doesn't matter, right? What matters is the delivery. Okay. So that candle could open here, rebalance, and then off to the races. All right. So when we're saying that, hey, this one fractal, let me correct this. This one fractal, right? The market literally points back to this one fractal, right? And you'll see that high probability pricing sequence at literally every edge of the market, at least 95% of every edge of the market. All right. And then understanding that this high probability sequence is at every edge of the market, right? And it actually is what creates the order block. You're going to see it here. You're going to see it up here, right? You're going to see it down here from an inverse perspective. You're going to see that up here. And you're also going to see it down here, right? Anywhere where there's a turning point within the market, all right? Which is why I say there's no need to trade the array alone, because you have the leverage or the ability to look at the response and price once price gets to that particular area. All right. So you're adding a little more conviction behind your trade ideas, because you're now understanding, hey, even on a more fractal scale, right, I'm still gonna get that delivery, right? It may not be the most textbook in terms of how we're drawing it up here, but if you understand, this is why I say don't just look for patterns, look for the delivery, look for the logic within the delivery. All right. And that's where you start to kind of move to new heights. Okay, so we'll look at a few examples of, I guess, just the fractal nature of this, right? When I say, hey, this is all fractal, you can see it without needing to zoom in. And we'll go to the chart, and then we'll open up the floor for questions. Okay. So here's an example of this is NASDAQ. We're running out that high. I want to say that's the previous day's high. It's the 15-minute chart. Yeah, it's the previous day's high from the 19th. All right, so we're running out that previous day's high. And balanced price range, we saw this example. Price trades through that range and then back up. All right, if you look right here, you can literally see the delivery without needing to go to a lower time frame. All right, taking that very first candle, understanding where we are in the market, right? We're hovering below that high. All right. This is just engineering short-term highs, right? Creating equilibrium. We're hovering below that high. We run that guy out. We trade back down, closing through the range here. All right. And then back up, rebalancing, and then price gets away. All right. All right. This is just an example from a student's homework, but same ideas. Balanced price range, ran out previous day's high, right? Trading through here. Now we're coming back up to rebalance. 1, 2, 3, right? 4 takes out 2, and also we get a new dealing range. All right, this example. I'm showing this example because this is when I'm making a point that it doesn't have to be. You don't have to have a super consolidated range. It's just understanding that there is a high created and a low created, and we manipulated, both external portions of the initial range. Now we have a dealing range. You can see that that point of fair value, right? We're coming right back to that particular candle. Bodies, precision with the bodies are here. And then prices off to the races. That is Euro GBP. Okay, one more example, or 2 more examples. Same idea, right? Everything right here is balanced. We take the midway point. We exit with speed through here. Trade back through, opposite end of the range. And there we go. Right, and prices is obviously out to the races. Right, you can look inside here and you can see on a fractal scale there's a dealing range, which creates an order block. Right, then taking it down to this this image here. Same idea. This is from January 24th, pound USD. This should be, this is the 5 minute. Okay, this is the 5 minute chart. I have it marked wrong. All right, this is a 5 minute chart. Everything is efficiently traded here. We go this way. All right, rejection blocks form, and then we leave opposite end of the range. The speed, fair market value is here. All right, but what I actually want to show is that this is 1, this is 2, that's 3, right? And then we're getting 4. But when I go to a lower time frame, what you guys will see is the same, because we're understanding that we got 1, 2, 3, right? Now it's time, this is that rebalancing phase where it's time for price to go back the opposite way. You could be on a lower time frame framing out the very same fractal. Right? So you can see a little bit of a consolidation here. That's 1. That's 2. Look at the wick here. That's 3. And then price is getting away. All right, let's go over here. Now this is actually the 3 minute chart, just so that I can show you. This is that daily range 1, 2. Right? Market understands this was balance. We traded here, rejection blocks form. We traded here with speed. We spent a bit of time up here engineering liquidity, running out that low, and then we trade back through that high with speed. All right, this is that little point, fair value. All right, do we need to trade to that fair value gap? No. Why? Because everything here is already efficiently traded. Boom. All right, and then we're off to the races. All right, so it's very, very fractal. Does not matter the asset. Doesn't matter if you're trading stocks, crypto, indices, commodities, right? This understanding applies across all financial markets, right? If there are candlesticks within that market, this understanding will apply to that particular market. All right. I know we've been on here for a long time, right? The first call is always this long because I like to make sure that you guys have as many opportunities to get as many examples as you deserve. So let's go to, we'll look at January 23rd, Euro USD. February. And then we'll open the floor for questions. Okay, yeah. So we saw this example right here, right? This is a day where I was telling you guys we took shorts on this day. All right, these were equal lows. We're looking at the market. We're coming to the market. We saw that everything here was balanced. We ran above that high. We took out a previous day's high. We came back lower. Remember, that's that point of fair value in that example that we saw. And we're coming right here, and we're ready to frame out a trade idea in the New York session. Okay, so on a lower time frame, we go down inside of this, we should see that high probability pricing sequence. Right, we already have the other framework in terms of fair value and things of that sort, seeing that candle traded through the low, right? But without going to a lower time frame, I can literally see that high probability pricing sequence right here, right? We trade above that first candle's range, through that first candle's range, back up to rebalance, and back lower. What you have to understand about this is that this is the buy side of a curve on a lower time frame, taking price up into fair value. We get up to fair value. Now what you're seeing is, so you saw down close candles over here supporting price. Now you start to see up close supporting price. So let's go down to a lower time frame and let's see what that actually looks like. Even go to a 1 minute. Right? So in a 1 minute time frame, the same concept applies. Whereas this is pretty much a balanced price range. All right. You saw the down close candles, these guys are supporting price. We run here, right? Rejection block forms. We're back through this side. Engineer, neutralize, distribute, rebalance, and then redistribute. Right. So I'll fly through these. If you guys, as I'm going through these, like if you guys have questions, just hold those questions, and we'll come back to whatever you guys want to take a look at. So let's go to January 7th on go to January 7th on Euro GBP. All right, so this is just an example of, same idea in terms of just balanced price range. All right, we can take the bodies here. All right, it doesn't really matter. But we can see that price is trading back up to that point of fair value. All right, so look at the bodies. Look at the precision right here. All right, we trade back up to fair value. All right, and then we say, hey, order blocks form in areas of fair value. All right, and then prices off to the races. I haven't looked on a lower time frame here to see if we can actually see some type of lower time frame delivery. Okay, cool. So we get up here, right? We're understanding that hey, price is just only trading to fair value. We had a balanced price range over here. We're in a bearish market. We get up here, not super clear at this particular point in the London session. All right, this is only if we were like if we only had the knowledge of the knowledge that we have now in terms of balanced price range, dealing range, so on and so forth. But once we get to the New York session, we can see this little range of price here is balanced. We're running above this liquidity pool, right? And then we trade right back through that range. We actually close through that range, which I like, right? Engineer, neutralize, distribute, right? Rebalance, and then redistribute. There's also a small fractal, right? This is not the most textbook, but it's the same idea. Engineer, neutralize, we distribute, right? Rebalance, and then price gets away. Okay, if you think about what I mentioned in terms of up close candles and down close candles supporting price, we can see that transitions over, right? So it's basically like market maker models, right? Buy side of the curve, sell side of the curve. But we've already framed why we should be looking at this. On December 28th. All right, so December 28th, pound USD on a 15-minute chart. All right, just showing the whole balanced price range theory, if you will. Then we can go down to a lower time frame chart. So as you're looking at this and you're seeing that price is traded above the Asia high, all right, you may be trading the London session and you may be looking for that Judas swing. All right, you may want to confirm that Judas swing. All right. Well, you'd have a lot more conviction understanding that, okay, this range was balanced. We traded through that range with speed. All right. Order flow begins to stack. Right. And then we have a fair value gap and an up close candle at fair market value. All right. So this kind of becomes like an OTE type of scenario in the London session. And I want to say that's it for the lab chart examples. All right. February 1st, I'm sorry. So February 1st, this should be a dealing range and a BPR example. Yeah, perfect. All right, we're trading below previous day's low. Dealing range, we're taking out sell stops, taking out buy stops. All right, understanding that everything is efficient. We're looking at order flow as well. All right, that's 1, that's 2. This becomes 3, and then price is off to the races. And also look at that as everything is efficient. Let's say that you didn't, let's say you were like, you might be questioning, well, I didn't see price come back inside of the range, right? Don't be a robot to price, okay? Take the logic, use the logic to your advantage. If this is efficiently traded after taking out a previous day's low, efficiently traded here, leaving that range, this is a dealing range. If this candle closes above that point, what are the chances of us trading back below that high resistance signature, which is also accompanied by a balanced price range? All right. So capitalize where the market is allowing you to capitalize. You don't have to be the most precise person. I'm not here to teach you how to be super duper precise. You're here to make money, right? Or as mentioned earlier, we're here to trade for expectancy. All right. So just once again, don't be a robot. I see a lot of people when they first learn this from a concept standpoint, the robotic nature is going to be there, but understand you have to capitalize where it's meant to capitalize. I hope that makes sense. And then January 24th, Euro USD. And after this one, we will open the floor for you guys to ask whatever questions that you wish. All right, this is a great example. All right, so let's say we were looking at this and we saw price taking out that previous day's high. All right, so we run out the previous day's high. This little range of price is efficient. We run out previous day's high, and then you can see we come back down and we kind of stall inside that range. So this is where we're saying, hey, if I'm thinking that this is a market maker model, we've had pretty strong, upward movement. I want to look for that last phase reaccumulation, hence balanced price range before an expansion. If we trade through that level, then now I should see redistributions from that level. All right, we had a bit of an order block of some sort created around that level. All right, but this is just, framing out the logic even more. All right, and this is also a dealing range. 1, 2, back inside of the range on the next day, and then rebalancing. So imagine coming into the next day, understanding that you have a dealing range created off of a previous day's high sweep, balanced price range, right? This was the midway point of that balanced price range. All right, we have a fair value gap here. So you're coming into the next day, London session ranges, New York takes out the high of the London session, and then maybe on a lower time frame, you get lower time frame delivery that starts pointing to lower prices. Right? You have a lot more conviction because you now understand why this should happen, right? And why the probabilities of this actually playing out are in your favor. And now, obviously, this is news. That has to be news. All right. So that is it in terms of me rambling for the day. Now we'll open the floor up to any questions that you guys have. All right. Who do I have? To Vante. Sure. You can unmute and you can ask away.
So my question is, how do you measure fair market value at BPR correctly? Because in some examples you measure from the VIX and in others from the bodies. Is there like a consistent approach on how to do that?
Yeah. So just as you deal with this more and more, right? You'll kind of lose the roboticness of it. And the reason you see me doing that is because I'm not trying to frame the most precise point. It's more so a general area. So There's times where I'll take the wicks, there's times where I'll take the bodies. All right, but the biggest point is me seeing that there's a consistency in where price is struggling to leave a particular range. Does that make sense?
It
So
does,
there's no
thank you.
practical. So there's not exact practical how to mark BPR.
Yeah, yeah, pretty much, right? It's more so you're framing out an area for probability, right? I want you guys to truly, when I say this is about probability, there's no level of certainty in price or in any market. Okay, so just to answer your question though, to try to give you a framework for that, it is finding an area where price has struggled to leave a particular range, right? There's more consistency in price getting to this point and then this point down below, then I'm going to frame it from there, right? You may have wicks that go here, you may have bodies that exit here and there, but you just want to get a general area. And if you're understanding that, hey, we left here and then we left here, it doesn't matter if we go exactly to the fair market value or not. It's just you're just framing out the whole idea.
Yeah, cool, thanks.
Yes, sir. Next question. Don't be afraid to ask, guys. Like,
Yeah. So when there are subsequent lows or highs, how do you mark the dealing range? Sometimes I struggle with that.
Okay, so draw on the screen if you can. Give me a visual of what you may be struggling with, and then I can better guide my answer based on
Right,
that.
I'll try it out.
Okay.
Whiteboards. Board. No, I cannot use whiteboard.
Okay. All right. If you're not seeing the drawing tool, just ask me the question one more time, and I'll do my best to draw it out.
There's a drawing in the chat. If I can tag you on it, I can tag you.
Yeah. Go ahead.
So what's your nickname?
It should be TAT IPDAX.
Oh yeah, okay.
I didn't even know you can do that.
Oh yeah, I marked it, but right here. Let me do it one more time. Oh, my bad. Here. No, actually, I'm just gonna send a new message right now with the same screenshot. Wow. Computer. Oh yeah. This is it.
Is this you, Philip?
Yeah, that's me.
Okay. All right. So, in looking at this example, so at what part are you saying you're struggling with?
So I marked the last the last low that formed the high, and then we broke it. So for me, I would draw the dealing range as I showed, like the balance price range, like the red lines. So for me, the dealing range is because this is the low that broke the high, and the last high that was rated.
Oh, are you looking at this high and that low?
Yeah, yes,
Oh, okay.
yes,
Yeah,
correct.
okay. Yeah. So you're correct. You're not wrong in this case. Right? It's remember, and this is why I say it's the technical part of it is if there is a high and a low taken, all right, that is our dealing range. All right, don't make it more complicated than that. I mean, even still, I would imagine that, remember, it has time and price, right?
Yeah.
So I don't know. I would imagine this is not, maybe there's a crossover where this isn't a real kill zone. I'm not sure. I don't know where this is coming from. I think this is one of our examples, right?
Yeah, it is.
Yeah, okay. So 1, 2, right? 3. Now I'm not sure of time, but just remember that there's no level of certainty. All we can do is show up where probabilities are in our favor. All right. And if we get a scenario where, you might have saw this as, hey, price coming back into the range, and then we come here, all right, and then it goes back out. There may have been a trading opportunity up here for you on the lower time frame if you scale down, right? If you take that opportunity, you exit the trade, you're having a different conversation than the guy who didn't exit the trade.
Yep.
Right. So it's gonna be, that part is gonna be based on perception, but I believe here that this is an instance where time, we're not having the time and price part is not there, which is why we may be getting that additional.
All right, but so basically you're looking for the dealing range to be formed at a kill zone.
I wouldn't say it like that, because you're not waking up and you're not looking for a dealing range, right? You're looking for you should be perceiving delivery, and that might not make 100%, or let me not say it like that. That might not make as much sense now as it's gonna make to you later on, the more that you show up and you engage with this. Because what's happening now, it's like learning the alphabet, right? When you learn the alphabet, you learn the letters, but you don't understand how there could be the same letter in different words that create different sounds. All right. So you're kind of your understanding is it's on a premature level right now. The more that you engage with it, right, you'll start to kind of remove the robotic part of it.
All right, I got it. Thank you.
Okay. And understand this. That's why we have that midweek Q&A session, right? That's why we're there in the chat. So don't be afraid to send in the chat your examples, your questions, and we'll make sure that we answer them. But you'll
I
gain
will for sure.
understanding.
I will.
Yes, sir. Next question.
Hi, Chris. Do you hear me well? Is it?
Yes, loud and clear.
Okay, that's great. How crucial it is to get a candle closure below a breaker block. I mean, to form a CIST, how crucial it is for a candle to close below it, or it's just the wick would do, is it?
Yeah. So remember when we're explaining, like when we're speaking about our balanced price ranges or ranges in general, right? And we saw price kind of here. And if I'm not answering correctly, just let me know. But the way in which price leaves this range is important. All right. Because if we leave the range and rejection blocks form, right, which are just wicks, then this is not as strong of an indication of lower prices as this would be, right? So if I were to give you a direct comparison, this is us leaving with speed, right, in volume. Right. So I'd have a lot more conviction behind taking short opportunities here, as opposed to, yeah, we left the range. You might have saw that as, hey, we created a lower low. This is why we don't go by, hey, lower low, lower high, lower low. That's way too subjective.
Mm-hmm.
You want to see it lead. You want to see that price exit that range with speed. And when I'm saying speed, I'm referencing volume.
Mm-hmm.
Does that answer your question correctly?
It does. It does. Thank you so much.
Perfect. Next question. Can we say type 2 dealing ranges occur near higher time frame PD arrays, and type 1 occurs on higher time frame distribution or redistribution? Absolutely. And can we say consolidations are engineered price ranges? Absolutely. Offering dealing ranges to the market? Absolutely. Right. So you kind of have it figured out. All right. So basically what he's saying is we have a higher time frame PD array. All right, I'm going to use this box to frame out the higher time frame PD array. And this is where, and honestly, when you're saying type 2 dealing range or type 1, you could have it doesn't matter which one forms at the particular PDA rate, right? It's more so about the overall framework of the market and the delivery at that particular time. All right. What I mean by that is I'm not gonna say, hey, you have to have type 2 dealing range at a higher time frame PDA rate, because remember, this price engineers, it neutralizes, right? It distributes, rebalance, right? This would be considered type 1. Right, can we say yeah, now this part that you're referencing here, right? I like where you're going with it, because you're understanding that we have that PD array, right? And this is where we want to see we want to see price engineer liquidity. And I always say, hey, don't, even if we trade into the PD array, I always say, hey, don't take the very first swing into an array. Why? Because it all points back to us saying engineer, neutralize. If I can't truthfully say that we've done this on a fractal scale, and if price begins to go here, right, and let's imagine this is a liquidity void. If price begins to go here, right, and we have that low resistance signature, right, it's more prone that this is just an inducement to get, guys to go in early, and then we're coming here. Right, and then now the move is going to happen. I wouldn't say that, right? To a certain extent, right? Every scenario is going to be different, because you can have your original consolidation, right? And the market could leave that point. All right, but I get what you're saying. You're basically, what you're alluding to is, we're ranging here, building up liquidity, and then you're expecting this. But I don't want to say yes for every single scenario. All right, if you wanna guide me to what day that is on, I don't mind going to it. All right, high time for PD arrays are mostly 4-hour, daily, weekly. Does it depend if you're a scalper, day trader, swing trader? None of that. I'm gonna say that it doesn't matter, because price is fractal. All right. So if you're a scalper, right, then it pays to know, even if I'm a scalper, and it pays to know where I am in a particular phase of the market, right? Let's say that you're here, prices just ran out stops, all right? Let's say you're here, and we're beginning to trade here, and order flow begins to go back bullish, and you know that here's the point of fair value, right? Then you may find a little more success in understanding that, hey, we're trading back up to this level, right? And by the time price gets to this level, you understand, all right, we should be turning around. So it doesn't matter. I don't like to say that it matters if I'm a scalper, day trader, or swing trader. But what matters is you understand the overall framework, and then you apply that accordingly. All right, the importance of high resistant and low resistant in a dealing range. The importance is this, right? This is a high resistance signature. If we ran out stops, the chances of us needing to trade back above that rank, that high, right, are much lower than us coming back below these lows, right? Low resistance signature here. Is this yeah, this is DXY. So this is what I framed out. This is the exact way that I framed out the DXY plan out in terms of a market maker sell program. This is that monthly fair value gap. So that's perfect. Right. So look, so now take this understanding, guys. You see how everything here has been efficiently traded? Imagine if we trade and we close through this with speed. All right. This is a 4-hour chart. At that point, we could frame ideas, all right, understanding that if that's a high resistance signature, we traded back through that balanced price range, the chances of us going back up here, right, are lower in probability. Not certainty, probability, right? And I see you have fair market value on this as well, all right? It could also be this scenario. We trade with speed, fair value. We only come to that little point of fair value, and then we trade lower, all right? But you're understanding how these market maker models and this understanding of high probability price and sequence, I can tell that you're understanding how this stuff is blended together. Very well done. Yeah, so we'll have for this question here, you guys will have just allow me to arrange the channel and things of that sort. You guys will have a Q&A section for the chat. Myself and the rest of the mentors will be there to answer questions for you guys. But we encourage upload your questions, but do us a favor and make sure that the chart is clear. Make sure that there's not a lot of colors on the chart, and really make it obvious in terms of what you're wanting us to answer. If we engage in the trade in point 3, which parameter can we check to determine when 4 is failing to take 2? All right, how to differentiate reversals from just a retracement? Should we use as reference the significant candles that trade through? Yeah, so it's going to point back to understanding where you are in a market. All right. So if the institutional order flow is bullish, meaning that these higher time frame down close candles, right, are supporting the direction of price, and we're coming back lower. All right, we're coming back lower, and you might have saw, this is not drawn to scale, but you might have saw price come up here, and you might see the type 1 dealing range, all right, and you're seeing phase 3 at this point. Price comes here. Price comes here. And obviously there's going to be a fair value gap within there. I hope you can see my cursor, right? But remember, the candle that trades through the low, right? That is an indication, especially if we're responding to a higher time frame PD array. If we begin to close through that candle that trades through the low, right? Let's say that's this candle here, and then we're trading back up and we close through. Understanding where and why this is happening. I'm using this for the higher time frame array, right? Understanding where it's happening, and you're seeing that, hey, these sell side imbalances are not being respected anymore, right? I might not have gotten the true market structural shift, but I'm seeing that as a response to the higher time frame array, we're beginning to negate those sell side imbalances. This is beginning to point to a reversal in price. All right. And then once we close through that imbalance, you may actually see, right, price come back lower here and begin to go higher, right? Framing out a lower time frame market maker model that becomes a higher time frame market maker model. Yeah, Brian, hell yeah. Yeah, homework after each call. How do we enter the market on dealing range, and where do we put our stop loss? All right, we'll save that. As for now, right, just so that I don't leave you hanging. And understand this disclaimer: you guys have not learned entries yet, right? We're not teaching entries, and we're not prompting you guys to execute, and I'm also not prompting you guys to trade, right? Consider this a new journey. If I were you, I'd literally stop trading right now. I would soak this stuff up, right? Submit and understand that you guys are going to get everything you need out of this mentorship. I can promise you that. All right. But if you were to only have the understanding of a dealing range, right? Just take the logic. If everything here is efficient, you guys have saw enough examples. I mean, if you take 100 examples of this scenario, right? Maybe 75% of those examples, even if you were to just blindly execute here, maybe 75% of those examples will play out. All right, providing you with some type of edge. Okay, phase 3. Yes. Yes, exactly. Right. So we say that higher time framework has to approve lower time frame context. All right. Which is why when I'm showing you guys the high and low resistance signature, not high and low resistance signature, but high and low resistance liquidity runs. All right. If price is down here and I'm seeing a bearish dealing range that's forming, I'm not taking that trade. Why? Because the higher time frame framework is not approving of this lower time frame context. I might even see a fair value gap here. All right. But I'm not willing to engage because probabilities have decreased. Now, had that formed up here, I might take it. But as I get closer to this measurement of order flow, I'm not going to take that trade. All right. Which is why it's important to learn how to trade the response at certain areas. Because what might actually be happening here is you may see this as a bearish dealing range, but what actually might happen is this has a higher chance of being just a manipulation that goes here. Now it becomes a bullish dealing range. Boom. Market maker model. Yes, you guys will have homework and a quiz, right? We'll give you the correct correspondence for that. Any market. Yeah, fair value gap. I see it. Perfect. All right, what I would say though is, I'd be looking at this little portion of price. 1, 2, 3, and then we're trading back higher. Yep, you're welcome, Brad. Thanks for joining. All right, I'll take one or two more questions, and then we gotta wrap it up, guys. We've been on here for a long time. Cool. All right. If there are no more questions, what will happen is you guys give me some time when I get off this call. I'm gonna have to stretch and like get myself going. But what we have to do is we have to still, because what we're gonna organize the chat, so we'll have one chat where it's all material, and then another chat where it'll be like our daily trade talk, for you guys to ask questions, to upload your homework and get answers. And so just give us throughout the day to organize that stuff. We'll have the recording uploaded to the channel very, very shortly. Claire, she's always good about getting that right out to you guys. And yeah, for homework, just to model the homework, what I advise for homework. All right, I'm also going to write this in the chat. What I advise is that you guys come to a chart, and I want you to condense the chart like this, right? The reason I want you to do this is so that you're not looking at candlesticks, you're not looking at the colors of the candles, you're only looking at delivery. All right, does not matter the time frame. And I want you to get very good, right? You should get 5 bearish examples, 5 bullish examples, right? I want you to just look at the chart, and I want you to start building your eye to see that 1, 2, 3, right? That dealing range. All right. Even once you see it, I want you to also force yourself to get good at when price is at that phase 3, going inside of price, right? And looking at phase 3 to see if you can frame out a more fractal dealing range, right? So now you're learning and you start to basically teach yourself to learn to view the response at certain PD arrays. All right. So once again, condense the chart. We want 5 bullish examples, 5 bearish examples. And obviously you're going to get some examples where you're seeing the entire delivery. All right. But then I also want you guys to find examples where you're seeing it within just a few candles. All right. Challenge yourself to see this stuff. All right. You run through that side of the range. Right. And then you might see a candle that looks like, you might see delivery like this. And then this, right? 1, 2, 3, right? So get good at both parts of that. All right. Just condensing the chart. 5 bullish examples, 5 bearish examples, and I would say at least five examples where you're seeing it with just the candle. What we'll also do is once you guys upload the homework, we'll probably have it in there might be a link for you guys to upload the homework, because what I like to do is go through the homework and record a video grading the homework so that you all can learn from each other's examples, based on my feedback. So just give us a moment. We'll have that stuff orchestrated, and I think that about does it. I really appreciate you guys' time, and I will see you guys on the very next call. So midweek Q&A with Vision. I'll upload we'll have the quiz this week, and then we'll also upload the prompt for the homework. Thank you, guys.
Chris?
Yes.
Can I just quickly say, I just want to apologize to anyone that had any trouble getting on the call today. We had some issues just before we set up the call, so there were a number of students that actually couldn't access the call, and there was a number of students that couldn't get in to the call until quite late into the session. So I just want to apologize, and we're going to work on fixing what the problem was today so that it doesn't happen on your next call.
Absolutely. But nonetheless, right, you guys will have this call uploaded to the channel so that you can watch it as many times as you like. Thanks, guys. Any other questions, just send them to the chat. We'll talk about graded price swings, and then as always, we'll open the floor up for any Q&A that you guys have at the end. Just let me triple check and make sure it's recording. Perfect. All right, so learning objectives for today, right? We want to be able to blend the teachings of lecture 1 and 2, right? So lecture 1, we spoke about delivery. Lecture 2, we spoke about institutional market structure, right? And we want to be able to blend those things and see how those things actually fit into the scope of what we're speaking about today. We're going to understand the power of buy and sell programs and how we can effectively use those, right, to our advantage. We want to be able to trade in line with order flow by identifying whether we're on the buy or sell side of the curve, okay? And then we want to learn to use institutional order flow to our advantage, okay? Because you guys will see, we like to say that institutional order flow is the one thing in price that almost never lies, right? Keyword almost. And then we'll talk about grading price swings near the end once we've covered the things that come before that. Something I want to point out, I thought this was pretty profound, but Vision brought this quote to my attention. So by now things should begin to unravel and pieces should begin to be easily put together, right? You should be seeing how this puzzle is coming together. So a quote that Vision brought to my attention states that every time we revisit a new piece of information or material, we're not interpreting it as though it is, we are interpreting it as though we are, right? And so what I take from that is that very first time we had lecture 1 or the very first time we watch a piece of material, right? What we gain the second and third time is a lot more valuable. And it sticks a lot more, and we're able to digest a lot more. So I just wanted to take that quote and just use it as a piece of encouragement as we continue to push forward. I thought that was pretty special. All right. Okay, so now in reference to me saying, hey, by now we should see how the pieces are being put together. What we've covered and how it is to be blended is high probability pricing sequences. Okay, we talked about institutional market structure, institutional order flow briefly, and then signatures and price. Okay, now this one fractal, right, where we're going engineer, neutralize, right? We distribute here, we rebalance back here, right? And then we redistribute. this one fractal, you can literally see every angle of the market by just understanding this one fractal. Okay. Basically, what I've done here is just take this piece and duplicate it and place it here. Okay. And if I continue to do that, what you'll see, right, is a market maker buy or sell program. Okay. And I want to point that out because we could see this from a fractal standpoint and just see these as candles, right? Either way, the delivery, right, that of the underlying piece, okay, is relative to everything that we've spoken about just thus far. So we just have to get into a phase of really understanding how to mend these pieces together to be able to position ourselves into the right parts of the market. Okay, so institutional order flow. Institutional order flow is a powerful tool that we can use to position ourselves on the right side of the market. As mentioned, I like to say, or we like to say, that institutional order flow is the one thing in price that almost never lies. All right, because if you think about it, whenever price is reaching up into an array, all right, it doesn't just magically appear from point A to point B. Okay, there's going to be something that can visually be seen in terms of price's behaviors and the things that are occurring, right? That may be slightly different than what occurred on the opposite side of price as price was in phase headed to that particular array. All right, and when I say there's a visual aspect to this, right? What I mean is that we're able to actually see if and when price is changing its state of delivery or changing institutional order flow. Now, some factors and questions that help us identify institutional order flow are as follows. Are up or down closed candles supporting price? Okay. Are buy side or sell side imbalances holding or being negated? Okay, and by negated, I just mean is price closing through those areas, or are those areas being cleared? Have any balanced price ranges been cleared or created, right? So if we're on this side of price, we're reaching up into that array, and there was a balanced price range here, right? Beyond us just saying market structure, okay, we should understand it a lot deeper now to look for balanced price ranges and things of that sort. But has balanced price ranges on the opposite side of the curve been taken out, right? Or are new balanced price ranges that flow in line with the new direction, have those guys been created? Okay, those are things that we want to look for. So these questions are to be considered after price reaches into a corresponding PD array. Typically, if price runs into an array and that array is going to hold, we will see a shift in price's behaviors as lower time frame opposing imbalances will become negated, opposing balanced price ranges will be cleared, and opposing institutional order flow will no longer hold its weight, right? What I mean by that is if down closed candles are supporting price over here, and obviously beyond us just saying, hey, there's a market structural shift, let me trade from the fair value gap, we're taking a much deeper look into this because many of you guys know there's a lot of times where you get a market structural shift, fair value gap, and then price just does this. There might have been a balanced price range right here that you didn't really take note of, right? Most times when institutional order flow shifts, the imbalance is the first thing to go, which is why I always say, hey, the imbalance that's the single most important thing in price, right? That imbalance is literally kind of what gives me the answer to the test every single time. All right. Hence why we can use the understanding of fair valuation, right? If you watch the material that I dropped, I want to say that was Friday, but hence why we can use the understanding of fair valuation and take that concept into a lower time frame for executions if context and framework align, right? See material drop in the previous week. Okay. All right. So this is just a little practice here in terms of institutional order flow. What I've drawn out is this resembles the buy side of the curve, right? Obviously, we're headed up to a PD array, and this resembles the sell side of a curve, okay? Key thing to note, and I didn't put it on here because it's been mentioned multiple times. However, on the sell side of a curve, or in this case, let's say buy side of a curve, right? On the buy side of a curve, we're going to see a consistency in terms of down close candle support and price. All right. On the sell side of a curve, we're going to see a consistency of up close candle support and price. Now, does that mean that the very first moment a down close candle gets cleared on the buy side of a curve that order flow has shifted? No. All right, and we're going to see why. Because as I always mention, we can't be robots to concepts. All right, there's a lot of other factors that go into the things that we're looking at here. All right. So once again, on the buy side of a curve, down close candle support price, sell side of a curve, up close candle support price. All right. So if we're looking at this little diagram here, all right, buy side of the curve, running up to that array, let's just, take a note of these few things here. All right. So as price is headed up, we're looking at the fact that discount arrays, right, in terms of order flow, I'm seeing price head to a higher time frame level. However, on this lower time frame, this is where I want to, when we say read the tape, right, I'm reading the tape. I want to see what price is done on this side of the curve and then how that can compare to whatever's on this side of the curve, right, once and if we transition. All right, so here, discount array support and price, right, or down close candle support and price, right? Here's our down close candles. We have fair value gaps, right? So on and so forth. Now, right here, imbalances are holding, okay? Up here, liquidity was swept from the previous high, and the imbalance was closed, okay? So right here, we swept liquidity from that short-term high, and right here, what I'm trying to resemble is that the imbalance is closed, all right? Now, the lower time frame context is there, but why isn't this considered high probability for entering into the market? If you guys can place it in the chat. Great. We should have more answers, guys. But for the few of you guys that did answer, that's absolutely correct, right? So the down close candles are support and price. Perfect answer. And the fact that we have not met the higher time frame array. So when we say lower time frame context has to align with higher time frame framework, right? This would be one of those scenarios. Yes, we said, hey, not market structure shift, but if this could be seen as fair valuation at one point, right? Maybe there's a candle here that provides an imbalance. We come back down. We have to take on liquidity. We clear out that imbalance, right? And different scenarios, we use that as a means of execution, right? Without needing the market structural shift. However, that is only lower time frame context. Okay, there's no alignment of higher time frame framework here. All right. But for you guys that said the down close candle support and price, that is also correct. All right, great job. Now, what is the one additional magic answer here as well? All right, great job. Not quite daily range. It's right here. Yes. Yes. Perfect. Right? So literally right here, what we have is prices pushed up. It's created a bit of a balanced price range, right? And then we push out of that balanced price range. Okay, so even though we're closing that imbalance at the sweeping liquidity, I don't want to impose my will on price and say, yes, we're going to trade through that BPR. All right, we've seen how those BPRs really hold as true support or resistance for price. All right, so we're headed up. We're consistently seeing down close candle support price, and then we get just below the array, and this is where we're engineering, right? Engineering that short-term high with buy stops above it. Okay, we rally higher, and this is where if you watch that video on Friday, when price is running into an array or when we're taking out a liquidity pool, we prefer, right, to see speed, right, or we prefer to see imbalance created within the stop hunt leg of price, right? If you're taking notes, right, that's one thing you should put down. The imbalance within the stop hunt leg of price, all right, as price pushes into the array, the imbalance within the stop hunt leg of price, right, that is where we want to focus our attention. Okay, so most people focus a lot of attention on anticipating or wanting to see the imbalance created on the right side of price. Okay, by us understanding a more deeper level in terms of order flow, fair valuation, and the inner workings behind it, we want to focus our attention on the left side of price first. Okay, because as mentioned, typically if price is changing order flow or changing states of delivery, that imbalance is usually the very first thing to go, right? That the imbalance will go before you get the market structural shift. Okay, so before you get the market structural shift and before the new imbalance is created, the old imbalance is going to be taken out first. That's like our very first sign. All right. So so now that we are responding to a higher time frame array, therefore shifts in behavior can now be seen as a more solidifiable potential change in the state of delivery. All right. So unlike this move, right, which had no framework to support it, this scenario here has framework to support it. All right. Now, I might be a little hesitant because we have a BPR here. Okay. But the very first time that price trades and it closes through that BPR, I might just use what I call a market logic execution and go into the market. All right. If this were, let's say this were a lower time frame, maybe that array was 15-minute. Maybe the time frame that I'm looking at now is a 3-minute chart, right? I may execute literally right here. All right, because of market logic. I know that BPR should hold. All of this has occurred simply because we met a higher time frame array. All right, now what is the scenario if this, let's say that this is a daily array, all right, and maybe this is a 1 hour chart. All right, it's got a 1 hour closure. Well, I'm probably not just going to execute right here because I can leverage a much more efficient entry and stop loss placement. All right. However, I can still use the very same logic. All right, because I'm seeing a shift in terms of order flow or the change in the state of delivery. All right. So instead of just executing here, I understand that new sell side imbalances are created, right, which is a form of order flow. Old buy side imbalances are taken out, which is a form of order flow. And I'll be prompt to look for, right, high probability shorting scenarios within this particular area of price. All right. So, and then also, I think I've already answered it, but beyond just the market structural shift, what other logic can we use right here? Maybe I did answer it. Okay. What else? I like it. Reclaim OB, perfect. Daily range, perfect. Perfect. Yeah, absolutely, right? So he mentioned lower time frame market maker sell model, right, which we'll get into. So by understanding all of the framework that has occurred here on the left, knowing that this idea of stops to inefficiency is highly probable within this area, right? We're right at 50% of that BPR. I should be prepared to see this or frame this as a lower time frame market maker sell program. Right? Smart money reversal up here, so on and so forth. You guys, I took an execution Euro USD shorts on Friday. It is this very same diagram, very same makeup. It's the exact same thing. I'm going to show you guys that the execution and thought process behind it. All right. And then now we're on the sell side of the curve. Okay. So what we're seeing, obviously this here would be a down close candle. right? We're taking out down close candles and we're responding to up close candles. All right. So I want to make one key point. Okay. If we have this scenario, I don't know if it'll let me do this, but let me try. All right, perfect. All right. Okay. At this point, right? Because since I'm telling you guys, I'm saying, hey, on the buy side of a curve, down close candle support price. On the sell side of the curve, up close candle support price. Right? Well, because down close candle support price, we've met that array and we've just taken out a down close candle, right? Does this 100% mean that institutional order flow is now bearish? Bro, you are on it. You've been studying. All right? No, right? So now when I say that, I'm not saying that there's not we're not smart enough to know when and how to kind of bend rules and execute, right? Because common sense overrides rules at certain times. All right. But the point that I'm making, which you guys have answered, all right, is that just because I saw that down close candle support price, that doesn't necessarily mean that institutional order flow is in fact bearish, right? This could very well just be a liquidity sweep. So if we're bullish, right, this whole move is still bullish, we come here, we take out that down close candle, this could just be a liquidity sweep. All right. Now, what would I need to see in order to confirm that order flow has shifted? Only one person answered. I want to see more answers. How will you know the imbalance has healed? Krishna. Perfect. Perfect, right? So when I see those up close candles support price, retracement with bearish OP. Perfect, perfect, right? Yeah. So when I see, and this is why we say, hey, we want to be responsive because price will tell us. Price will literally tell us when order flow has shifted. All right. So if I'm seeing this candle, or us trade into that candle rather, all right? And then we go here. Now I can truthfully say, I can factually say up close candles are supporting price. Before this happens, I can't say that up close candles supporting price. I can say that a down close candle was taken, but I can't say that up close candles are supporting price because I don't know. All right, I haven't been gifted that information yet. Okay, so I just wanted to make that brief point. All right, so now let's look at some examples of us actually putting this into practice. Now, this right here is higher time frame framework. Well, what is the framework here? But just because you guys might not be used to my charts, right? So these two things here is just me marking out the London session and New York session. All right, obviously this is midnight opening price, not midnight opening price, but the midnight line. And then Asian session is here. All right, but what is the higher time frame framework? Because we're gonna focus over here. So what's the logic or the story behind what's occurring right now? Perfect, right? So previous day high has been taken. All right, the previous day high has been taken. Now that previous day high has been taken, right? What can I use to my advantage, right? Because I can't just say, oh, previous day high has been taken, the market's going to go short. I don't know if the market is going to go short. I have no way of knowing. What only thing I can say, I can truthfully say right now is that on this time frame, down close candles are supporting price, buy side imbalances are holding, right? I have no way of just there's no magical way for me to know if price is actually going to turn around from that particular area. What I can do is read the tape on a lower time frame. So in a lower time frame, what is the thought process that I should be going through right up here, or what should I be looking for within that particular area to frame a potential execution? I like it. Great job, bro. Devontae. All right. So I see some of you guys saying breaker block formation, right? Think about what we just talked about. So this is the breaker block formation right here. Just because that's a breaker, or I'm seeing it as a breaker, doesn't mean that price can't do this. Right? So let me say this. I'm not saying that you're wrong. I'm just provoking more thought. All right. Yeah. All right. So imbalance is being negated, right? I see some of you guys. This is the perfect answer. Imbalance taken out, up close supporting price, or maybe an accumulation phase taken out. Right. Perfect answer. Okay, that's the thought process that we should be going through. Inversion fair value gap. I like that as well. Okay. Okay. So going back down, previous day high taken. I saw somebody say normal protraction, right? Judas swing. Now, here's the lower time frame context. Okay. We'll come back to this because this is a very clear market making model. But this is where we're seeing these down close candles. These guys are supporting price. I'm seeing a consistency in down close candles supporting price. Now that we've taken out the higher time frame array, all right, so buy side imbalances we're holding, down close candles are holding. But now we've met the higher time frame array, right? And I want to say this is a 3-minute time frame, but nonetheless, we can see buy side imbalances are being cleared, right? Sell side imbalances are being created. We're seeing rejection from those sell side imbalances. Now, we don't necessarily, we could be technical and kind of say balanced price range here, but, I prefer to see the more textbook scenario, okay? But, so this is a market structural shift, yes. All right, but imagine if you only had the understanding of liquidity sweep, market structural shift, and then I want to trade from a fair value gap, right? Well, I don't necessarily think you would have gotten a retracement to a fair value gap here. That's not always going to happen. You can't be a robot and be subject to only that occurrence, right? So if we're taking a deeper look into this, and all of you guys' answers are correct, once again, buy side imbalances are cleared, but then we also create a BPR right here. All right, we leave that BPR, we come right to 50% of that BPR, right? Remember what we said about OBs that are created at equilibrium of a balanced price range? Those guys will hold. Ultimately, what this becomes is what we call a propulsion block, which is why you're seeing speed right here. Okay, so we're using all of this logic to frame, and on this time frame, this would frame an execution. On a higher time frame, it would just frame more framework to say, hey, we could probably look for something inside of here. But for this time frame, since we've already gathered the framework, this could be an execution, right? BPR, short-term high, intermediate. This is the other short-term high. Okay, and then we're closing through that BPR. There's nothing even wrong with just executing here, placing a stop up here, or maybe even above the BPR, because you've already gotten all of the logic that you need, all right, to say, hey, we actually shifted, right? We had framework. All right, we have framework, right? And then this is the lower time frame context to go along with it. We're on the sell side of a curve. All right. Here's another scenario. So this is the same day. All right. Now we actually took shorts on this day. Okay. We actually took continuation shorts to these equal lows down at this level right here. Okay. But using the same day, right? Time and price. So we've executed within the London Open kill zone by simply using market maker models, what we use, and then we use institutional order flow, and we also use market logic. Now we're getting to the New York session, okay? And looking at the New York session, all right? So this is my New York session starting here, 7 a.m. to 10 a.m., New York Open Kill Zone. In terms of framework, what is my thought process? All right? Because I want to frame out an execution, all right? Of course, we can see it in hindsight, but the logic here would be I want to look for a continuation. But what is the framework that I could use, all right, to kind of pinpoint where that continuation move might begin to occur from? Dealing range, absolutely. Imbalance to stops, I like it. Perfect. Perfect. All right, cool. So level of fair value, right? Which is absolutely correct. So we're looking at this area right here. All right. So we're looking at this area. Remember, if we're looking at a range and we're like, hey, I don't know where price is gonna go, right? You have slight propulsion block type scenario here. This is a BPR. We really shouldn't trade back above that area. All right, we have imbalances up here. Okay, I'm going through my PDRA matrix. How do I know where price is gonna go? And let me also say this, guys. I know like we're in the ICT space and we say, oh, premium and discount needs to come up to a premium before it goes short. I'll be honest, we never know, right? I can show you 68 case studies from 2023 on Euro USD alone. New York session, when given a certain scenario, it literally came to about between 23 and 38% most of the time, probably 75% of the time. All right. Now, but understanding things like this can help you better frame out if price needs to run deeper inside of that range, or if probabilities are heightened for it to just run to that 23-38% level. All right, and I know we don't talk about those levels within the ICT space, but you can't be so much of a robot to everything that ICT says. All right, you got to kind of study this stuff for yourself and make your own decisions. All right, or build your own belief system. Okay, but fair valuation right here, that's the framework, New York session. All right, and I even have a short-term high that was engineered just below that point of fair valuation. Okay, so that's the framework. Now I'm moving into lower time frame context. Okay, because I don't know if price is going to turn from that point of fair valuation. I don't. There's only potential or probability. Okay, so we go down to lower time frame. I think this is a 1 minute time frame. All right. And then we can kind of see the same things that are playing out that we saw from the London session scenario. All right. We see over here we have the buy side of the curve, right? Price pushes to fair valuation right here. All right, it's pretty neat, pretty cool how this stuff is like so precise. Down close candles here. And once again, this is a scenario that points back to the question I asked earlier. We took out a down close candle and a down close candle, right? Does that mean order flow has shifted, right? Is that a means of execution? And imbalance was taken as well. Guess what? Framework is up here. So whatever this context is that you're looking at, it has no weight. All right? We push higher, down close candles are still supporting price. Same idea. We even close the fair value gap again. We push down close candles to support and price. Framework and context still don't align. All right. Short-term high engineered, low resistance signature. All right. This is just inducement. All right. For anybody that wants to go short too soon. All right. So they induce that low. And then speed, right? We love to see speed. When price is taken out a liquidity pool, you want to see speed. All right, because the speed within those candles is going to give you the answer to the test if we actually shift to the opposite side of the curve. All right, we take out short-term high, right inside fair valuation, rejection block forms, buy side imbalances are taken, down close candle taken. All right, yes, market structural shift. All right, but we can go a lot deeper than just market structural shift. Okay, this BPR cleared as well. All right, and then here you actually get, a slight retracement, failure swing, mitigation block, so on and so forth. Market maker sell program. In looking at this scenario, right, I was able to allow the market to tell me if it is actually going to shift to the opposite side of the curve. Just a simple yes or no. Absolutely. And can that thought process be duplicated in every single scenario? Absolutely. Right? So that's that, right? We took those shorts down to those equal lows. Now let's look at a weekly chart on Euro USD. Okay, so this is a weekly chart, and you can actually see what I've highlighted here. It is, institutional order flow, institutional order flow, order flow, order flow, order flow. All right. But I want you guys to tell me, and I've kind of placed hints. What do you now notice in identifying buy and sell side of the curve? Like, what are a few things that you notice here as your eyes move from this I guess you would call this yellow, but this shaded area to the blue shaded area, to the next shaded area, so on and so forth. I just want you guys to kind of point out a few things that you're noticing here. Mm-hmm. Absolutely. So, right, the point that I'm trying to get everyone to see is that every time we're getting that actual shift, you can literally look left and see sell side imbalances are being taken, right? There's a change in what's actually supporting price. Okay. We can also see the fractal, how that plays into an actual shift to the sell side of the curve, and this becomes an extended run. All right, so this is more likely a retracement. I believe there's some type of PD array up to that particular point there, and then we're getting that reversal and continuation type of play. All right. Just look at the consistency in up close candles or sell side imbalances support price. So what we should be gathering from this is that a lot of us struggle with bias, right? Or knowing where the market wants to push next. And that can be as simple as understanding where I am on the buy sell side of the curve, asking myself what's supporting price, right? Are up close candles or down close candles support? Our buy side or sell side of balance is holding as support or resistance. Right? Once you understand that, every time you get, on this higher time frame when we're getting closer to one of these particular levels, right? Probabilities increase for us to look for certain opportunities in the direction of the current trend, right? Or the low resistant liquidity run. low resistant liquidity run, low resistant liquidity run, low resistant liquidity run, and then overall low resistant liquidity run. Okay, every move back up to these up close candles will be considered the high resistant liquidity run. All right, price is going to be much more resistant in terms of wanting to push through those areas. It's going to be protective of the stops above these particular candles. Okay, and then you see volume imbalance. Those areas hold as very strong support resistance. Shifting here. Now this is back in this is November. I think it's around September of 2022. September, November, December time frame of 2022. Okay, and we were framing out an additional push up in the market. There's a lower time frame dealing range that occurs in here. Okay, but biggest point, we see price push through up close candles. Sell side imbalances have been taken. All right, we're pushing through more up close candles. And the biggest point is that price was pushing right to this area right here. There's no price offered from the closing of that candle to the high of that wick. All right, it's exactly where price pushed to. Okay, but you can see on the weekly chart, down close candles are supporting price. Here, 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 right? This was March of 2023, right? But same idea, right? Down close candles supporting price. Okay. So at one point in time, this is another point to be made. What I saw was that price had pushed all the way through, right? Those down close candles. And I started to frame out, I think the level was 0,400, I believe. I started to try and frame out a draw to the monthly inefficiency. All right. And I was saying that, hey, order flow is bearish. But did I really have, I guess, factual information to say that order flow was bearish? Or was I kind of and just jumping to conclusion simply because we ran through it one down close candle? What is the next piece that I need to truthfully say order flow is bearish on this weekly time frame? All right. So in this case, and we haven't gotten that answer yet, okay, because we've been inside of this whole consolidation. However, if we were to see, and I would even take down to this candle, I would see this as an entire order block, right? But if we were to trade through this area with speed, then what I would be looking at is I would be saying, all right, order flow, institutional order flow is bearish. Okay, right now where the market is, we've saw back and forth market from January throughout the time that we're in now, and so we really don't know. All right, we're in a range. All right, there's really no way to actually know because order flow is literally back and forth. Okay, but now let's push inside of current price action and break down the entire fractal. All right, so we're gonna look at basically where we are today. Okay, so just taking the image of where we are today and looking at order flow. Weekly down close candles are supporting price. All right, so as of right now, a lot of our attention should literally be to see what is going to occur with this particular candle. All right, we don't really know. So going down to this time frame here, order flow bullish, weekly chart. All right, and we're going to focus up here. Okay, so now understanding that order flow is bullish, every time price is traded down into these down close candles, every time price trades and closes above a down close candle, we understand that that area should be support because of institutional order flow. Now I'm able to make better decisions on my intraday time frame. All right, so notice how clean institutional order flow is on that weekly chart. Okay, at least for this side of price. We're on the buy side of a curve right now. Okay, Now shifting to the daily chart. This is that same point of order flow that we were seeing on the weekly. Okay, and this is that other weekly down close candle that we saw. All right. Now, this is important. At the top, up here, at the top, we begin to take out daily down close candles. My question to you is, shouldn't we be overall bearish and now shorting to the low resistance signature at the bottom of the range? Excuse my spelling. But because we've taken those down close candles out, right? Shouldn't we say, oh, order flow is bearish. We need a short to this low resistance liquidity run. I mean, low resistance signature. Is that the correct thought process? And if you say no, please give me your why. So if you by higher time frame, what do you guys mean by higher time frame right here? All right. So I do see the right answers. The perfect answer would be that yes, we've taken out the daily down close candles. However, we're just trading in two, right? The more parent order flow, which is the weekly down close candles. Okay, so even though those daily down close candles were taken here, we can't just say, oh, we're officially bearish. No, it's just trading to that level of support by that weekly down close candle. Okay, now going to a 4-hour chart, what we can see, this is where those daily candles were, right? Price traded up. And then you can see the transition as we transition to the sell side of the curve, right? You can see right here, up close candle starts supporting price. Buy side imbalances are taken. This is a BPR. We trade with speed through that BPR. Sell side imbalance. Up close candles are supporting price. All right. So now, while we're in the market, this is the daily chart. We understand that. All right, we're shorting. All right, we can be short in this market, and we have a area of fair valuation right here. But we be short in this market, but it pays us. I'm sorry, this is 4-hour chart, but it pays us to understand to what extent can I be short in this particular market. So here, these are good times in terms of going short. But as we get closer down to this more parent order flow or point of parent order flow, I need to hold back on wanting to short this market. I need to slow down, be a little more patient, and I'm going to be looking for scenarios where down close candles, right, start supporting the direction of price. Now, we get CPI, so, it's a pretty fast move that takes out that level, right? Sell side of the curve. Actually, buy side of the curve, sell side of the curve, buy side of the curve. All right, you can see the consistency of up, down close candle support and price followed by buy or sell side imbalances. Okay, now let's look at this quick scenario. So here's a market where price has a reason to push. All right, the reason I say it has a reason to push is because we have equal lows. This is Friday. However, the range is large, and I don't know where it will push to. Right? We have a range, multiple PD arrays. I don't know where price is going to push. We never know. So how can I take advantage of this opportunity? What is my thought process, guys, to take advantage of this opportunity? Perfect, right? Just read the tape. Lower time frame context. I don't know where price is going to push to, right? But all I can do is I can look at the range. Okay, I can look at the range of price. And this goes with what was in that teaching the other day. I was kind of giving you guys anticipatory skills for how you can trade the New York session if you wake up and say you're a New York trader, right? You wake up and London session hasn't really gone anywhere. I like to use, this is time and price. I use London to basically tell me, all right, is today a trading day, right? Is there something that I can gauge in price? But London gives me the information I need to then make necessary decisions in the New York session. All right, and I try to keep those decisions consistent. Okay, so here's London session. We have the equal lows down below. We trade up. We take out the London session high. Once we've taken that high out, we start closing buy side imbalances. We have a BPR right here, though. All right, so we can look at it here, or you can look at it here. All right, we have a BPR. But we also create this BPR. All right, so I'm seeing strong order flow in terms of bearishness in terms of price. Right, we're closing out buy side imbalances. But because we have this BPR, I'm hesitant. Okay, you guys can see where the execution comes in at. Okay. So I'm more hesitant because I want to see how price responds to this BPR. We create sell side imbalances. This was mentioned in the chat. An imbalance traded on the opposite side of a BPR, right? That's a strong sign that price wants to continue in that direction. Now, most times I want to see that hold. We don't hold, but what we do is we push to balanced price range up here. Okay, so this is just, accumulation, manipulation, and then distribution all over again. Right, going down to attack the equal lows. I believe we left equal lows. We didn't make it all the way, but nonetheless, you guys get the point. Meant higher time frame array or a key level, close imbalances, clear it down, close candles, up close candles, started supporting price. All right, it's that simple. I was able to allow price to tell me if probabilities are in my favor to go short. Right? There's no certainty. Right? The reason I say there's no certainty because I could very well get all of this ingredient and price could just do this. Does that mean I lose confidence in what I know? No. I was just randomly distributed a loser. That's how we gotta look at it. All right, it's just the law of random distribution. All right, so all right, back to the top. Now that we've gone through, we know what institutional order flow looks like from a consistent standpoint. This is when it becomes frustrating. Okay, I had a bit of a small losing streak last week, but when I say losing streak, we have to change how we think about trade. Right, you are going to endure a losing streak. It's not the losing streak itself; it is the severity of the losing streak. Do you have the capability to protect capital, right, and reduce the severity of that losing streak? All right. Now, this is when it becomes frustrating. I'm gonna ask you guys, what's actually happening right here? Mm-hmm. Tell me what's happening in regards to order flow. Perfect answer. This is the exact answer I was looking for. This one, right? It's and then also inconsistent, right? So order flow is indecisive. Okay, we framed it out. We've said, hey, up those candles are supporting price. We've came to the market. We've used all of the information and education that we have. We know that when we see this type of scenario here, where those up those candles are supporting price, we've taken liquidity. Those guys are supporting price. We might see price continue to trade lower. But then something happens. We trade here, right? Maybe that was just a liquidity sweep. We're gonna keep going lower. Oh, then that happens again. So it's at this point where it becomes very frustrating. And a seasoned trader, right, you got to have that inner voice or that inner knowing to say, all right, look, this is just we're just going through a phase of consolidation or a range. You don't know it's a consolidation until you've probably been on the wrong side of price a few times. But at some point, you got to say, all right, look, it's just a consolidation. It's not that the market is doing something crazy. It's not that the market is super irrational. It's not that the market is out to get you. All right. It's just this is just a consolidation. That's all it is. All right. The market is always right. Okay, so you don't lose sight of what you know, you don't lose confidence. You just say, hey, this is a consolidation. Probabilities might not be in my favor. Okay, I need to approach the market in a slightly different manner. All right. So ranging markets will oftentimes, this could be, I'm not saying this is fact, but this could be where a losing streak occurs. And it's simply because you come in with a preset bias, okay, and things align that you would normally see, and for some reason they just don't hold up. But what you have to do is quickly recognize that price has lost its consistency in terms of institutional order flow, and that the approach should accommodate the current market profile. It doesn't mean run away from the market. All right. It just means you have to approach it in a slightly different manner. Okay. We have to understand that we are trading in what's becoming a higher time frame reaccumulation or distribution phase. All right. So when we're looking at those higher time frames, and we see this, and on the higher time frame, you see a point where price slows down, or price gets here and slows down. From the intraday level, it's just that we're just trading inside of that, and you don't know until you know, right? There's no way you can forecast. Well, I'm not going to say that because we're going to talk about graded pricing. But there's no official way that you can just literally know, all right, we're going to get a consolidated range at this point in time. But you can see here, right, no consistency in terms of institutional order flow. So if you guys were wondering why I kind of went quiet last week, I did not have the answer. At some point I realized, all right, I don't have the answer for price. All right, because I'm calling it this side, this side, this side, and it's not holding up. All right, the things that I'm used to seeing that are consistent, those things are just not in the market right now. Okay, so instead of imposing my will on price every day, I'm fine with just saying I don't know. I'll wait, and at some point I'll know, but right now I don't know. Right? We were literally back and forth. Here's the weekly opening price. We were above it, below it, above it, below it. Even with this range, after taking out that liquidity pool, we still went here and then all the way back up here. All right, no consistency. Okay, yeah. Oftentimes, if we are in a ranging market after a market reversal, what I mean by that is, let's say we go here, a raise down here, market has come down to this level, consolidated, made another move, and then came here, and then we start to go into a consolidation. Right? If we see that, this should prompt the trader to zoom out and then grade the price swing relative to an anticipated terminus, right? We're going to that later. But if I see this occurring right here, like we saw, I'm going to zoom out and I'm going to look to see if, maybe this consolidation makes sense for where we are relative to the terminus. Because we might be at a 50% grade, which is where I'd expect a consolidation or an offset accumulation or an offset redistribution. All right. So that's that. That's institutional order flow. Now let's move into market maker models. All right. So the market maker model is essentially a hedge program by large funds that want to drive price up or down to a key level, which we know as a PDRA, as a form of manipulation before reversing price to its true terminus. It's just power of three. Right? Accumulation, manipulation, manipulation. But wait, I think I said it wrong. Accumulation, manipulation, distribution. I'm sorry. All right, so the market maker model consists of every single component that we have discussed thus far. Market maker models should be seen as fractals in and of themselves. We must understand that we are always within some phase of a buy or sell program. Okay? Identifying where we are in regards to order flow, relative arrays, as well as phases of buy and sell programs, this enhances our chances of being positioned in the right side of the marketplace. Okay, so key point from that is here. Market maker models should be seen as fractals in and of themselves. All right, now additional understandings. If large funds want to push price lower, this goes to the idea of accumulation, manipulation, distribution, or power of three. If large funds want to push price lower, they will first drive price higher into a premium array, right? And vice versa. If they want to push price higher, they will first drive price lower into a discount array, which is kind of the image that we're seeing down here. The key point in this is the fact that as price is being driven higher, in this case lower, they are hedging sell positions into the market bit by bit, stops to imbalance. Okay, so let me pause and help you guys to, if you kind of missing where I am with this. So let's focus on this move. If these guys want to push price higher, all right, let's say this is the terminus. This is where they really want to get price to. But the current market price is here. Key level is here. As these guys are sending price lower, because of the amount of volume that large funds are trading at, they can't do what we do, right? Where our broker assumes the liquidity is there. We take a position, we buy, and it's there. All right. These guys have to hedge into the market bit by bit. So when we're saying stops and efficiency, here's the market logic behind that. Okay, so what has just happened is, let's say these guys have 100 million positions they want to place into the marketplace. All right, let's just say, we just say 100. But 100 that they want to place into the marketplace, right? Just imagine there may be 25 here, 10 here, 25 here, right? So on and so forth. They're hedging into the market, which is where we get our retracements, right? Price is going down into a discount, from discount, fair valuation, or you can say premium in this case, back down to discount. Now they're coming back up to find a premium here. But what's also occurring is these buy positions, they're being tacked on to the market, which is why you see your reclaimed order block, right? That reclaimed order block is just basically reclaimed interest from an area where smart money or large funds found interest in buying before. All right, so we push down to that key level. This is where we're looking for our signatures in price, smart money reversals, so on and so forth, dealing ranges. Now, around this area, we might see a dealing range or something of some sort. We might grade this price swing. This might be a 25% grade that aligns with the reclaimed OB to send me, up to terminus. All right, we'll come back to all of that understanding. Now, how can we spot a market maker model? Spotting or anticipating a market maker program is as simple as using the mental framework of stops to imbalance, understanding order flow, and seeing price reach into a higher time frame point of parent order flow, where you anticipate a reversal, right? So, once again, it can be as simple as stops. Well, what is the most ideal thing that could happen here? We trade up to inefficiency, and then we trade back to stops. Inefficiency would be key level, stops will be terminus. Meaning that for price to get to the inefficiency, there's going to be a buy side of a curve on a lower time frame. But now we have stops in the market. For price to get to those stops, there's going to be a sell side of the curve, creating a market maker sell program. Does not matter the time frame. All right, and then obviously you throw that in with your understanding of order flow, because this could be a down close candle, another down close candle, right? Market maker sell program, so on and so forth. So components of a market maker model. Now I like when the light bulb went off for me to understand this, because I would always see those little diagrams with the colors and the different phases, and I just couldn't put it together. But where the light bulb went off is when I first understood, all right, there's three main points. There's the current market price. All right, you have current market price, there's the array, and then there's the terminus. Everything else just fits right in between those. So we have our array above here in yellow. This is our array. But this is where price has traded down through stops, right? And we're resting right here at current market price. But my array is up here. My potential turning point is in deep premiums of the range. This is similar to that New York shorting opportunity that we saw earlier in the lecture, coming up to fair valuation. The current market price, array. Now, tell me from lecture 2, right? What should I be looking for at the array? Perfect. That was fast. You're on fire, bro. Yeah. Failure swing or breaker block. All right. So key note. We know that this is a turning point. This is a turning point. Well, what occurs at turning points? There's only two signatures in price. I should be looking for a failure swing, a breaker block. But I will mention this. If you have a swing high or swing low fractal, technically what you're saying is I have a breaker block and a failure swing. Okay? But just remember, at the array, I'm only going to get here, here, right? Which technically failure swing. Right? And then there's going to be something on the left side of this. So breaker as well. Same thing. All right, so 3 main points. Okay, now what fits in between those 3 main points? That's where you're gonna get those other phases, right? Those are the boxes that you see on those little diagrams. Okay, so let's explain each phase. Original consolidation. This is typically, but not subject to, a balanced price range. Okay, the way in which we identify the original consolidation is simply using the logic that we understand about BPRs. Okay, so we know BPR is basically where prices, struggle to leave out of this particular range, right? Bodies of candles haven't really left this particular range. All right, what we do, we just kind of look for that consistency. Don't be a robot. It is subjective in nature. All right. But you can get pretty, as you guys have seen, we can get pretty darn close to calling out or to framing out the balanced price range so well to the point where we actually get to the pip where that the middle portion is. All right, and we'll see price trade to that area. And that's what we say, that's current market price. Now, once we leave that BPR, so right down here, we leave the BPR, this is where, stops, maybe fair valuation. This is where you get that low risk buy or that low risk sell. All right, so when price makes the first exit from the original consolidation, right, we leave with speed. It has a retracement of some sort. We consider this a low risk buy, low risk sell. Ultimately, a failure swing. We leave, we trade higher, trade lower, maybe to fair market value, maybe to fair valuation, right? Maybe not. Main point is that low risk buy, low risk sell is just a failure. It's just like a failure swing. It's another short-term high or short-term low that's being created. All right. Now, once we push past that first low risk buy, low risk sell, right? We push beyond it. Now that order flow is established, think about it. We have a down close candle supported price, another down close candle supported price. So order flow is established at this point. And price is headed to its objective or key level or PDA rate. Then we expect to see the cycle of stops to inefficiency as institutional hedging takes place. By institutional hedging, what I mean is this is the buy side of the curve. It's headed to some type of a rate. So what these guys are going to be doing, push price up, shorting, push price up, shorting, push price up, shorting, right? And then maybe into the array. So these just become those redistribution, or on the buy side, we're saying reaccumulation. But do not get so caught up into the terminology. It's not the terminology, it's more so how you engage with, what you're seeing in price. It does not matter what we call this stuff. Right? So we have original consolidation, low risk buy and sell, reaccumulation, redistribution. And then once price makes it to the terminus, smart money reversal. Right? Price is now made it into the array, and this is where it becomes important to read the tape for shifts in order flow and shifts and changes in the state of delivery. Imbalances fail, BPRs no longer hold, breakers and failure swings form. Right? In this case, we have a breaker. This now becomes a low risk sell, failure swing. Lower time frame, market maker sell program. Right into a BPR. Right? Last phase reaccumulation. Key point, you should take a note of this. When looking at a market maker buy sell program, the best thing you could do, this is why I always say, hey, look, if I'm expecting a market reversal, I don't always have to be so precise and take the smart money reversal phase. I can give myself a little more patience. And if I see that last phase of reaccumulation or redistribution taken, we trade through that level with speed, right? This is using your newfound logic of BPRs. If I trade through that last phase of reaccumulation, and there's also an imbalance created, well, I'm prepped and ready to go. What am I expecting? I'm now expecting a low risk sale, or I could call it a redistribution. Right? But nonetheless, smart money reversal here. Breakers or failure swings. Swing high fractal, swing low fractal. And then offset distribution. So price reaches its terminus depending on if the move was pro or counter trend, right? Then we will see if price continues or halts at the BPR. Right? What I mean is if this is a scenario where this market is here. In this case, this might be an OB. If where order flow is bullish, then we might see price turn around from here. Opposite scenario, if this market was here, we were just trading to fair valuation, then we probably see price trade right through that original consolidation. All right, so let's do a little bit of practice. Okay. So a quick question. What is the current state of higher time frame institutional order flow here? And how do I know? All right, order flow is bearish. Up close candle support and price. Premium fair value gaps respected. Perfect. Perfect, perfect, perfect. All right, great answers. So now that we're here, you guys can see the cursor. Now that we're here, what is the thought process that I should be using in terms of this pricing cycle? I should see a bunch of different answers right here. What's the thought process? Because now I'm ready to engage. Obviously, I need to be patient. But what are some few things based on what we've learned thus far? What are a few things that I could be using right here to prepare to frame out a trade idea or prepare to execute? Okay, I like it. 1, 2, 3, 4, right? Retracement up to imbalance, expecting lower time frame market maker sell model. Perfect answer. Imbalance to stops. Perfect. Intermediate term high creation, high probability prices sequence, order flow changes. Perfect, perfect. BPR plus imbalance. Stop, balance. Good job, David. Perfect. All right, great answers, guys. You guys are doing great. All right, so we have BPR here. If I'm looking at this, notice we have not placed a time frame on this. I only said higher time frame, meaning that the things we're speaking about applies even on a 30-second chart. All right, it's gonna be 5 minute and 30 second. I'm not promoting that, but I'm just saying the same stuff will hold regardless of time frame. I'm seeing BPR here. I'm seeing institutional order flow. I'm seeing a point of fair valuation, right? Stops to inefficiency. And then overall, we're on the sell side of the curve. Okay, so let me map something out. Bear with me. All right, cool. All right, so now this is where we go down and we're inside of that lower time frame. Okay, price is going here. And we're seeing up close candles support the direction of price. Right? Lower time frame is in alignment with everything that we're seeing on the higher time frame. But we created that short-term low. Now our price is wanting to trade higher. I see a shift in order flow on a lower time frame. Price trades higher. Right? We briefly run out those stops. But biggest point, we create an imbalance. Right? So now what we're seeing in the market is we're seeing buy side imbalances now supporting price. And these sell side imbalances, this sell side imbalance that was over here, that guy has been taken out. So now I'm like, oh, okay, price might just be trading up into the more apparent price swing or the parent point of institutional order flow. Okay, so if I had counter trend ideas, this is the logic that I'd use because I now know, it's a higher probability that we're probably trading to that particular area because of what I'm seeing. All right, here we are. Lower time frame, up close support and price. Transition is over. Bear with me. Okay. Now, what are we seeing price do here? Price is engineering a short-term high below premium rate. All right, engineering a short-term high below premium rate. But key point, guys, what I have to understand is that this delivery that goes down creates an OB. This delivery here goes down to that OB. Right? This delivery here, same idea. Okay, so you're seeing this intermediate time frame, down close candle support price. The lower time frame, the much lower time frame is back and forth, but the overall framework, the higher time frame, we know those up close candles are supporting price. So even though I might be buying within here, I have to know to what extent does probabilities of buying start to fall off and where I might need to be patient and look for opposing ideas. Okay, so we go here, down close support and price. Now we've made it into the array. I've had some form of original consolidation. Right, we leave, reaccumulation, reaccumulation. Now we've made it up into the array. But the whole idea is that we're in a market where we're on the sell side of a curve. So what we're seeing is institutional hedging is taking place. So shorting here, right? And ultimately empty the bag right here. Right? So we get up, we see that swing high fractal form, lower time frame, sell side imbalances are taken, lower time frame up close candles start supporting price. Now price is off to the races. And I'm just going to use this black now. Okay, so we trade here. We've cleared out that down close candle from the intermediate time frame. All right, we've cleared the down close candle. Ultimately, this is a liquidity sweep. We've traded through that last phase of reaccumulation. Okay, now, and this question is kind of subjective to the image that we're looking at, but since I've traded through that down close candle, does that ultimately mean that I can factually say the up close candles are supporting price? Right? Because I mean, yes, I can see it on that much lower time frame. However, this delivery is going to create up close candle, right? So I have the luxury of allowing myself to see what occurs as we trade into that next up close candle, right? So up close candle trades here. Ultimately, what this delivery becomes is a lower time frame market maker sell program, right? Maybe up into that inefficiency. And keep in mind that the imbalance over here, the sell side imbalance that was created over here, price is traded through that after reaching a two higher time frame PDA rate, right? Or parent order flow PDA rate. We get up to the inefficiency. Boom. Right? We can efficiently say order flow is bearish. We're on the sell side of a curve, right? We got a failure swing here. This, you say low risk sell or redistribution, it does not matter what you call it. Smart money reversal up here, right? And then now we're just expecting those phases of redistribution. Okay, this is how we frame the market out every single day. There's no time frame attached to anything that I just said. This could be a monthly chart, scaling down into a daily chart, a 4-hour time frame, and then taking the 4-hour scaling into a 15-minute. Right? This could be a 15-minute, or this could be a 4-hour scaling into a 15-minute, taking the 15-minute and then scaling into the 5-minute. Right? That does not matter. The same rules and the same concepts will apply. Right? So we take that, and now let's talk about, we'll finish off speaking about grading price swing. Okay, so first, why do we even grade a price swing? All right, what is the point? All right, and then also, is it a deal breaker? So grading price swings is not, is for one, it's not a deal breaker. Okay, so it's not like you have to use it. However, as you guys get more proficient in this stuff, it can help to forecast where or why certain market behavior is in play. Right? It fits right into the mold of market maker models. Think about the market maker model. When we're looking at this right here, we're seeing those different phases. And once we grade price swings, we can kind of forecast or better understand why that particular phase is occurring or what type of behavior might occur at a particular level. These grades can help us anticipate where price could slow down, reaccumulate, etc., relative to PDA rays on the opposing side of the curve. Now, how do we actually grade a price swing? So grading a price swing first requires you to be equipped with all of the understanding that we've covered prior. All right, you got to understand where you are within a larger market maker model or fractal. You got to understand which side of the curve you're on, and you got to have a proficient idea about where price is reaching for. This is the main point right here. All right, you can't even grade the price swing until you understand what the anticipated terminus is. Without that, then you're not going to be able to grade it. All right, so now that we understand all that stuff, what are my next steps? The next steps are to anchor your fib. All right, so let me just draw this box. Okay, so let's say that I had equal highs up here. And this market had traded all the way down here. We got here, ran that low, and then we did this. Boom. Order flow is bullish. So what I'm going to do at that particular point, I'm going to anchor my fib from that low, and I'm going to take it to where my terminus, the anticipated terminus is. So maybe this is a market where it's gone, stops, inefficiency, and now I'm expecting from inefficiency to stops. Doesn't matter the time frame. Okay? What I can do is I can grade this entire range, this anticipated range. I can grade it, and I can anticipate where certain things will occur in a market maker model relative to the PD arrays that are on this side of price. All right. So you have a 25% grade, 50% grade, all right, then you have the 75% grade. So it's 4 quarters. Right? Now, at the 25% grade, most of the time this is speed. This is where price has left that original consolidation. This is where we see fair valuation theory and or our first phase of reaccumulation. Okay, so maybe we go with speed here. Reaccumulate there, so on and so forth. The 50% grade, this is where we typically get a consolidation and a stop hunt. So if I'm looking at price and I'm wanting it to run to this level, I'm anticipating running to this level. If I grade that price swing, I may anticipate some form of consolidation around here, some form of inconsistency in terms of institutional order flow, right? Because what typically happens is we get in what we call an offset reaccumulation, meaning that there's a consolidation, stop hunt, right? And then it's reversal. But let me make a key point. The 50% grade, you anticipate that consolidation and stop hunt when price actually trades through the 50% point. Okay? And then what you'll notice is around these areas is where you'll typically see a price slow down a little bit, and there may be a stop hunt for a continuation. All right? Now, the last 25% grade, or 75%, doesn't matter what you call it. Here we usually see speed into the terminus, right? So if price is serious about getting to that level, and if it is a pro-trend move, most of the times you'll see speed into that terminus, not really providing any real retracements. All right, now that does not mean that's going to happen every single time, and it doesn't mean that you can't get price to go here. But what it does mean is that most times you'll see, price will want to hurry up and make it to its terminus at that point. All right. So here we are, taking that same 3-point image that I drew earlier. Current market price, PD array, terminus. We trade higher. We create short-term high. We run into the array, intermediate term high, right? Little feather swing here, and then speed through that level. That's that 25% grade. Right? So we look at that like, 25% grade aligns with the point of fair valuation. That's pretty decent confluence. So now in lower time frame, I might be looking for this to be a market maker sell program. I'm looking for certain fractals to form up here. I'm using all the other logic to make this entire trade make sense. We leave that area, right? We displace lower, and then the market slows down. Right? We start consolidating. Institutional order flow becomes a little inconsistent. I zoom out and say, oh crap, this is a 50% grade. I would anticipate that we would have a consolidation at that area, and I'm sitting and I'm waiting for the stop hunt. I'm looking at this range. I'm trying to frame out. All right, I'm waiting for the stop hunt. That's what should happen around this area, from a probability standpoint. Not certain, just probability. All right, stop hunt. We push lower. slight little, phase of redistribution here, and speed to terminus. So 25, 50% grade here, 75, and then terminus at that point. All right. So just look at some examples. All right, not always going to be textbook, but the more you look at this, it goes back to the quote mentioned earlier. Right? The more we visit something, we're not seeing it as though it is, we're seeing it as though we are. Right? Every time we look at it, we should advance, with our understanding. So this is that monthly imbalance that we called about a couple weeks ago on Euro USD. Right? This is, if we were grading that from that high down to the imbalance, this here would be that first 25% grade. Right? So original consolidation, we leave that original consolidation, right? And then we're kind of understanding, right, that 25% grade aligns with some point of fair valuation. You can see that fair valuation there, and that's there. Right now, grading price swings is also it's a fractal concept or idea as well. Okay, so now here's the 50% grade. We can see that price has slowed down and kind of hung around that area. We get a consolidation, stop went up to the 25% grade. Right, but key point, it's traded through that 50% grade, and then we get the stop point. All right, and we still kind of hang around that area. But you can see price bouncing off of, these areas with precision. Right, and then 25%, we have more speed and we run to terminus. Okay, so now what we're going to do is we're going to grade this move from that low to this high. Okay, and let me mention something. So you guys should be seeing this as sell side of the curve. You're just framing out where those accumulation distribution phases are going to occur. That's all this is. They don't have to use this, but it is good to know at certain times. All right, another example. We're looking at this side of price. All right, so we have this consolidation, original consolidation down here. Trade up. All right, with speed, and it's that first phase of reaccumulation occurring around that very first grade. We trade up above the 50% grade, reacting to the 25%, or to this, let me just say quarter, not 25, 75. But right around here, around 50% is where we anticipate consolidation, stop hunt. Boom. So we call this is offset reaccumulation. And then here we are, and then speed to terminus. All right, so this is just the buy side of a curve. Right, this is another example from pound USD, 15-minute chart. All right, just zooming out a little bit. Equal highs above market price. Price gets down here. Original consolidation, right? More of a stop hunt, dealing range type of scenario. But we go with speed through that area. Okay, you can see the fair valuation created here. All right, that very first grade. We get up. So let's say we were looking at this, what would happen is before any of this happens, we would already be framing out this area, somewhere around this area for us to see price kind of hang around that area. All right, maybe there's going to be some type of consolidation, some type of stop hunt in this area, and we'd kind of anticipate it. All right, and then we know here, once we get here, it's probably going to be speed to the terminus. But so we trade through 50%. Now we're expecting a stop point. Stop points, consolidations. Stop point, exit that range, and then so on and so forth. All right, this is also a lower time frame market maker buy program within a buy program, which is why I say you have to see this stuff as fractals in and of themselves. All right, that's graded price swings. We'll as we progress, especially once we speak about bias, we'll have a little more practice on that, and then progressively when doing breakdowns and stuff like that, you guys will hear me mention these things if it aligns and if it's necessary. It's not something that we force on price every single week. Yeah. All right, so that's it for the lecture, guys. We'll open up to questions if you guys have them. Yeah, you use a fib for this. So you could just go into TradingView and just you could get you a fib and just only put the 25, 50, and 75 levels. Going back to institutional buy and sell levels, they can be seen on the chart as extended mitigation blocks from the left side of the chart, right? So we're in the buy model, then the mitigation block from the sell side, literally. Can you take your mic off mute? I want to better understand your question. I want to make sure I answer that for you.
Hello, can you hear me?
Yes.
Could you pull up a chart and let me annotate?
Okay. Do you have any pair in particular that you like to look at?
Euro is fine.
Okay. Let's do it. All right. So I'll just start here in the 1 hour time frame. And then what's your question again?
So yeah, going back, there was a slide where you said like on the sell side delivery, institutions are buying on the every swing and vice versa. Yeah, this example is good where the long-term low formed. Maybe you could zoom out a little bit or zoom in so we can see the individual candles.
Right here.
Yeah. And let me draw, please.
There you
go. Yep. This example maybe isn't so clear, but we have sell side delivery and buy side here. So if there was an up candle, let's say in this place, it would be a mitigation block on a lower time frame. But if we extend it to the right, like this would be the level where institutions buy, right? And so you can kind of look for these accumulations to go higher, no?
Yeah. So, but it wouldn't necessarily be the up close. It would be the down. So in this case, the down close. I would look here. Like so, look. You see how there's buying interest from this area right here. Right. So look at what's happening here. So you have.
Then this count as an reclaimed order block, though.
Yeah. You would consider it reclaimed order block, right? It's all it is, right? It's just in the simplest way I can explain that without trying to be too complex. It's just an area where there was once buying interest. Now you have to see it in the light of a buy or sell program. All right. But understanding this is how I came to kind of frame out that entry model that's on YouTube by seeing, all right, we have a level over here where there was buying interest. All right. And then, we see that as a short term low, and we run that level out. All right. And then we're trading back inside the range after taking out. The key point is we reacted to a higher time frame PD array. All right. And then what you'll see is within that same area, that general area, we're seeing that buying interest that occurred here is basically being reclaimed back over here. All right. This is a reaccumulation. We graded the price swing. We got a stop point to where right back inside of where there was heavy buying interest from before.
That makes sense. Thank you.
Okay. And we'll as we progress, just understand we'll continue when necessary. If certain things show up and there's great teaching points, I'll make sure that I highlight them.
Hi, Chris.
Yes.
I have a question. William, yeah. So
Okay.
when you do when you are doing the graded swings, in some cases you find that when you pass that 50% level where we expect the manipulation, price might go up and hit the 75%, and then it comes back to 50%. Now, in those cases, would you still expect for it to go back and to terminus, or at that point you might consider, okay, maybe we might complete this buy side or sell side and then switch over because it has gone up swiftly and hit 75%, and then it comes back? Or will you still say, okay, this is just that manipulation around 50% level? I don't know if that's clear.
Yeah, great question. So remember, that's going to depend. So everything that you've explained is context, right? So now what solidifies the answer to that, because there's no one answer. What solidifies the answer is the overall framework. Right? So if I'm in a market where order flow is bullish, and we go here, as you're mentioning, we sweep there, then we go up here, and then we come back down, and you might be seeing that order flow. Maybe order flow in that intermediate time frame has gone slightly bearish, because the higher time frame is right. The higher time frame down close candles are supporting price. And we might have some type of obvious terminus up here, or actually the terminus would be right where we have our grade. But I'm not gonna just jump and just say, oh yeah, it's turning around because it hit the 75% mark. No. Now, in the light of a different scenario, if the order flow is bearish on a higher time frame, right? Let's say that the order flow is you had here, and maybe there was something here, right? Maybe I was framing out some type of equal highs in the marketplace, but then price got here, and then it got here, and maybe there's a fair value gap in here, and I saw the 75% grade. Then basically it's just a matter of me saying, all right, well, this wasn't where price wanted to run to. Order flow has probably truly shifted because now we're in alignment with the higher time frame order flow. The example before that, higher time frame order flow is bullish. If that's probably the best way I can explain that. All right. In short, it's going to depend on what the overall framework is.
Yeah, that makes sense. Thank you.
Yes, sir. I wouldn't say I wouldn't say it's always or it has to be a reclaimed OB. Like let's even take away the logic of reclaimed OB, and let's just simplify it and use market logic. Right? I'm answering this question. So array price trades higher. We get here. We slow down a little bit, and then we run here. Right? So and the reason I'm saying this is because I don't like to get so caught up into what we call certain things. I believe that there's more value in how we internalize it, and then how we engage with it after internalizing it. But once we have speed through here, it's just simple. Our base market logic at this point is that because this was a balanced price range, and we've reacted to that PD array, right? Then I can say, yeah, I believe this area should hold, especially if it has a fair value gap in it. So you could say, yeah, it's a reclaimed OB or reclaimed selling interest from that area. You could say that, but I just wanted to kind of reverse engineer and just point out the fact that we could just simply use the base market logic that we have beyond having to call it something. You're welcome.
I have another question.
Okay.
Is the market maker a model confirmed when the last phase of accumulation is taken out?
Yes, that is the best way. That is the more proficient way. All right. So that's a great question. Array, and this is kind of gonna be the same drawing that I just drew, but last phase of reaccumulation. All right. So I might even I'm not even going to say that. But just to answer your question, yes, when you see that last phase reaccumulation taken, and you combine that with if any sell side imbalances are created, buy side imbalances are taken, right? Now you've increased probability in terms of saying, all right, yeah, this market maker model, or I wouldn't say it's complete. The buy side of the curve is complete. Now price has shifted over, and now we're on the sell side of the curve. So it's very important when you're looking at price and you saw price reach into an array. It's very important. The very first thing that I'm looking for is I want to look for the opposing imbalances, right, that were created in the midst of a stop hunt. And then from there, I also want to look to see, are there any balanced price ranges? And the reason you want to see if there's any balanced price ranges is because if we just leave this stuff to market structure, right? Well, if there's a BPR sitting right here, and you see market structure and fair value gap, and you take just a blind execution from that fair value gap, boom. I saw this 1,000 times. All right, it's stuff like this that may force me to kind of go in and get deeper and say, all right, how can I be more logical than just taking that array for face value? Because this is a market structure shift, but you'll find you get a market structure shift, BPR is right here. All right. And yes, you might say, well, isn't that last phase of accumulation, right? Because the market went here and then here. Yeah, it can be subjective. However, common sense at times will override rules. Okay, so if I'm saying BPR, then I'm going to see that BPR as the most significant level within this current price range.
Okay, thank you. So we would just wait till price trades through that BPR?
Yeah, you can do that. You can do that. And let me say this: if one guy says he's only gonna wait for order flow and imbalances up here, if that works for him 70% of the time, then there's nobody that can tell him he's right or wrong. Right? If you say, well, I prefer to find these market maker models that have a clear BPR or clear reaccumulation phase, and I prefer to wait to see that area taken out. That could be a model for you. That could be what you become proficient in. There's nobody that can tell you you're right or wrong.
Okay, thank you a lot.
Mm-hmm. 4-hour chart on gold. How would you grade price swings here? I haven't looked at gold in a couple weeks, I think. Oh, damn. So we called these levels a while ago. It's nice to see them here. Order flow is framed out here. All right, so basically you're asking how would we grade this? So because we called out this level, right? It's somewhere in the chat, 2066, or maybe I said 207 to round up. But it's that simple. When I'm here, like let's say I'm here and I start to see order flow, change over. I'm like, all right, cool. We're down close candles is supporting price. We ran out a previous month's low, right? We ran out January's low. And we're already in a bullish market from a higher time frame perspective. I'm gonna grade to those equal highs. All right. So I'm gonna grade. Let me actually clear this stuff out. I'm gonna grade to those equal highs. All right, and I'm gonna say, all right, maybe around this level we might get some price might slow down a bit. All right, you can see this grade here. There's a liquidity sweep that would occur at that grade, and I don't know how this plays out, but let's go to 4-hour. You actually 4-hour. I mean, there's your stop one, right? You see what happens at the 50%? So right here. Right? You anticipated some form of a consolidation and a stop one. the first 25% grade, this is your first phase reaccumulation. Okay, and then this last 25%, what happens? We get speed, right? This is honestly a textbook scenario or teaching opportunity in terms of graded price swings. You know, we've called the equal highs out. We saw order flow shift. At that point, once we see order flow shift, now we're coming in and we're saying, all right, let me grade the price swing. You just want to be conscious of where those grades are. So then you kind of anticipate certain things to happen around those grades. All right. And if you saw consolidation, stop hunt, and a push out, now guess what? We're taking it back to lecture 1. Dealing range. 1, 2, right? 3. Oh crap. The imbalance was negated. Order flow is bearish. No, it's not. Down closed candles are supporting price, right? Framework and context support bullish ideas. Okay, you see the order flow here?
Yeah, okay, thank you.
Fair evaluation. Speed. I'm glad you asked that question. That was a great teaching opportunity. Great job. Next, there's somebody that needs to mute their, please mute your mic. There's a lot of typing. If you're typing, please mute your mic.
Can you hear me now?
Yes, I can. Yeah, I can hear you.
Okay. Yeah, many thanks for this answer about the gold. And I was wondering if I should mark these 2 equal highs or this one swing high before, but you just answered my question that these 2 equal highs are more in interest, because on my screen I marked this first, the first swing high before these 2 equal highs. So on the left, around 2,100 or something like that. Yeah.
Oh, you mark this level?
But I'm not sure why it shouldn't be like this one.
Yeah, So look, you can mark that level, right? If you're seeing that as a low resistance signature, right? That's fine. But what I'm doing is I'm taking where I know the most least path of resistance is, that price is that look back function is gonna run to. I'm gonna put my bets on those equal highs.
Okay, so I should look at the most resistant level, yes?
Yeah. So basically what I'm now look, this is the thing. For some reason, this stuff is always going to align. All right. You can still see, even though I stretch it out to that high, you still get a consolidation around that area. All right. Okay. A slight stop point right here. Boom. And then you still get speed at 25.
Yeah. Okay. Thank you.
Yeah, I agree. Great example. Somewhat. Yeah, it's a lot. Yeah. So once you understand this stuff, there's so many things you could do, but the goal is not to try to do everything, because then you start to have too many filters, and every filter that you add, every concept that you add, that just becomes another emotion to try to govern on a daily basis. So the whole goal here, guys, is you learn all this stuff, and then you reverse engineer for simplicity. And you do the same shit over and over and over and over and over. Win, lose, or draw, just keep doing the same thing over and over. You're going to have a losing streak. Right? Then just like you're subject to a losing streak, you're also subject to a winning streak. But the goal in trading is not to escape losing. Right? In 99% of us go on this journey and we try to escape losing, by finding a perfect system, right? So we learn this right here, and we learn something that says, hey, when you see this scenario, you should respond to that stimuli. All right. Now, what we have to understand is that has been created for probability, not certainty. Probability in the sense that there's the possibility for, in terms of positive future outcome, there's an 80% chance, right? When I see that certain scenario, or that's, for me to respond to, there's an 80% chance I get a positive outcome. But I also have to respect the opposite side of that coin. there's 20% chance that I get a negative future outcome. Now, if I show up to this scenario and I'm given that 20% future outcome 3 times in a row, does that mean I made a bad decision? No. It just means the market was right. You're never really wrong. You're just too early or too late. Right? So once you start thinking from that regard, then you can start respecting your concept enough to trade it enough sample size to then understand the numbers that go along with that sample size, and then it becomes a system. It's not a system if you're just trading a concept. And then the first time that the concept loses 2 or 3 times in a row, what you do is you go back to YouTube. This is everybody's story. You go to YouTube and then you learn something else, and then you throw another tool in there. And all that's going to do is throw off the initial system's expectancy. All right, so as we progress, we're going to speak about random distribution, which has 0 to do with technicals, expectancy, risk of ruin, survival. If you guys want to know the holy grail of trading, it is this, which points back to this. Okay? You can literally trade support and resistance, and if you understand these things here, and you have respect, deep respect for this here, you can trade any system, right? And I say that lightly. You can trade any system, right? And somehow, some way find your way to profitability. Because it's not the concept, it's your understanding of how to make the concept work over a sample size. But those are the types of things we're going to get to down the line. Cool. All right. If there are no more questions, we'll close this one out. I think this was a great session. You guys asked some really great questions. Hopefully you're starting to see, or not even starting to see, you're seeing more of how these things blend together. We'll keep progressing. Next week, we go into bias. So we take all of this stuff that we've learned, and then you're gonna gain a very systematic approach for framing out bias that incorporates everything we've learned thus far. For homework, and let me first apologize, guys. It's not an excuse. It's not an excuse. I'm not an excuse maker. Been kind of bombarded and overwhelmed. I'll be honest, right? Didn't get around to actually recording the homeworks last week. However, I want to encourage you guys to still take what I'm about to say and actually go in and do the homework. Because the homework is not just so that you get a recording. It's so that you place your eyes on this stuff. Points back to the quote earlier. Every time you visit something, you're not seeing it as though it is, you're seeing it as though you are. So when you do the homework, after going through this lecture, you're a different person. The next time you do it, you're a much more different person. All right. So what I would encourage is just go to your charts, okay? And you want to find, 5 examples of a buy program, 5 examples of a sell program, and then you want to mark out each phase: smart money reversal phase, reaccumulation, redistribution, low risk buy, low risk sell. All right, and then offset distribution. So you want to mark those things out. But remember, the best way to find a buy or sell program is just like this. I can come to a 4-hour chart. And let me not say 4 hours. It doesn't have to be 4 hours. But I can come to any chart, right? Anywhere where I see a peak and reversal. It's literally that simple. Anywhere I see a peak and reversal, what I want to do is I want to find the starting point, find the reversal point, right? Find the ending point, and I'm trying to make sense of what everything that happened in between. And I'm looking for once price reverse, what actually happened. And you'll start seeing there's a consistency in terms of what's happening. And there's enough consistency to where you can gain trust in just duplicating that every single day. If you guys want to also incorporate in there or take a stab at, when you do those market maker model examples, if you want to take a stab at grading the price swing on top of it, so you don't have to do any additional work. It's just once you find a market maker model, grade it and see if you start to see things align in terms of where those reaccumulation, redistribution phases are occurring. It's just a very good practice. So as always, we're trying to take theory, move from theory to proper application of that theory. So if there's no more questions, we'll close this out, and we'll be on to a great week ahead. Yeah, you guys will get a recording. If that's what you're asking, if you're asking for this upcoming week's bias. But all right, guys, thank you for your time. I'm gonna go spend some family time, and I'll have that weekly outlook to you guys later on tonight. To start off, the whiteboard device not device, but software that I typically use when we're doing these teachings, for some reason it won't come up. So won't be a big issue. We'll just transition, and we'll make the best of this particular meeting. I'll try to use this one. It's not the same, but we'll try to get it done. All right. So today's main focus is obviously execution, right? And so trouble with this thing already. All right. So the main focus for today, as we all know, is just executions. All right, and that's taking ourselves into more of a logical, rule-based, and a super objective means of actually executing in the market day in and day out. Okay, we're recording, right? All right. So in terms of executions, right, just bear with me because this was all stacked on an actual presentation. We have institutional order flow entry drill. We have Model X. And then we have a market logic execution. Okay. Now, institutional order flow entry drill is pretty much what what everybody saw in ICT's 2022 YouTube model, where it's more so executing after order flow has been established, right? Finding a fair value gap and executing from that fair value gap. Okay, so these scenarios here, price runs out liquidity. We tapped into a higher time frame array, right? Price runs out liquidity. We get displacement. All right, and as long as framework and context are aligned, and there's a fair value gap here somewhere, they're going in, and that's your institutional order flow entry drill, right? It's in alignment with institutional order flow reacting from a higher time frame PD array, some type of level of resistance or support. Okay. Model X, which is what we're going to see a lot of examples of today, is basically taking your understanding of fair valuation, swing high fractals, high probability pricing sequence, even market maker model. Model X is literally a compilation of everything that you've learned thus far, just on a very fractal scale. Okay. So in this scenario, this is where, we're removing that need for market structure. All right. And we're using what we know about fair valuation to say, hey, I can take that candle that offers the imbalance in the stop point leg, use that candle as my order block. All right. And then from that, I'm wanting to see price create a second change in the state of delivery from that, which confirms the order flow. All right. It has nothing to do with market structure. It's just you're confirming order flow. You're looking at opposing imbalances, right? And typically what we see is speed. All right. And then market logic execution is More so, we have a scenario, all right, and let's say this is a balanced price range. And, you know, price could either already be bullish or it could be a reversal type scenario. But if we're bullish and we know there's still maybe a draw of liquidity up here, right? And then we have that balanced price range and we leave with speed and we close, right? That's basically an immediate execution. Stops are going here and then we're attacking that draw of liquidity. All right. Different scenario would be if we go here, we react to a higher time frame PD array. All right. You might even get model X up here. But what you're going to learn today is in terms of probability, model X will become lower probability if a balanced price range precedes it. So in that case, what we have to do as traders is, yes, I might see model X, but in terms of just being smart and allowing myself to have more certainty, what I'm going to do is allow price to actually just close through that BPR. Once it does, right, I've already gotten what I wanted up here. I just need to confirm a little further. Once that happens, it's an immediate execution. All right, we saw this on Euro USD and Pound USD last week and the week before that. All right. So as mentioned, guys, this is basically me trying to freestyle in the light of not having my presentation board. All right. We'll transition really quick. We'll come here to these images. These are going to be used on the actual whiteboard. So let's go to all right, so in terms of IOFED, right, institutional order flow entry drill, that is where in this scenario here, right, maybe you're trading that London Judah swing. You see that balanced price range, price runs sell side, runs buy side. At this point, you know that price has chosen its fate. You're trading in line with the higher time frame institutional order flow. All right. And then that fair value gap should become support. So basically, when you're trading institutional order flow entry drill, what you're saying is, I'm trading in line with the higher time frame order flow. Price is created an imbalance that supports the higher time frame order flow. So that imbalance should become support. I'm going to take an institutional order flow entry drill. All right, just going to scan through until we get to the next one. Same idea here. Right. So this is adding a little more logic to what you learned in that 2022 model. Balanced price range here, we go up with speed. If you're looking at this before price runs through that BPR, you might not want to execute. All right. We push past it. Institutional order flow entry drill taken here. All right. So the institutional order flow entry drill, that is that risk entry. All right. Which most times, we say, hey, we don't want to take risk entries. We want to take response-based entries. But over time, you'll learn when the risk entry is necessary and when it's not necessary to have to be extra precise. Let's keep scanning through. All right, same idea here. IOFED. Here's a balanced price range. We leave that balanced price range with speed. Fair value gaps behind. All right, what are the chances of us trading back through this area? We know at this point, very low chances. Once we leave with speed, we might see price only come to fair market value. So we have that accompanied by a fair value gap. We can take an institutional order flow entry drill, right? It's more of a market limit execution, or maybe it's a market execution, but it's just right at the fair value gap, right? Risk entry. Okay. Another example here. See a balanced price range. We take out stops. We trade through with speed. All right. What are the chances of us coming back here? Not really high. So here's a fair value gap created as I've left a BPR with speed. I'm just going to take that fair value gap is going to hold as support. IOFED. All right. Same idea here. Here's another example of an institutional order flow entry drill. All right. Order flow is already bearish. We're on the sell side of a curve. I think this was a Tuesday or a Monday. We're on the sell side of a curve, right? You have a fair value gap. IOFED. Okay. So it's knowing when to actually apply those those few teachings from that 2022 YouTube model. All right. Now let's get into the market logic executions. Okay. Which is taking those BPRs, right? Taking the BPRs and just being logical with them. Okay. So if we have a BPR, prices back and forth, and let's say that we've already uncovered our framework. We know where price is. Price is responding to some type of higher time frame level down here. Okay. And it goes, we run out those stops and we trade and we close literally right here. All right. So you're already on that lower time frame. We trade and we close. All right. A lot of times you don't know that price is going to create the fair value gap, come back to the fair value gap, and then run, right? If you get a scenario like this where order flow is already bullish, price is already predisposed to go higher, maybe the draw of liquidity is here. All right. We did this on Euro CHF. I want to say that was last week. Price came down into that higher time frame fair value gap. We'll go to the charts and see it. And I'm allowing myself to take a response-based approach. All right. Once I saw the balanced price range form and we tapped into that higher time frame fair value gap, I'm knowing that, hey, well, if price responds by trading and closing through that BPR, I can, and we're in close proximity to, where stop should be, meaning that we haven't done something like this. In this case, then I'm going to play for an institutional order flow entry drill, right? Where I might want to just execute from that fair value gap. But if we trade through with speed and we close here, I can go ahead, I can immediately market execute, and then we'll see price go higher. All right. So let's actually go to Euro CHF on that particular day. And that was actually on a 1 minute chart, which I rarely use. I don't use the 1 minute as much, but for this sake, it was necessary. And I promise we're going to get to Model X. All right, so here's a day where I was calling the draw at 09807. Okay, and we had on a 15-minute chart, we had this point of fair valuation right here, right? 15-minute fair value gap here. Institutional order flow is bullish. Now, in this case, right, in this scenario, going back to our understanding when to apply an institutional order flow entry drill, we haven't made it to the draw. Here's a fair value gap, right? Here's an order block that precedes a fair value gap. All right, it's in those scenarios where the institutional order flow entry drill or risk entry, right, makes sense. Okay, now if I say, hey, I don't like the RR on this, and what can I do? Then I can go down to a lower time frame and I can play for a little more precision. All right, but maybe I'm a guy that says I'm cool with taking this 1 to 1.2, right, or 1 to 1.3. Right? I mean, unless you grade the high and then you go 1 to 1.9, right, which is cool. But if I don't want to do that, and I want to take a response-based approach, I'm headed to my lower time frame. All right, and this is where we're thinking market maker model. All right, so price is running lower. Right here, we create this balanced price range. Right now, objective logic in this scenario is that I want to see price get down to that PDA rate. I want to see it engineer, right, some type of short-term low, okay, and then I want to see that low neutralized, which is exactly what we do here. Now, this little area here becomes my BPR. Once we trade it through that BPR, all right, and then we had this second close showing me a fair value gap, I immediately execute. All right, I'm not waiting on that on the IOFED here. right? I'm just going base market logic execution. Okay, I have a BPR. We took out the BPR as low, right? We traded through with speed and we created a fair value gap. Okay, now here's the key point. Anytime that price is responding to a PDA rate, okay, this is major key. Anytime price is responding to a PDA rate, right? PDA rate symbolized by this little yellow shaded area. Okay, maybe this is a fair value gap or an order block. We want to see the price hits that level and it's trading away from that level. I want to see sponsorship always. All right, and by sponsorship, what I mean is institutional involvement. How do we know there's institutional involvement? What does that look like in the market? Displacement. Okay, so what I'm getting at is I don't want to see price trade down into an order block or trade down into a fair value gap and just start to slowly work itself away. There's no sponsorship. If that PDA rate was ready to hold or it was ready to send price in new directions, I would see some type of a fair value gap, some type of sponsorship. All right. If I don't see it, probability is lower. And we might get this. Now, if I start to see sponsorship, and I'm like, okay, cool. Right? We've reacted to the PDA rate. I'm seeing buy side imbalances or pro imbalances step into the market. I like what I'm seeing. I can execute. All right. So keep that in mind. Whenever price is reacting or responding to the PDA rate, we want to execute, we have to see sponsorship. Right? Let's go back here. All right. So this was the euro. This was euro a couple of weeks ago. Let's go to the 5-minute. Yeah, right. All right, so this is euro a few weeks ago. And this is a scenario where higher time frame order flow is bullish, right? And we're expecting price to run down to these sell side imbalances. Let's go to our higher time frame. All right, we push up, we hit fair valuation. Okay, we know that order flow is bearish. We hit fair valuation. We closed in this fair value gap here to the left. Right, and then we just traded to fair valuation. Now, in a 5-minute chart, as I'm reading this, initially I'm looking for Model X. And we haven't gone through what Model X is yet, but initially I'm looking for Model X. Now, in a scenario where price trades higher, and if this is the current market price here, I have to study the range that took price into that array. Why? Because within that range, I want to look for things like this. I want to look for BPRs. Okay? Because it's the same logic that we use in a higher time frame when we say, hey, I want to see the last phase reaccumulation or last phase distribution taken out. In this particular case on the euro that day, we didn't get a clear Model X, right? So then I can resort to, let me just use market logic. All right, I might not get the most precise entry. You don't need to have 5R, 4R every single trade. Right, 2R, 3R is great. 1.5R can be great. Okay, but anyways, price trades through here with speed. We close with volume. Right, market execution can literally come here. This is just a market logic entry. That VPR has been traded through. We close through it after reacting to a higher time frame PDA rate. This point of fair valuation. We come lower. Okay, if we come lower, you can sort of see the same thing here in terms of a market logic execution. Right, you can just take this little range of price. We trade through. Right, so order flow is still bearish. We trade lower with speed. Right, we're not expecting price to run back through this area. You can either execute immediately here, right, or you can allow yourself to see if a fair value gap is created, and you can trade an institutional order flow entry group. What I'm explaining to you guys now is just knowing when and how to use certain things in certain scenarios, because every scenario is going to be slightly different. All right. Here's another scenario where you use a market logic execution. So on this day, we had equal highs here. I actually took this trade. This trade actually turned around on me. So we have an expansion. Fair value gap on a higher time frame rests right inside of here. Okay. Price stalls for a bit. And this is on that video. I'm saying, hey, I like the fact that we have this, because now I get to use this to my advantage. If we trade and we close above that level, I'm just going to market execute. I don't need to see a fair value gap traded back into. I don't have to see any of that stuff, because at this point, price has chosen its fate, and I know we should go higher. So balanced price range, we trade up, we close through it here, right? I market execute. Now, you could be a guy that says, hey, I want to wait for a fair value gap. You don't always know that FVG is going to be in close proximity, or even if price is going to run back to it. If you can execute and you're not too far away from stops, just go ahead and get into the market, right? Make sure you get filled. We're not here to take the most precise entry. We're here to make sure that we're filled and we take advantage of opportunity. Okay, so those are all market logic executions. Just to recap, market logic execution is me finding that balanced price range, right, and using that to my advantage. If we close here, we've just reacted to a higher time frame PD rate. I can go right in and execute, and then I should see price run away. There's actually one more of these in February. Let's go back and look, and then we'll go right into Model X for the sake of me not having what I need today. Yeah. So these are shorts that were taken back in February. These shorts were taken into 07. I want to say it was 07220. Yeah. 07220 monthly fair value gap. And we're in this scenario on a higher time frame. We had I want to say a 15-minute fair value gap. Right here. Okay. And as we always say, within this range, we don't know which array price is going to run to. All I can do is see it get to an array and then watch it on a lower time frame, read the tape on a lower time frame. So in this scenario, me and James both saw this the same way. We were looking at this area right here. All right, we were seeing this as a VPR. Maybe I can go to the lower time frame. You can see it clear. We were seeing this as a VPR, this small little area. On the lower time frame, you'll see it a lot more clearly. But as you can see, price is trading and it's responding to that VPR, right? It's responding to that area. Okay. So now, most times we're looking at price and we're looking for structure, right? Or at least in the 2022 YouTube model scenario, the very first thing you're going to look for is structure. You're going to see a fair value gap, right? And you're going to see that fair value gap here, and then price is going to run into it, and you're going to trade from the fair value gap. You're going to get a slight reaction, and then boom. Well, why didn't it work out? It's because every scenario is slightly different. There's a BPR is resting right below this structural point, right? You didn't pay attention to it. So yes, you got all of this, the ingredient that you needed from the start. However, there's one more piece that you didn't pay attention to. There's a BPR resting right below market price. And that BPR is holding that support. So what you would rather do in a scenario like this is market logic entry, right? Price comes here, boom. At that point, you execute. Place stops above or somewhere inside of here. All right, so on this day, what we did is we executed right at the closing of that particular candle. All right, order flow. You see up close candle support and price. Order flow was bearish. We had a fair value gap in here as well, very small, right there. All right, but we executed at the closing of this particular candle. And that gave us Let's say that was 2R, or maybe a little more than 2R on that day. So we have market logic execution, IOFED, institutional order flow entry drill, and then we have model X. Okay, let's get into it. All right, so model X is us taking what we know about fair valuation, what we know about high probability pricing sequences, what we know about the market efficiency paradigm, right? Stops to inefficiency, stops to inefficiency. Okay, swing high fractals. We're taking all of that information and we're compiling it into an objective execution model. When it comes to fair valuation, typically what we do is we say, hey, price has traded through that low with speed. This is my point of fair valuation. I expect price to trade back into that area. All right, for order pairing, I expect price to trade back into that area. Respect the fair value gap that rests here. And then trade lower. Right? And we also learned in fair valuation theory that if price trades and it closes through that candle, probabilities heighten for price to continue to trade higher. Okay? Now, when it comes to model X, there's basically 4 steps. There's your sweep, 2, EFD, which means efficiently delivered, right? We want to see the imbalances within the stop point leg. I want to see those guys taken out. Okay, so we tap into an array, right? There's a lower time frame liquidity sweep, the inefficiency that was created as price took out that high. We turn back around and we close through that inefficiency. Third step, OBV. The order block is validated. Okay, so now how do we validate the OB? The candle that houses the imbalance within the stop point leg of price. All right, don't worry, I'm just giving you surface level. We're going to go back through every single point. But the candle that houses the imbalance within the stop point leg, right, which in this case, it would be this particular candle. That is our housing candle. All right, the reason we're identifying that candle is because if you think about what ICT says, he says the order block is that series of up close candles. Right? It's that series of up close candles. But what I kind of discovered in learning or understanding fair valuation was that I can take that particular candle, right? The candle that houses the imbalance. And I'm using that particular candle as my OB. So even if I had a series of candles that started here, right? I'm finding the candle that houses the imbalance in the stop point leg of price. And I'm using that particular candle's low or high to validate my order block. Now, how do I validate the order block? We validate the order block simply by price trading through that particular candle. All right, so I want to see a sweep. I want to see the inefficiency. I want to find the housing candle, and I want to see the inefficiency close, and then I want to see price trade through the low of this particular candle. All right, because that is at that moment where I validate my order block. All right, now, once the order block is validated, I have an OB. All right, this is my OB. Okay, but now, I don't want to take that OB for face value. I want to add a little more conviction to my trade idea. So how do I do that? Well, if I'm going to go short, I only want to go short on the sell side of a curve. Or I only want to go short when institutional order flow is bearish. Okay? Well, what does it look like when institutional order flow is bearish? Up close candle support price. Well, if that be the case, then what do I need to do? I need to see price trade back into the initial order block, because that initial order block is an up close candle. And if we're actually bearish, that up close candle is going to create a second change in the state of delivery. Okay, so we have first CSD here, closing of the fair value gap, trading through the housing candle, or the candle that offers the fair value gap, pain and state. But I also have to identify is I want to, remember, always sponsorship. I have to see some type of inefficiency. Okay? Probabilities decrease even if I get all of this entire recipe, but no inefficiency. So I want to see sponsorship. Excuse the spelling here. All right, get it. I want to see sponsorship. Okay, order block has been validated, inefficiency has been taken out. Now I want to see price trade back into the order block and create. I want price to tell me that, hey, this OB, right, is like a transfer of delivery. Okay, this OB is going to force the creation of a second OB. If that happens, then that means institutional order flow is bearish. And at that particular moment, right here, once we close through that candle, okay, and then you'll learn, once you get like on a 5-minute time frame, you'll learn when you don't have to wait on the close. You can trade the very moment price clears the low of that up close candle. This up close candle that's retesting the initial up close candle. We're watching that candle's low. When that candle's low is broken, we execute. Okay, when you're just starting out, you honestly you want to wait until that candle's low is closed through. But once you get a little more advanced, you learn and you start really understanding scenarios, you'll know, hey, I'm just going to execute the moment price trades through that candle's low. And once you see that, what happens next is typically you'll see speed. You think about what we learned in terms of high probability pricing sequence, it's the same makeup. All right, short-term high, intermediate. We trade down with speed, right? Market efficiency paradigm says that if we were still bullish, price would come to the fair value gap and keep going higher. Okay, well, what happened here is we went stops, screw the inefficiency. So it's pointing to lower prices. Okay, well, if that's the case, then I want to see price retest that order block and then trade here. Well, then that just gives me a swing high fractal. All right, so now let's look at some examples. We'll look at these examples first, and then we'll go to live chart examples. All right, so in this scenario right here, this is a Judas swing play. There's a sweep. All right, and with that sweep, instead of me taking this series of candles as my OB, right, I'm going to start my OB from that candle. That is the candle that houses the imbalance within the stop point leg. Right, this is my housing candle. Meaning that when price trades through the low of that candle, right, that order block is validated. So let's go through the steps here. Remember, step 1 is a liquidity sweep. We have that. Step 2, EFD. All right, when I'm saying EFD, that just means efficiently delivered. The reason I say that is because when we have a fair value gap, we say inefficient. So if we've closed the fair value gap, I'm just saying efficiently delivered. Okay, which means I want to see price close through through the fair value gap. Okay, right here we traded and we closed through the fair value gap. Next thing is order block validation. I want to validate the order block by finding the candle that offers the imbalance and seeing that candle's low traded through. Well, in this case, we just trade and we close through. It happens simultaneously. 2 and 3 happen simultaneously. All right, so now that I have this order block, this is my OB. I'm asking the algorithm, I'm saying, hey, algorithm, prove to me that that order block is going to act as resistance. The algorithm says, okay, I'm going to trade into that order block, and I'm going to show you that that order block acts as resistance. Here, we trade into it. Let's pause. We have sponsorship inside of the marketplace. We have sell side imbalance. All right, which is key. So the algorithm is proving to us at this particular moment, we trade into the order block. If that order block is going to hold as resistance, it is going to create or force a second change in the state of delivery. When this candle closes down below this up close candle's low, right there we execute, and then you see speed coming to the market. All right, here's another scenario. This is like a delayed protraction type of day in the London session. Here's the stop point leg of price. Right? So what we want to do is we want to locate the imbalance within the stop point leg. In this case, we have multiple imbalances. Okay, here's the point. If you have multiple imbalances, because you're probably asking, well, how do I know which candle? You just pair them as one candle. You just see them as one candle. All right. So any candle that it trades through, it counts. Meaning that, like in this case, we have an inefficiency here, inefficiency here, inefficiency here. I'm just going to see those guys as one candle. Okay. So if we close through the first one, that's good. We trade through, we close through it. So we got a sweep, 1, EFD, and efficiently delivered, meaning that price trades through the imbalance. Great. Clear the low of the candle that offers the imbalance. Order block validation. Hey, algorithm, prove to me that that order block is going to hold as resistance. Algorithm says, okay. It trades back into that order block. Right? And then back down. So I'm watching the low of the up close candle that trades into the order block. Why am I watching that candle? Because when institutional order flow is bearish, up close candles support the direction of price. So the moment we close through that candle's low or we trade through here, you can execute at that very moment. Okay, the reason I have an execution here is just you might be a guy that you don't care to be extra precise, and you know that if you get that body closure, everything should be okay. Okay, but nonetheless, that's pretty decent RR. Go to another scenario. Same idea here. This might have been from last week. We push up, taking out liquidity. What's the very first thing I'm looking for? I'm locating the imbalance within the stop point leg. This candle is where my order block begins. Notice many a times they always only come to this candle. All right, I'm not taking the series of candles, as ICT says. I'm taking the candle where that houses the imbalance. That's starting my order block. We take out liquidity, we trade lower, right? We have sweep, EFD, order block validation. Hey, algorithm, prove to me that the order block is going to hold as resistance. Algorithm says, okay. Pushes up into the order block. And the moment it trades and closes through these up close candles, we execute. We execute, price goes lower. All right, same idea here. Stop point leg of price. This candle here offers the inefficiency. Notice it's this candle that holds up, right? We never come back and trade through that candle. We close the inefficiency, EFD. Trade through the low of the candle that offers the inefficiency. That validates the order block. And now I just want to see price trade back into the order block and then trade lower. Now let's talk about this scenario because it's kind of cloudy if you don't already understand this. You see how this candle, this up close candle trades into the order block? And we be watching the low of that candle, right? Well, the moment we get a down close candle and then a new up close, a higher up close candle, that basically restarts the delivery. And I have there's some clearer images coming up to help you understand what I mean. But it restarts the delivery. So now I'm watching the low of this candle. And every time that happens, it restarts the delivery. Now, in this case, instead of going through all of that, saying, hey, the delivery just restarted, just take the low of the initial up close candle, which is why I have an execution right here. Okay, you don't have to be super duper precise. This is precise enough. So there's response. You're seeing Model X is you allowing yourself to see order flow transition, okay? But understanding where the actual order block is. It's like a transfer of delivery. Order block, second chain of state of delivery. Execute. Speed. Okay. Here's another example. Now you can't see, I don't know why I have this so zoomed out. But here's a sweep. In yellow, what we see is an inefficiency. We close through the inefficiency. We trade through the low of the candle that offers the inefficiency. And then you can see that small up, you see that up close candle trade back into here. All right, once that occurs, second change in state. Now, in this case, we didn't have any imbalances. So, maybe you wait. Or maybe you're aggressive and you just go ahead and execute. Maybe you trust the whole trade idea. All right, but there's an institutional order flow entry drill right here. And this is a scenario when you would take it. Okay, so see, these are some of the better images that I sent in the group for you guys to study. Step 1, sweep. All right. If you can write on the screen, guys, just mark out your housing candle. Which in this case, this is an easy one. So the housing candle would be this down close candle. Okay. When that down close candle, I'm watching that candle. When this candle here closes and we have an inefficiency, I'm watching that down close candle. I'm literally watching that fair value gap. Once price trades and it closes that fair value gap, that's literally step 1. EFD, not step 1, but step 2, because step 1 is the sweep, right? Step 2, EFD, efficiently delivered. Okay, well, now I want to see the high of the candle that offers the imbalance. I want to see the high of that candle traded through. Once that occurs, order block validation. Now I have to ask the algorithm, hey, algorithm, prove to me that that order block is going to hold up as support. We trade down. All right, this is another scenario where the delivery restarts. We trade down and then back up and then down again. Okay, so we can go from this candle. Once we trade back through this candle, we execute, and then you see speed. All right, there's no market structure involved in this. I want you to take your attention to this area right here. All right, and this, because this area right here is going to show you why that part here, which is what we call IOFC, institutional order flow confirmed. This scenario shows you why that's important. Okay, so imagine you only saw this, right? You saw, at this point, you see liquidity sweep. Now, you have a liquidity sweep. You're watching this imbalance. That imbalance becomes that's the housing candle, right? The imbalance within the stop point leg of price. Price trades through, closes through the imbalance. That's EFD. Trades through the high of that candle. That's order block validation. In the chat, I want you guys to tell me what is the last step. Why are we not executing here? So we had the OB, the initial OB. That was validated. We should have more answers, guys. Yes, you are correct, right? So what we don't have in this scenario we'll walk through one more time. Remember, sweep. After I get a liquidity sweep, I'm looking at the imbalance within the stop point leg. That imbalance is within this candle, right? That candle becomes my housing candle, meaning that it houses the imbalance. That candle is important because I can start my order block from that candle. Then I only want to see three more things. I want to see the inefficiency traded and closed through. I want to see the high of the candle that offers the inefficiency traded through. And from there, we have to confirm order flow. I want, in this scenario, what we would have needed to see is for price to trade back down into this candle. And then back out. At that moment, algorithm proves to us that order flow is bullish. We never got that. Happens is it continues to trade lower. Now, the difference is this here. You're actually seeing order flow confirmed. And here's another example. Very small inefficiency inside of there. But nonetheless, we run and we take out liquidity. Step one, there's a sweep. Step two, I want to locate the imbalance within the stop point leg of price. Well, at the closing of that green candle, we have an inefficiency here. So this becomes my housing candle. Right here, the imbalance is negated. Right? So we trade and we close through the imbalance. We also trade through the high of the candle with that offers the imbalance, right? So in that case, that validates the order block. The EFD, order block validation. Now I want to see down closed candles trading to the initial OB. If we trade through those down closed candles high, that confirms order flow. We execute, price gets away. In this case, we're just allowing that candle to close. Another example here. We trade down through a sell side liquidity pool. Step one, there's a sweep. After this sweep, I locate the imbalance within the stop point leg. This is my housing candle. Once price trades and we close through that inefficiency, which is here, okay, at that moment, I got EFD. So whenever we see, I'll always mention this, whenever we see price take out liquidity, you want to see it. You would rather see that liquidity run out with speed because it allows you to leverage what price does to that inefficiency on the opposing side of price. This candle here is the candle that I'm going to use to validate my OB. Once we trade through the high of that candle, the order block is validated. From there, I'm just saying, hey, I want to see price trading to that order block. And if a second change in state of delivery is created, that confirms institutional order flow. And then we see speed step into the market. Another example here. Sell side liquidity pool. We run, we take out that liquidity pool. Even here's another example. Here's an example here of why this fails. So we run, we take out liquidity. All right. Initially, we'd be looking at the inefficiency. We close the inefficiency, we trade through the high, we get an order block, so we get EFD, OBV, but what never happens? Price never trades down into the newly established order block. It then goes here to confirm order flow. It never happens. We continue lower. The imbalance gets negated. The high of the candle that offers the imbalance is traded through. And then you can see a down close candle trade back into the order block. Once we clear right here, IOFC. And then we see speed step into the marketplace. So you're literally executing the moment we trade through that candle's high. Same idea. All of these will look exactly the same. Liquidity sweep. Once we get the sweep, I'm locating the imbalance within the stop point leg. This guy right here. This moment, we negate the imbalance. We trade through the low of the candle that houses the imbalance. So we have EFD, order block validation. Now I want to see price trade back into the order block. And once it clears the low of this candle, confirms order flow, and I can execute this very moment. Then we see speed. Another carbon copy. Liquidity sweep. Once we sweep, I'm watching that candle with the inefficiency. Right here, we clear the opposing imbalance. That was EFD, order block validation, trading through the high of that candle. So when it comes to order block validation, you don't need price to close through the high of the housing candle. You want to see it trade through. When it comes to EFD, that's where we actually want to see price close through the inefficiency. And then trading through the candle that houses the inefficiency is all we need. All right. And then when it comes to IOFC, the highest probability is when you can allow price to close. All right. But in certain cases, as you gain more experience, you'll know when you can go in and you can execute right away. Maybe there's a VPR to the left of price, because certain scenarios will be different. All right. But in a nutshell, those 4 components are what you're going to see almost every time when that price is getting ready to turn around. And if you don't see it, fine. Because seeing it is enough within itself. Not seeing it doesn't mean force it or find a way to see it. And just understand that seeing it is enough within itself. All right. So EFD, order block validation. Order block validation. Down close candle to retest the order block. Right here, second change in state of delivery confirms institutional order flow. And then we get speed. We look at that one. All right, we'll go to an actual chart and do this as well. This is our model X as well. So you see that liquidity sweep, and then we're locating this as the housing candle. All right, we close through EFD, order block validation once we trade through the housing candle's high, and then right here confirms institutional order flow because we trade and we retest the order block right there, second change in state, and then price plays around for a little bit, and then we get speed. Okay, now what time frames are Monolix? I wouldn't say more efficient on, but I would say the 3 and 5 minute time frame is the most durable. All right, because you're not in so much of the noise, and then you're also not missing a lot of what's on the higher time frame. Can this be used on a one time frame? Yes, guys use it all the time. All right. However, a lot of times when you're owning 1 minute, you don't need to use a 1 minute. You don't need a 10R. But a lot of times if you own the 1 minute, what happens a lot is this. Price may trade up into an array with speed, and this may be your 5 minute view. And you're not noticing that there's a 5 minute inefficiency right here. You're so focused on the lower time frame, and you see sweep, EFD, order block validation here, and then you go short, and you're basically going short right into a higher time frame fair value gap, which is another filter, a key point, right? Always identify if you're getting ready to take a short or if you're getting ready to take a long, look and see if the delivery that you're seeing on a lower time frame, you might only be seeing that delivery so that price can reach into that fair value gap, and then it might give you something like this. So your perspective was, momentarily it was flipped. It was just on the wrong side. Okay, let's go to a real chart. Let's look at last week and see what we can pull from last week. I think we might have saw this in the first examples. All right, so this is on a 5 minute chart. We're trading up. We traded into a 4-hour order block. This may be the opening price of that OB. Let's see. Yeah, opening price is right here. I was almost there. All right, so on the 5 minute chart, we traded up into a higher time frame PD array. And how do I know if price is truly wanting to, if there's truly going to be a change in state, or if we're going to actually reverse? All right, so I'm reading this, I'm watching price. We get here, here, and I'm looking at this inefficiency within the stop point leg of price. We trade down, we close through that inefficiency, we trade through the low of the candle that offers the inefficiency, and then what happens next? Up close candle trades up into the order block. I also have sponsorship. The moment we trade through that candle's low, we can execute. All right, you can go here or you can wait on the close. All right, the more aggressive approach is trading once it breaches the low. The more conservative approach is actually allowing it close, which, probabilities are always heightened that way. Okay, but this is how you'd execute here. Okay. All right, here's another example. Let's say you didn't get in on that first entry and you didn't even, you come to the charts late. Same idea, same fractal. Sweep. Inefficiency is here. At that point, EFD, the order block is validated. Now I want to see up close candles trade back into it. You trade into it, and I want to see those up close candles breached. You can execute again here, place a stop here. This is a high resistance signature that ultimately creates a swing high fractal. You could also see that as daily range. Okay. Let's just continue to scan through. All right. So no model X right here. All right. In those events where, let's say you get a sweep and price just continues to trade lower with speed. All right. And let me pause. I said no model X, but technically in theory, it's here because if you saw that as the whole OB, and then, you know, you could execute there and go lower. But maybe you don't want to take so low of an entry. Well, if there's no, let's say you were marking this off as your, you know, this is your OB, your housing candle, all right, and price never really comes back to that area. It just continues with speed. Okay. What you want to find is you want to find those balanced price ranges. And just use a market logic execution. They don't have to be a robot and say, oh, I have to see a certain image of model X every time. No, if you know that that range is here and we've just traded into an internal range PDA rate and it's time to go back external, don't be a robot. Execute where there's logic. Okay, right inside of this area, we go back and forth a few different times. So trading through that area with speed and closing and providing a sell side imbalance, that's the means for execution. Go to pound USD. All right, here's a scenario on pound where we have a higher time frame imbalance. Trade down into that imbalance. We clear out liquidity, and then I'm locating the imbalance within the stop point leg. This candle. High of that candle validates my order block. Once the high of that candle is traded through, once we clear the inefficiency and we trade through the high of that candle, I have EFD and order block validation. The order block is validated. Now I want to see that institutional order flow is bullish by seeing these down close candles supported by the initial down close candle. Okay, at this moment or this moment, I can execute and what steps into the marketplace? Speed. I think that might be almost a 1 to 3, which is decent. Okay, Model X can be seen here too. I'm not saying that I would take an execution here, but it's the same ingredient every single time. Well, actually, we might need to go to a lower time frame because we always have to find an inefficiency on the left side. Okay, perfect. All right, so here's a scenario where we're taking out, we run and we take out the Asia session low or the New York session low. There's a liquidity sweep. Notice on this side, I can't find an inefficiency, so I'm not really concerned with this. Right here, even have a balanced price range here as well. We run lower, we take out the low of that the short-term low. We have an inefficiency. EFD, order block validation. Now I just need to see a down close candle trade into the initial order block. And the moment that we close here or trade through, say you execute here, most times you're safe with stops. Wherever the candle that offers the last inefficiency, most times you're safe below that candle because if price is truly bullish, it won't really run back down through that candle because you should see speed. Now you don't have to take that approach. You can be conservative. All right. Most times I'm more conservative than aggressive. You can be conservative and just take that type of stop loss. All right, and price trades away. But I'm just showing you guys that process, that same pricing process, right? That occurs a decent bit of the time whenever price is actually turning around. Right? Even here, if you were watching this, let's say this was not your time window for coming into the market. We get into New York open kill zone. There's a liquidity sweep. You're already expecting a reversal. Right? You have a slight EPR here as well. Inefficiency, EFD, right? Order block validation. Okay, now in this case, do we come back to that candle? No, we don't. I can still see this area, right? Because if I click on the higher time frame, you're going to see this as one whole candle. Price is just coming back to fair valuation. Comes back to fair valuation, and then we breach the low of that candle. You can execute at that point. All right, same idea. There's a liquidity sweep. There's your imbalance. Here within the stop point leg, we trade through, we close through, we trade through. Up close candles are retesting it, and we trade through those up close candles. Right, executing here, stops are up here, and then eventually we get speed to a predisposed target. Here's another example. There's liquidity sweep, right? We're inside of a kill zone. There's an imbalance within the stop point leg of price. You can view this as your OB. In this scenario, I'd probably take the entire range, or at least down to here. But nonetheless, the rules apply. Inefficiency within stop point leg, order block validated, efficiently delivered here. And basically, you're just seeing a redistribution occur from the newly established OB. Okay, so you can either execute at this point, or you could wait. Maybe you didn't trust it, but you saw another redistribution. You execute there, and then you get speed. Right. I guess what we'll do here is, we'll open up to the questions. Scan through this very quick. Swiss had a scenario this past week, right up here. Okay, with Swiss, we were taking out previous day's high. We also ran and we took out London session high. Once that occurs, I'm watching the inefficiency within the stop point leg, literally right here, EFD right here, order block validation. And once I see an up close candle trade back into it, bingo. We see price get away. Same process every single time. It even occurs here. OB, retest the OB, another change to B. So it's sweep, inefficiency cleared, OB established. First OB forces the creation of a second OB, which in turn creates model X. Creates swing high fractal, which also creates a high probability pricing sequence, so on and so forth. Okay. you can see it right here as well. Even though this is not a kill zone, EFD, order block validation, right? Institutional order flow confirmed. All right. So let's open the floor up to questions. Just so I'm not, continuously rambling. Limey, are you there? Yeah, of course I'm here. All right.
This is William. Are we open to questions?
Yeah. Let's go ahead and let's go with some questions.
Okay, thank you, John, for the delivery. Now I have 1 or 2 questions. So between the 3 models, the market logic, the institutional order for real, and model X. Now I've seen, like in most cases, even the last example of Swiss, if you look at that, the model X happened at a bit top of it, of that range, at the top of the sweep, I can say. Then there's a rate of BPR down there. Now, I've noticed in several examples, when you have model X at the top, you have BPR lower. Now, we also know that you can use BPR for the market logic execution. So my question is, do you have like a condition that could say, okay, in this particular setup, I go for model X, or in this particular setup, I use market logic, or you just go with the flow depending on how to find. I don't know if it's clear.
Yeah, great question. So it's like a flow, right? Once you show up and you do this enough times, you'll kind of automatically kind of get in rhythm with that flow. But basically, initially, I'm looking for Model X. All right. Initially, I'm looking for Model X. If I show up and I have a range of price and we've traded back inside of the range, order flow is bearish, and we're running into that PD array, my mindset at this very moment, my mindset is Model X. Okay, now I'm going to adjust because you can't be a robot. You're not going to get the same. You're not going to get the same scenario or the same experience in every single trade. All right. So I'm thinking Model X, right? I'm anticipating Model X. I want to see sweep. I want to see the order block validation, the imbalance negated. I want to see the institutional order flow confirmed. Well, let's say as price traded up, we kind of hung around right here. All right. Well, I might still look for Model X, but I know I got a BPR right below me. So if Model X occurs here, maybe we go EFD, OBV, right? Institutional order flow confirmed. I'm not going to take that execution just yet. Why? Because it doesn't make sense for me to take that execution. There's a BPR. I can sacrifice R for the sake of me placing myself in a more highly probable scenario. So then if we trade and we close, through that BPR, all right, price is showing no concern about that BPR, then I'm going to execute. Now, if that BPR doesn't exist, we trade into that PD array and we get all of the steps of Model X, I'm executing and I'm expecting speed. Does that answer your question?
Yeah, exactly. Thank you so much.
All right. I think you said you had another part to the question as well.
Actually, it was 2 in 1. Thank you for answering that.
Okay. Cool.
Yeah. But I wanted to go to this example of Swiss, so just do that explanation.
Okay. Next question.
There's one there, Chris. It was from Jovan. He said, when we use market logic, do we wait for the market to close above the highest wick of the BPR, or do you wait for a closure above the body of that BPR? Because we usually mark the BPR bodies and the wicks out a little from that box.
Yeah. So great question. All right, let's go back to that scenario where we had Euro USD. Because Euro USD gave us a BPR. It might have been 2 weeks ago. It's fine. I think this is it. All right. Now, here's how I'll answer that question. Will you ever be will you ever be wrong for allowing for only taking it once price closes below the full range in terms of the actual low of these candles? No, you'll never be wrong. All right, the next part to that answer is, are you able through experience to get to the point where you know that, hey, I can execute right here? Right? Because this is fair market value. We ran up, we reacted to a higher time frame PD array. And at this scenario, right? That's why I always say there's no scenario is going to be the same. Which is why I'm going through those different modes of execution for you guys so that you can be aware of them, in every scenario. Because if I were to just go right into Model X, which we have done in the past, go right into Model X, you're not going to understand how to be or how to turn on necessary filters and how not to be a robot. So for this scenario, even though I'm executing here, you might say, well, it hasn't cleared the BPR or it hasn't traded completely below the BPR right here. Well, what I'm basing this off of is the fact that I've had sell side imbalance step into the marketplace, right? Up close candles are supporting price. Okay, so this is market logic. What are the chances? They were clearing out these down close candles. We traded through fair market value. So in this scenario, all right, I'm gonna go in and I'm gonna execute. Next question.
I guess I had a quick question.
Okay.
Would you recommend finding structure on a 5-minute and then dropping down and looking for the displacements below that?
Could you ask that one more time?
Oh, just it's best to look nothing below a 5-minute, right, for structure. And then I'm noticing like sometimes on the 5-minute you won't see the displacement, but you'll see a clear sweep of a higher time frame PD array, for example, and then dropping down 3, 2, 1 to find the fair value gap. That should be our approach, more or less, yeah.
Well, what we're doing here is I'm trying to see how I can answer this the best way. You're already in execution mode. All right, at this moment. So you're already on a set time frame and you already know exactly what you're looking for. So in this case, I don't know if you're saying you're not seeing the imbalance over here.
Yeah, like the scenario is likely, but because I'm on a 5-minute, I don't see the imbalance, and so I do want to drop down and look for it, I guess.
Oh yeah.
Okay, that's all.
Yeah. So yeah, you can walk the time frame, right, for the sake of having getting that visual that you want to see to confirm. However, I'm gonna say you'll be a lot more consistent if you get super familiar with one time frame. Doesn't matter what that time frame is. It's just that what I found is when guys get in the habit of walking the time frame, right? You're on every single time frame and you're not really getting in sync with a particular time frame. And it's typically because FOMO, right? You think, oh, I'm gonna miss out on this trade. If you don't see it, you just don't see it. It's fine. Seeing it one time is enough. So I would say my biggest encouragement is find a time frame. If it's a 2-minute, if it's a 3-minute or 5-minute, get so familiar with that time frame and all the intricacies of that time frame, because you'll be more in sync as opposed to, okay, on this scenario I was on a 1-minute. This scenario I was on a 3-minute. Well, this scenario I'm on a 4-minute. It becomes a lot more cloudy when you do that. But through experience, you'll find I've seen it 1,000 times where guys they jump into it, they gain a lot more experience with it, and then all those questions and those all the gray area kind of clears up.
Yeah, thanks, man. That's great advice. And you're right. Your eyes will start to see it. I think after I had the benefit, obviously, of getting the VIP beforehand. And exactly. Your eyes will see it.
Okay. No, you're spot on. Like you certainly want to get familiar with a time frame, And then, and will there be times where the visual is on a different time frame that might not be the time frame that you look at? Yeah, that might happen. Will it cause you to miss out on the trade? Yeah, that might happen. But if I said, hey, what feels better? Missing out on the trade, not making money, but also not losing money, or doing something that's outside of the realm of your usual practice and then losing money. I think it would hurt a lot more if you lost, doing something that's outside the realm of your normal practice. So there's times where you'll have to just throw some trades, or not not execute. Next question.
There's one here from
Hey,
Sammy.
Chris.
Oh,
Hey, go ahead. You can keep going.
Hey, oh yeah, this is Heriberto. So the issue I have is how long to lead the trade out, because sometimes when I realize myself, if I do 15, 20 pips, I'm making money. But if I try to make the 30, 35 pips, this is when I start going crazy. So on some situations that I see, it went down like 15 pips and then it came back up. So like, you get that FOMO situation where like, oh, should I get out or should I just let it ride? So is there like a more or less like how many pips you let it ride before you say, okay, I'm wrong?
Yeah. So that is gonna be relative to where the draw of liquidity is, right? So
Yeah, because I noticed on some draw liquidity, I let it go and it'll keep going. It'll take it out and it'll keep going down. Then it'll go to the second draw liquidity. That's when it starts, like ranging. But sometimes, you get that first draw liquidity, it may hit, but it'll range and then it'll go down. So the question is like, when do you know when to let it ride and when do you know when to say, okay, maybe I'm taking 10 pips and I'm out?
okay, I got you. I just caught you. I just basically caught it at the end of that question. All right, let's go to because I took a short Monday of last week, and was it Monday? No, maybe it wasn't Monday. It was a short that I took. I think it was, yeah, this day? It was one of these days last week where pound USD went short. I don't know why I can't find it. It was New York session. Maybe it was this day. I'm not sure. All right. So the easy answer to that question is, if you're a guy where you don't feel, you're not a guy that wants to hang on to a trade. All right. And this is going to be because all of us are unique. We have different levels of risk acceptance, risk tolerance. If you're a guy that says, hey, I don't really like to hang on to these trades, all right, because there's no way to know outside of order flow. There's no way to know if price is going to get through this low and then turn around. This is the day. This is the actual day that this happened. This would be a scenario what you're talking about, right? It goes to the first draw of liquidity. I actually went in one more time inside of here. So this was a day where I took an institutional order flow entry drill on top of me executing up here. I took a market logic execution up here. All right. Well, we got the run, and I'm thinking, all right, we've called out lower prices for the week. We should get that run to discount or raise. But then price goes to this target, the very first draw, comes back inside of the range, takes that out, and then the entire trade is completely thrown off. I can't plan for this. Well, I'm not gonna say I can't plan. I can't predict this. Right? There's gonna be days where this happens, and there's gonna be other days where it runs away. But you have to decide based on who you are as a human being, as a unique, trader. You have to decide what guy you're gonna be. You're gonna be a guy that just takes low hanging fruit. Maybe you take 1-to-1s, 1-to-1.5s. You're in and out of the market. Or you're a guy who says, hey, I want 2R, I want 3R. I'm okay with the days that it runs and then comes back and hits me break even. But there is no one objective answer to it. It's more so you as a trader. Over
Gotcha.
time,
Yeah, because I also use trailing stops. It does help a bit, but of course, for some reason, you know how market makers are. They just want to like bring it back to the point of beginning and then it'll drop. So that's why,
yeah,
and it does it like twice. So then you don't
yeah.
know.
I'd say if you're trading on it like from an intraday perspective, and this could just be my experience, but with trailing stops on an intraday perspective, that to me it's not a really good practice because there's so much noise. Now, if you were swing trading, right, and you were doing trailing stops, I say cool. But I think on an intraday perspective, you're asking yourself to get stopped out of scenarios you don't have to get stopped out of. Because here's the thing: what you'll see with Model X is don't worry so much about the times where it runs and comes away and hits you at break even, because there's going to be a lot of times where you execute and it just runs with speed. And you just have to be present for these opportunities, and then the days where it runs and just comes back and hits break even, you just live with it. Don't force yourself back into the market. Don't overtrade. Just the name of the game is survival, right? Protect your equity, and live to see those days where you get those great market movements.
Gotcha. I appreciate it, Chris.
Yes, sir.
Hi, Chris. I have an additional question to that. I remember, this is William. I remember in one of the presentations, I don't remember which one, you say that, for example, there was an opportunity in New York, and you say you look at the range, and the range was exhausted, so you would not want to get in. So I wanted to know, like, okay, when you say the range is exhausted for the day, like, what do you mean? That also, like, to the range option.
Yeah, so basically every day that I wake up, right, or any of us, right, when we wake up, we gotta know, we have to know what the 5-day average daily range is, okay? And let me take you to a scenario from February where things were exhausted, and we basically I actually I didn't follow protocol. I didn't wake up. I didn't check the market as I should have. And I want to say it might be this. Yes, exactly. All right, on this day. Okay. So now typically this is what I love to see these types of scenarios, right? Where there's expansion in the London session, maybe price can keep going lower. But this is like when I see this type of day, this is where I'm like, okay, cool, this is my day. All right. However, the ADR is exhausted, meaning that whatever that average was for those 5 days, right? We've basically, before we've even gotten to New York, we've pushed beyond that average. So immediately the chances of price continuing this way have decreased. Right? Chances of price continuing have decreased. So I'm not gonna look for an OTE Model X entry to go back here. I'm not gonna look for it because ADR is already exhausted. Chances of me getting a continuation have decreased. Now, can I use that idea of an exhausted ADR to my advantage in terms of actually taking a trade? Yes. Let's imagine that order flow is already bearish. Okay, and here's the previous day's high. You have your Asia session. London opens. In London, we exhaust the ADR as we run into the New York session in a market where order flow is already bearish. Well, this is what I want to see because I'm expecting price to turn around anyway. I don't expect it to keep going higher. ADR is exhausted. Previous day's high has been taken, and we're trading up into higher time frame institutional order flow, up close candle support and price. This is beautiful. Now I'm looking for Model X in this case. Model X, market logic execution, doesn't matter, right? Things are in alignment with, higher time frame order flow. Does that answer your question completely?
Yes.
Hey, Chris.
Yes.
When you say in that same example, I'm noticing that the market moves almost 100 pips in that example. So that's what you mean by ADR being exhausted?
Yes, yes. So basically every day, so you guys can get this indicator, Judas Daily Me or whatever it's called. But every day you wake up, you should check. You don't have to leave this on your chart. But if you do, it makes it a lot easier. But you want to know if the ADR has been exhausted or not. If the ADR has been exhausted, and you're wanting to take a continuation type of trade, continuation trades are lower in probability if the ADR is exhausted. Reversal trades, right, become higher in probability if ADR is already exhausted.
Have you explained the ADR before?
Yeah, in previous lectures. It's kind of, at times it's built into, if we're doing a trade breakdown or something of that sort.
All right.
Mm-hmm. Is that Kevin?
Yes, it is.
Okay, cool. We can speak about it on the once we have another one-to-one lecture.
All right.
Yes, sir.
Just reading out a question here from Sammy. He or she said, sorry, I don't know if it's a male or female. Would it be good to look for a 15-minute IO Fed entry and to wait for 1 minute model 1 minute model X to happen to take the execution, basically combining two models?
Okay, so looking for 15-minute. Let me go back to the chart. Is this the question? No, that's not the question. Oh, would it be good to look for M15 LFED and wait for one model to take? Yeah. So you could do that, right? But what I'm gonna say is whatever practice, because you could take this stuff and you could tweak it to your. I've seen guys do it 1,000 times. Right? I have one guy from one of the old boot camps. All he does is he just simply trades BPRs. That's all he looks for. So for you guys who don't care to hold on to trades, all he trades is he looks for this type of scenario, this where there's a BPR and he's taking a 1-to-1. He does really good at it. But what I say that to say you could combine these teachings into your own liking. So maybe you're a person that maybe you only want to trade 15-minute scenarios where there's 15-minute fair value gap created. And yes, you could go in here. Now, are you gonna get the perfect model X scenario every single time on a 1-minute chart here? No. But there's other things you could use. You could see price react to the 15-minute fair value gap. Maybe on a 1-minute chart, you get a BPR that goes here. All right, we leave the BPR with speed, you execute. Another scenario could be maybe price trades into here, right? And then we go here, and you go higher time frame IOFED to lower time frame IOFED. There's so much you could do, but what I will say is objectify your practice. Don't be all over the place. Don't try to use everything, because we're all different and we all have our own tendencies, our own habits, and certain things that we like, and you have to find that out for yourself. Next question.
There's one here from Anjali.
Okay.
She said, "Hi, is it important to place the stop loss at the end of the swing point?" Because she was saying, "I tried this, but mostly it results to a big stop loss. She feels really scared to trade when the stop loss is a bit big. So placing stop loss few points above or below BPR, does that help?"
In terms of BPR or just any scenario?
I think she means any scenario in this case.
Yeah. So here's what I'll say. All right. This is where, as traders, we have to become like data scientists. All right. You have to become your own data science. The best answer is the answer that you gain through data. All right, through sample size. So if you go for the next 30 days or 60 days and you place your stops, right, maybe at the high of the last candle that offers the imbalance on the right side, and you test that out and you see and you go back and you look at your data or your metrics, and then maybe you go another 30 days and you place it above here, right? You might actually find that you're a lot safer going up here, which is, I think we all can agree, you're obviously going to be safer above the high. Okay, but you have to go in and you got to test that for yourself. But my answer to that is yes, you're always going to be safer above the high. I would also say don't get into a habit of worrying about how many pips a stop loss is. Trade what makes sense. We're not always here to catch the highest RR. We're not always here to catch the most precise entry. We're here to take advantage of opportunity. And a lot of times, I read this in a book. Vision actually sent this to me. It was in The Psychology of Money. But the guy was speaking about, he said most scenarios, you're not actually wrong, right? A lot of times you're right. It's just that you required that decision to be absolutely right, right? You wanted everything to be right. How many times we get into a trade, it actually goes in our direction and we're like, oh, I had my stop loss too tight, or oh, I tried to get too much out of that trade. Maybe if I would have just closed the trade, I'd have a different conversation. Next question.
So there's a question here from MJ. What is your advice on higher time frame to look for a sweep and execution time frame?
One more time.
So MJ said, what is your advice on higher time frame to look for a sweep? And I think he or she is asking for like the execution time frame.
From a higher, like, I think the question is a bit too broad. What is, can that person speak? Can you unmute your mic? If that person can unmute, so we can kind of, I want to make sure I answer that question. It's tough to do it, but just reading it here.
Can you hear me now?
Yeah, it's a bit low, but I can hear you.
Yeah, sorry about that. I'm just want to know, basically I want to know basically that if you're looking for a high time frame, say for example, what would you suggest, like the hour or the 4 minute or the 4 hours? Then what time would you take the execution? What time would you take the trade? That's just advice, just want to know.
Okay. So basically 4-hour PD array, you're saying what time frame would I look for? Like if this is a 4-hour fair value gap, are you asking on what is the most optimal time frame to look for, maybe Model X or something inside of here?
That's correct. Yeah, that's correct. Thank you.
Yeah. I think, on a it won't matter on a 4-hour, even if this were a 1 hour. I'm always gonna say 3 to 5 minute chart, 3 to 5 minute time frame. So it won't necessarily matter. It's not like, hey, on a 1 hour you can only look for 2-minute executions. But I don't think there's anything wrong with that. If you go and test that and you find that it works for you, then apply it. It's not gonna change anything about the base ingredient that we're using to execute or to confirm if there's gonna be a change in the state of delivery. It's just whatever you do it consistently. But my answer to that is it doesn't matter what it doesn't matter if it's a 4-hour time frame or 1 hour or even a previous day's high. A 3 to 5 minute time frame looking for Model X is pretty efficient.
That's great. Thank you.
Mm-hmm.
And probably the last question I can see here, Joven was asking, when do you actually go break even on a trade?
All right. So break even for myself it's gonna depend on where the draw is. Okay. If there's a 1 to 2 on the table, right? I'm expecting 1 to 2, then maybe at 1 to 1 I'm break even. Okay, but as mentioned for myself, so sometimes that becomes discretionary, right? It depends on the scenario, on the situation. If I know I'm trading in line with higher time frame institutional order flow, right, then I may respond slightly different than a counter trend trade, where that maybe at the beginning of the week order flow is bearish, obviously bearish. This is the new weekly opening price. And then I'm trading up. I know that I'm taking a counter trend trade up to that fair value gap, right? I might want to go break even a lot sooner, as opposed to me trading away from that fair value gap. Okay. I might let it run to 1 to 1.5 before break even. I might be a little more aggressive in how I actually hold this trade or approach this trade, because the conditions are different. Here, anything can happen. Here, I have higher time frame order flow, basically backing me in this case. But I think the hard answer to that is, or the more objective answer to that will come from yourself. Because as mentioned, all of us have different risk tolerances. All of us have different levels of patience. And then you might be a guy who wants to build a complete career around 1 to 2, which is great, which is awesome. If you're building that career around 1 to 2, you might go break even at 1 to 1 or 1 to 0.7, right? It's just, you got to build those rules in, and you have to basically live by them. Any additional questions, guys? Please don't be afraid to ask.
I had a non-technical question. I apologize for. I really like the forex price action. Does anyone know if there's a prop firm that uses TradingView directly, or do we have to use social trading tools, or how do I approach that? Because I'm only traded futures.
I think, sorry, Chris. I think Funding Pips use DX Trade, and they're crossing over to TradingView.
Yes, sir. Thank you. And then I just want to say, hey, man, thanks for the practical advice. Sometimes that's even as valuable or more about than the technical stuff, right? Because just, I remember when I was trying to trade every ICTpedia rate, and yeah, that's real talk, man. To find a model that, so yeah, thank you, man.
Oh yeah, absolutely. Absolutely. Thank you for the recognition.
Hey, Tris, I'm going to add to that prop firm. How about for U.S. clients? Because if you notice, all these U.S. prop firms or U.S. clients-based prop firms are going out of business.
I'll let you guys. I'll leave that to the chat. There's a lot of smoke within the space right now. I don't think it per se has to do specifically with just US. There's been a lot of different scenarios, but the easy approach is to say, hey, US is going out of business in terms of prop firms. I have not seen any statement from the CFTC. I always say it wrong, CFTC or FC, however you say it. I've not seen a statement from those guys or the SEC as it relates to prop firms. We did see a statement with those guys when it came to my Forex funds, my FF, the old prop firm. So my only statement to that is if they're going out of business in the US, why haven't we seen an immediate statement specifically about this where there's no gray area? I'm not a gray area guy. It's either it is or it isn't. And I don't think anybody has an objective answer on that just yet. But I'll leave
I'm just looking for,
yeah, I'm sorry, go ahead. I didn't mean to cut you off.
No, it's all right. I'm just looking for a prop firm that actually gives you real money if you pass the challenges. That's what I'm looking for.
In terms of like an A book, that would be called A booking. I don't think there's any unless you go with somebody like Darwin X. I don't think there's any prop firm that would A book you. That no one would A book you right away. It doesn't.
Right. No, I understand.
Yeah.
But I'm just seeing if there's anyone. I'm gonna switch to futures. That's what I'm gonna do. There's a lot of talk about it. I did some research, and I think it's the best way to go right now.
Yeah. Anybody have any additional technical questions? Here's a Model X trade from 2 weeks ago. All right, you have this range, price is pushing up, taking out the high, inefficiency, EFD, order block validation, IOFC.
There's one also, Chris, on Monday or GU. I think I took that trade. This
GU.
yeah,
Oh,
Monday. I think that's a Model X trade.
Previous Monday, the Monday from this last week.
Yeah, was from the 25th.
Oh, you said wait.
25th. I think you're on our replay.
I'm sorry, I didn't realize I had the replays too long. It was a New York session,
It was in London.
London session. Okay.
Yeah, Monday the 25th. Yeah. I think you're replayed on the 22nd.
Age 26. All right, 20. All right, I'm sorry.
It's a bit messy, but I got in on that trade.
Here?
Yeah, after the big displacement lower, I got in on the trade. Cause I was open high, low close for the weekly range. So I was anticipating like Tuesday or Wednesday high of the week.
So you took shorts here or
No,
long?
I took longs.
Okay, okay. Oh, okay. You were saying open, high, low, close. Okay,
Yeah, open high, low.
yeah, I like it. Right, you were understanding the order of operations. So you're trading the open to high part. I like
Yeah.
that. Yeah. Okay. Cool. And then London session, you're seeing Model X. You can see right here, even though we take out liquidity, right? We have the first three ingredient of Model X, but guess what? We don't get IOFC, so we don't take it. Then you saw the sleep, right?
Yeah.
EFD, order block validation. And then right here, we trade above that second candle, proving to us that down close candles are a support price. Was your execution at this very moment?
I had one. I went a bit aggressive. I had one underneath, and then my scaling was on IOFC, so I scaled in with a smaller risk on IOFC.
Okay. Were you on a 5-minute time frame or lower time frame?
I was on the 5 minutes. I was anticipating a type 2 dealing range.
Okay, gotcha.
Because there was equal highs left on Friday.
Perfect. Yeah. These guys here.
Yeah, exactly. There. That's where my TV was.
Yeah, that's perfect. That's beautiful. That's well done. Below the midnight opening price. Midnight open is here. So we're in discount relative to midnight open. And you got Model X. Speed. That's well done, bro.
Thanks, Chris.
All right. Any additional questions, guys? I say take advantage. I'm chilling right now. You guys got questions?
Hi, Chris. Am I audible? Is it?
What was that?
Are you able to hear me? Is it?
Yeah, I can hear you loud and clear.
Okay, that's great. Thank you. So the buy template and the classic. So you have those intraday profiles and the weekly profiles, right? Do you consistently align your trade decisions with these templates before executing the trades? Is it?
Great question. So after I've gone through and I've gotten institutional order flow, right? And I understand where the draw of liquidity is. Okay, so let me take you back. I think a perfect scenario for that answer would be here. All right, let's go back to early February. Okay. Now, this is early February, and I knew that price where was attacking that previous month, that monthly city. They were attacking the monthly city. Now, as it relates to a profile, just bear with me. Right. All right. So as it relates to a profile, in this particular case, because I know we're trading down to that monthly SIBI, right? I'm expecting, or once I wake up, it's not that I'm anticipating a profile before the day happens. It's more so me understanding the relationship between certain time windows, right, and price that allows me to have certain anticipatory skills. Excuse my spelling, right? So I'm using time and price. Once I wake up, I'm looking at the relationship between the London session and New York session, right? More so, I'm looking at the opening prices of those sessions as they relate to the Asian session. These are the specifics that we'll get into, and you guys will have some really objective stances in terms of trading New York, trading London. All right, but once I see, hey, this is I've marked off time, right? It's my opening prices, and then price. I'm looking at where those opening prices are relative to the Asia session. I'm using that info, that insight, relative to where the draw is to say, hey, we're probably going to get this particular profile. So based on these two things here, I can anticipate which profile I'm probably going to get. All right, here's a quick hint. When Asia high and low are swept, and New York opens outside of the Asian range, there's a very high probability you're going to get a classic buy or sell day. So at that moment, my mind already knows, all right, I have a 90% chance of classic sell day. I pulled data from 2023 on the Euro USD alone. When you got that scenario, Asia high and low swept, New York opens 7 a.m., occurs outside of the Asian range. There's this 89% chance from last year on just Euro USD alone that we got an additional expansion. So it's time and price, right? Time and price, having the anticipatory skills as it relates to where the draw is for me to say, hey, I'm probably going to get this profile. So I don't come into the chart with the profile in mind. It's that when I wake up and I know where the draw is, I'm just looking at the relationships between those two prices. And then I can tell, all right, cool. Probability points in this favor.
Sure, thank you.
All right. Any more questions?
Hi, Chris. This is William.
Correct.
Yeah. So do you do scalings? For example, a previous presenter said that he went into first trade and then to the second trade within some like setup. So do you normally do that, or you just go one trade per set?
Yeah. So I'm so my personal risk tolerance is I just like to go in on one trade. I personally I believe that scaling in or trailing stops, I don't really think it's an optimal practice for intraday trading because of the amount of noise. Now that's not to say that there's probably somebody out there who's proficient at it. It's just not something that resonates with myself. Now there are scenarios where I'll scale into a trade like this scenario here, where we had and it made complete sense, right? We were already anticipating open, high, low close for the week. So I'm looking at price and I'm like, all right, we traded to the 4-hour order block. We reacted. We have a dealing range. We had a dealing range. And then we came into Wednesday. We had SMT with EU and GU. So in that scenario, I think, scaling in makes a lot of sense. So I took my initial entry up here and I'm wanting to attack low resistance signature. I'm seeing all of this is relatively equal lows. So for this scenario, I'm trading with order flow. Prices created sell side imbalances. I have SMT, high resistance signature. Gotten in here, price trades lower, I take off 25%. of volume, what I did here was I added 25% of volume here. Now, this execution, the stop was open to where the initial break even was, because worst case scenario, I just break even because I already closed 25%. But that's not a common practice for myself. That's not to say that, you might be proficient, you might be able to do it a lot better than I can. And this is, this, when I say, hey, the market there's random distribution is something we all have to honor within the market, because even though we have all of those, like, literally good characteristics behind price still showed us who's in charge. This is probably this is the least expected thing for price to, on a Wednesday, for price to run here and then turn all the way around and take out the high again after we already had SMT.
Hi, Chris. Just a quick question, please.
Okay.
Yeah. Basically, I just want to ask, the Model X, what sort of time, is it a specific time that you have to be, I know you said there's time and price, but is that a specific time that you have to look in there for the execution?
So I'll say, this is how I answer that question. The ingredient to Model X, right? That recipe or that ingredient, in terms of what's happening, in terms of pricing sequence, that is honestly like universal. All right. So what I mean by this is any time that you see it, you can apply it. Now, we're in the smart money space. We understand that there is certain times of days, right? Kill zones where we have more, where we anticipate that the bigger moves will happen. All right, or at least because of the amount of volume or volatility in the market. But for a set time, you'll see that delivery, and it can work out at any time of day. But obviously, as a trader, you want to refine your trading day into a certain window of time. You don't just want to look for Model X all day long. That will be a disaster. You want to have a focal point. So what we go into from here is next week we'll have a full session on trading New York. Right? You guys will understand every day that you wake up, based on what London has did in relation to Asia, you'll know right away, all right, this is what I should be looking for from New York. And then it's just like a pulley system. It's like one part of your thinking leads to the next and the next.
I had a quick question. Is that the same for futures as for Forex?
Yeah, so futures, if you think about it, I mean, if you're trading like the euro, right? What is that, 6E1?
Oh yeah, 6E or something like that.
Yeah, and then for pound USD, so those, like, if I were to pull up 6E1 here, it's gonna move in the same fashion as let's put 6B1.
Right.
All right, and then we'll put
So if we're doing that, we need to change our kill zones to 7 to 10, and then how did you do that? How do you pull up a line chart for SMT like that?
So you go right here where it says compare.
Thank you, man.
But hey, quick point. Make sure when you do it, you hit new price scale.
Okay, new price scale. So
yeah. So compare here, new price scale, and then what I like to do is I actually put the candles on the chart so I can see it both ways.
Right.
And so you can see this is this is futures and Forex. It moves the exact same chart.
Right. Okay.
All right. Additional questions? Anybody have any more questions?
There's one here. They're asking, is there a list of all the acronyms and glossaries for the terms?
Yeah, we can place it in the chat. So I guess you're asking in terms of EFD, OBV, all that stuff. Yeah, I think it's necessary, so we'll make sure that we get that done.
There's another question there. They're asking when you are in a trade and observe that a housing candle in the 5 minute time frame is taken, is that an indication to close the trade?
Let's draw the scenario up. So here's a high. Here. All right. So I guess your question is saying if we've come here and then we trade and we push through the housing candle, meaning that this would be our housing candle right here, and then we've gone and we traded through that guy. Is that the question? Or maybe you've even gotten this, right? You've actually gotten the full Model X.
Yes, hello. Can you hear me?
Yes, I can hear you now.
Yes, my question is that if you are in the trade, okay, if the trade is going in your direction, but you observe that you are taking some kind of liquidity, so you are creating a housing candle, and then you observe that this, let's say, it's like creating an order book.
Oh, okay.
Yeah, because sometimes you see and you don't know if this will be just a normal retracement or it will be deeper and takes you out in break even. So this is a question that I always wonder myself.
Yeah, so you can tell me if I'm internalizing this correctly. So we've got Model X, we take our execution, but then what happens is we're starting to see the opposite from the opposite perspective. We have a housing candle here as well. Is that what you're saying?
Exactly. Yes.
Yeah. And then we trade above it. All right, so my answer to this is this. Order flow is going to take precedence, higher time frame order flow, right? So if I see this scenario and I'm trading higher time frame order flow is bearish, and I'm trading in line with that higher time frame order flow, and we've tapped into maybe some type of 4 hour order block, 4 hour inefficiency. What you don't want to do is you don't want to get so emotionally involved and be so just have too many try to have too many filters. It's just leave it as simple as, all right, I'm trading with order flow. I've got Model X. I'm gonna let price do what it does. Because this could very well happen, and then you say, oh yeah, it just cleared that fair value gap, so I'm gonna close the trade out. I promise you come out a lot better if you just, the trades that you executed it for a reason. You placed a stop loss for a reason. Let the trade do what it does. Because this market is here to give you these certain scenarios that you think, oh, it's gonna take me out, or this shouldn't happen, and then you close the trade out. Boom. That's not a good feeling.
Yeah, I experienced it.
Yeah.
Okay, thank you.
Yeah.
Someone's asking about the winning percent of a Model X over a year.
Yeah. So in terms of I've gotten this question before. You can't really provide, because that is just an execution model, right? That is just an execution protocol. So you can't really provide an answer for Model X over a year, because one trader might use Model X in a completely different facet than the next trader. All right, there might be a trader who uses Model X in a 1 minute time frame every single day. Well, he's going to have a different success rate. Now, I believe if you were to just take that ingredient, so if we were to put the ingredient of Model X, which is our entry protocol, on a card, right? 1, 2, 3, 4. I say out of 100 times given this ingredient, out of 100 times, I believe 85 to 90% of those times will play out. And the reason I say I can't give you one hard answer is because you could have Model X to show up. It could literally show up in on both sides of the price. This is where higher time frame framework, lower time frame context, we have to truly understand that. This is what I mean by that. You can have this scenario. Price gives you this. Here, here, boom, Model X, right? Now you go short. You go short here, here, right? The ingredient of Model X did exactly what it was supposed to do. Cleared an imbalance. It cleared an imbalance, confirmed order flow, left with speed. That's what Model X is there for. The trader is there to apply it in the right framework and context, and then manage the trade in the right framework and context. So in this case, if you took Model X and you got out here, then guess what the conversation is? Oh man, Model X is great. It worked out. Right? Everything played out. If you take that trade and you're wanting this out of that trade and you're not realizing that this is a higher time frame fair value gap, then you're not having that initial conversation. You're having a different conversation. Model X did what it was supposed to do. The trader, there was something that the trader missed. Okay, and then what could also happen is here, well, there's the ingredient for Model X. It's applied in the right context or framework. Model X is doing what it's supposed to do, then you get speed. So the point that I'm making is, if you get those ingredients, those four things, all right, and you're spotting that, hey, there's displacement here, there's sponsorship, order flow is already bullish, that ingredient in Model X is going to work out about 90% of the time. It's just the management of the trade and knowing when and where to execute and enter and exit rather. We have any more? Question. So let's still understand especially which areas. Yeah. So pretty much the same answer. Right? If you're someone who takes 1-to-1, right? Let's say you apply Model X and you take profit at 1-to-1. You don't care about a draw of liquidity. You're just saying, hey, I'm going to take 1-to-1. Every time I see Model X, I'm going to go 1-to-1. You might have a higher success rate than a guy who wants 1-to-3 or 1-to-4 out of the trade. Why? Because you're in and out of the market. You took advantage of where opportunity presents itself. You said that, hey, if this forms, I know that this market should at least give me a push, which is why I told you guys I have a guy who he only takes 1-to-1s. Right? You're by nature, you're gonna have a higher hit rate. Right? Because you're not susceptible to a lot of break evens or trades turning around, and there's unrealized gains that could have been made. So those questions, guys, are relative to you as the trader, what you do. The ingredient of Model X itself, it's like this right here, right? This is a 15-minute chart. Okay? There's a high, we're taking out that high. Here's the imbalance within the stop point leg. We close that imbalance. We trade through the low of the candle that offers the imbalance. All right, what happened? What is the next thing in terms of Model X? We're looking for an up close candle to trade into the order block. And then we're looking for that up close candle low to be traded through. So there's the ingredient of Model X. All right, it's just a pricing sequence. how you manage, or what plan or what model, what session you trade, the success is going to be dependent on that. It's going to be relative to that, right? Who you are as a trader, what session you trade, what time you trade, what what R you like to work with. Are you a one-to-one guy, or are you somebody that can hold on to trades for 3-4 R at a time? Right? Are you not hurt by a break even here and there, or a winning trade that comes back and turns into a break even or a loser? MEP stands for that's just market efficiency paradigm. When we were going through lecture 1, so there's a few things where we're talking about how price is delivered, right? Stops to inefficiency, the price delivery cycle, consolidation, or we could say engineer, neutralize. That's what that means. It's just that, right? This price is attacking liquidity and it's rebalancing inefficiencies. Attacks liquidity, rebalance inefficiency. I'll take about 5 more minutes of questions. Make sure I didn't miss anything here.
Hey Chris, this is William. Just one last question, yeah. So in terms of instruments overall, what kind of instruments do you recommend for a beginner or experienced trader?
What
as in like how many inexperienced, like how many would you look at? 3 or 4? Because I'm seeing, for example, you look at USHF, Euro GBP, about around 4 that you post analysis consistently. So are they all that you look at, or you also look at others, but if they don't get what you see, then you don't continue analysis or training that pair, that instrument at that time. So like what's like that thing?
Yeah, I would advise, if you're starting out, then I think 2 pairs is enough, so that you're more in tune and you're more in sync with. There's gonna be certain things you need to learn. There's gonna be certain scenarios where maybe there's a filter that you add, or maybe there's something you just need to notice. I don't think you can. I don't think you're in the best position to notice certain things if you have so many different pairs at play, and if you've not gotten to a level of mastery with your system and who you are as a trader. Now, once you get to a point where it's subjective, right? Immediately when you wake up, you know exactly what you're looking for. And if it's there, it's there. If it's not there, it's just not there. This is not a trading day. When you get to that point, then I would say at the most 4 pairs. Now, what matters is that, like, I don't just, when I'm looking at those pairs, it's not just 4 pairs. Those pairs correlate. The reason that I'm using those pairs is because I'm able to leverage the correlation of those pairs. Those pairs have a positive correlation, right? EU and GU, probably about a 90% correlation. I can use SMT. Euro USD and USD CHF has a high correlation. I can use SMT. USD CHF and DXY, I can use SMT. All right, so if you do want to open up, just don't open up to just have multiple pairs. Open up with assets that correlate so that you can use those assets to your advantage.
Thank you.
Mm-hmm. All right, 2 more questions and then we'll wrap it up. All right, market logic entry. All right, so market logic, right, is let's go back to, I think it was earlier in March where we were expecting that 110 level, and there was a Monday. Yeah, this right here. So it was early in the week. And we were expecting open, low, high, close. And so we're coming in here and we're wanting to see price trade lower under the weekly opening price. All right, so kind of to piggyback off of the last question of having multiple assets, right here, what I see is SMT. Right? There's SMT right here, which is beautiful because tracking correlation, it's Monday, I'm already expecting price to go lower anyway. Right? So I have a pretty decent framework. So now that I'm on my lower time frame, going to a 5-minute time frame. Let's say that you didn't trust the relationship of time here. You had a predisposed bias for the week, but you've learned the model, you learned the trading plan, and the relationship of time here it's not really befitting. Okay, but price should go lower. But in this case, a market logic execution would be if I'm seeing price trade through here, right? And I would see this as a balanced price range, right? This little portion of price. You can see once we left with speed, we come back, it's respected at fair market value, and then we push higher. So you're seeing short-term highs engineered into the market. So market logic would be, all right, well, SMT, in this case, BPR, sell side imbalances are created, and then we close through the BPR. Market logic execution would be literally right here. It's me just using market logic to go into the market. I'm not being a robot. I'm using just pure market logic. All right, sell side imbalances are created. You also have Model X here, but let's say you didn't know about Model X. Buy side imbalances are taken out. Sell side is created. Just base logic tells me, hey, this is enough confluence for me to go short. All right, if I can find another example, let's see. This could be a market logic execution as well. Okay, so let's imagine that I don't know what's below market price. Maybe it's a fair value gap. All right, so we didn't tap into the fair value gap. But let's just imagine this were the perfect scenario. Let's imagine we did tap into a fair value gap and you were confident that price is going to run. The biggest part about a market logic execution entry is just simply seeing a balanced price range, knowing what order flow is, and then seeing price trade above that balanced price range of speed. Right? You go right into the market. Down close candles are supporting price, so stops should be safe within here somewhere. This is a BPR within itself. That other example was on Euro CHF Monday of last week. Or maybe the Tuesday of last week. We saw this example earlier, but I'll go back to it. Tuesday of last week, we're seeing price trade down to fair valuation. Market logic entry is simply this. We haven't made it to the draw of liquidity. Balanced price range is created. We take out the low, and then we trade with speed and volume, and we close above that BPR. At that moment, you could execute. What are the chances of it actually trading back through here? Can it happen? Yes. But the probabilities of it happening are not as high. All right, so this plays in your favor. We took this trade and it ran to TP. No worries. That's why we have the recording. And whenever my whiteboard is fixed, I don't know what's going on with the program. Whenever it is fixed, I'll try to give you guys a better teaching on this. We were kind of on the fly today. Any other questions? If not, we'll wrap it up there. And just understand, guys, you're just getting into this today. As time progresses, right, there'll be a lot of teaching points, a lot of learning points, a lot of great scenarios to pick up and learn from. So let's just trust where we are right now, and then also trust where we'll be in the future. I appreciate you guys' time, and I am going to log off from now. Thanks, guys.